UBS is said to be unwinding the first Boston spin-off, while the Swiss lender offers to buy back some bonds sold just ahead of its Credit Suisse purchase. Plus, UK inflation unexpectedly accelerates, likely sealing the deal on a BOE rate hike tomorrow. And coming up shortly, we are in Frankfurt live to hear Christine Lagarde's closely watched address at the ECB and its Watchers Conference.
Tom, let's take a look at the futures now. They did start a little bit higher now. They're pretty much unchanged if you look at some of the futures here in Europe. Certainly when it comes to the FTSE, a bit of pressure there because of that inflation print. That complicates matters for the Bank of England. And then look, the Fed, they have to choose between inflation and the banking crisis. Yeah, arguably there's a little bit more clarity coming through from the BOE versus the Fed. As you say, traders now the most uncertain leading up to this Fed decision, the decision from Jay Powell, since the start of this tightening cycle. What we're going to see as well in terms of the revisions, if they come through for the dot plot, the first time that we're expecting those forecasts potentially to be changed since December, when the highest rate, the terminal rate, was put at 5.1%, given that balance that they now face in terms of price stability and financial stability. Do they take a leaf out of Madame Lagarde's book? And we'll be hearing from the ECB head later today. But it is the Fed that is front and center, of course, and as we reflect on that, here's how things are opening in the first few minutes. You saw a very solid session yesterday, of course, gains in Asia, but right now the FTSE 100 off by 0.3%. That CPI inflation rising for the first time in 4 months and really raising the pressure on the BOE to go at least 25 basis points come the decision tomorrow. Here's the picture across the yield front then. We saw a lot of action at the front end once again yesterday. Yields moving around 19 basis points higher yesterday. Today you're at 340. On the two-year UK, I was referencing, of course, the front end of the US yesterday in terms of that yield movement. 415 at the front end of the Treasury curve currently. Not a lot of movement, of course, a little bit of holding steady ahead of that Fed decision. Here in the UK, then, yields moving on the back of that CPI print. 341. Tighter, of course, higher yields on expectations that BOE will have to hike come Thursday. Here's what the picture is at the front end of the German picture, 269 on the two-year, not all the movement. Again, we lead up to that speech from Madame Lagarde in about 30 minutes' time. What she has to say then about whether or not there is a contradiction between price stability and financial stability, something she's so far pushed back on. Francine. Let's dig deeper into some of the sectors. Out of the 20 industry groups that make up the Stock 600, about half of them are on the downside. Now, I have real estate on the down, I have banks, travel and leisure, pretty much breaking even, unchanged. Retail on the way up, 0.7% higher. I have healthcare and media. What I would point to, Tom, is the fact that actually we had a repricing when it comes to BOE expectations of an interest rate hike tomorrow by 25 basis points. That's on the back of inflation. So this is a picture overall for all of the European indices, but we could see a break away from the FTSE compared to some of the other major bourses.
Yeah, absolutely. There could well be that distinction at play, given that CPI print and the inflation print coming through from the UK. Food and drink really powering that higher. The Fed, though, as we've touched on, policymakers trying to balance their inflation fight with that recent turmoil in the banking sector. This, of course, as we count down to their policy decision later today. For more on this story, let's bring in Bloomberg Markets reporter Valerie Teitel. Valerie, what do we expect then today, given the conundrum facing the Fed?
Oh, it's a big conundrum facing the Fed today. They will likely meet market expectations and going for a 25 basis point hike, but boy, have things changed quickly. It was only 4 sessions ago we were leaning to pricing in a pause. Now we're pricing in 21 basis points. Again, the Fed is likely to meet those market expectations and hiking that quarter point. The biggest thing for markets, though, is what they decide to signal in the dot plot. Will they revise those dots higher, perhaps in a way to show confidence that the banking issues are contained, and repeat that word, ongoing rate increases are in the statement? The flip side of that argument is maybe they'll keep the dots where they are and signal in some way that the lagged effects of monetary policy are upon us. Lending conditions are likely to tighten and possibly doing the work for our inflation on them, leading to less rate hikes needed in the dot plot.
Yeah, I mean, the concern today, for today specifically, is hike 50 basis points. And of course, markets will panic if you don't hike at all. And then you wonder what the Fed is seeing in terms of financial stability or the fact that they don't have faith in their own financial institutions. Going forward, I mean, how is, the press conference, to me, Valerie, seems extremely important because he needs to acknowledge some of the financial breakdown that we saw over the last 3 months whilst reassuring that he's there.
Definitely, Francine. In the press conference, he will be asked on his thoughts on this recent banking turmoil. And let's be honest, the Fed will have more intelligence on this. They've probably spent the last 7 days on the phone to as many regional banks as they can to understand perhaps the impulse of tightening lending conditions. But you noted some of these on your Twitter, Francine, and they're very important. There's some big hats throwing their name into the argument that this will tighten lending conditions materially from here. Apollo arguing that the financial tightening we've seen recently equates to 150 basis points of a rate hike. Mike Wilson at Morgan Stanley also saying that the risk of a credit crunch has increased materially. When we look at the Bloomberg Financial Index, it has tightened and took a very sharp dive tighter after the collapse of the Silicon Valley Bank and the downfall of the other banks surrounding it. But the big question is, maybe they don't know about the lagged effects of this banking turmoil, and they might look to keep their options as open as possible.
Thank you so much, Bloomberg Markets reporter Valerie Teitel. So, Tom, if you look at the European banks, I mean, what a whirlwind they've had.
Yeah, absolutely. The gains of yesterday across the sector, gains of almost 5%. Today, coming off a little bit, maybe a bit of profit taking. Across the sector, down around 0.6%. Here are some of the individual names then. Of course, UBS posted a decent session yesterday, a rally, as investors started to weigh up the longer-term prospects, maybe the fact that you've taken out this tailwind in terms of the risks around Credit Suisse. And you posted a decent session again for UBS. Still, currently, just in the first few minutes, gaining 0.6%. Deutsche Bank just off 0.7, you can see. HSBC gaining 0.4, and Santander 0.5. There's more stability in this banking sector. And of course, the question is whether that maintains. And of course, regulators will be wanting that to happen. A couple of tailwinds that came through. You had, of course, the news that maybe US authorities were looking to backstop or at least guarantee all of those deposits. And then you have the news from Bloomberg around First Republic and the prospect again of the US government's taking something of a backstop there as they look to try and sell off or at least find potentially a buyer for that bank. So a couple of things that came through added to a bit of stability, and the question, of course, going forward is whether that is something that can be maintained for this beleaguered banking sector.
So, Tom, let's get back to the Fed. Ven Ram from our Bloomberg Markets Live team joins us. Ven, we'll get onto expectations for the Fed in a second, but what I find incredible is if you look at the Fed fund expectations since that February 1st meeting, I mean, it's been nothing short of stunning. They've been all over the place, and then we're back to where they were before the banking crisis. What does it tell us about the mood of the markets?
Good morning, Francine. It tells us that the markets are all over the place. They're fretting in this because in the aftermath of the Silicon Valley Bank failure, we saw market expectations come off radically, and that was needed because no one knew at that point how deep the problems were. But now, 1 week, 10 days later on, it looks like the Fed and the other institutions seem to have some kind of a grip on the situation. And it looks like, this doesn't look like a 2007, 2008 financial crisis kind of thing, when pretty much all the financial institutions had exposure to toxic assets, CDOs and stuff like that, which is not the case now. This is a balance sheet mismanagement problem. And definitely with the backstop that the FDIC and the Fed have put in place, it looks like the storm may abate, and that's why we have seen market pricing shift successively higher.
Ben, what is your take on where bonds go from here? The Treasury curve, you've seen that reaction again, so much volatility, and yet JP Morgan saying there is enough liquidity in the system at this point.
There's definitely the sense that there is plenty of liquidity in the system, because if you look at the markets, if you look at the debt spread, for instance, there is no panic in the markets. There is no flight to safety as such. So what we are seeing is purely the expectations of whether banking stability is going to trump is going to matter more than price stability for the Fed. And that's what we have seen playing out. And I think that today's Fed's decision and dissent, possible dissent, and the dot plot together will provide a more definitive direction for treasuries and yields. And therefore, I do expect rate volatility to come off a bit after the meeting.
Then I'm torn because I want to ask you about the dot plot at the Fed, but actually I really want to ask you what you think the BOE will do. It's now fully priced in 25 basis points. Will they just take it and hike?
I think they will take the market pricing on this because, no one expected inflation to come in as hot as it does, as hot as it did, and at 10% plus, there is no. You've got a BOE policy rate of 4%. That's hardly restrictive, and they need to keep going. And where previously they may have thought they may be able to stop around 4.55, I think they will now go definitely to 4.25 and survey the lay of the land after that.
4.25 for the BOE. Bloomberg's Venram, thank you very much indeed for the analysis, the preview of the Fed, and of course, a take on the BOE as yields move higher, aggressively high, particularly at the front end in terms of UK gilts, 3.45 now. That's a move higher by 18 basis points. Coming up, we dive deeper into the world's biggest bond market as JP Morgan says treasuries are seeing the worst liquidity since 2020. We have more on that story. Volatility is key. Stay with us. This is Bloomberg.
Amazon acquired Zoox back in January 2020 for what reports suggested was $1.2 billion. Since then, the company has revealed its Zoox vehicle. This is, I think, a rectangular passenger-focused vehicle with no driver's seat or steering wheel. How would you describe it?
We describe it as a purpose-built vehicle, but it's really a robo-taxi. That's its purpose. And essentially, it's about transporting people from point A to point B on demand in the most effective, cleanest, and most enjoyable way.
So why won't you call it a car?
Because a car is, there's an inference that there is a driver. Whereas in our robotaxi, there is no manual driving. A human cannot really drive it to transport passengers. So we want to make sure that that mindset, that shift, that distinction is clear.
Our studios in New York and San Francisco. Our new hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
He's there, the kind of upside.
Turmoil. what's the Fed's next move?
The job of reducing inflation is not over.
Are they worried about the signal it would send if they did nothing?
Trust Bloomberg for the fastest coverage and exclusive analysis.
Central banks groping their way through a dark room, looking for Schrodinger's cat.
Does this indicate that the Fed is petrified?
Does bank supervision take precedence?
If you want to fight inflation, you better sort out your financial system first.
Bloomberg Surveillance. The Fed decides. Today on Bloomberg, your global business authority.
Welcome back to the Open, everyone. 13 minutes into the European trading day. A bit muted, maybe, for some of these European equities. Look, the real reason is the Fed. We did have an inflation print in the UK that was much higher than expected. That probably cements a hike from the BOE tomorrow. But on the Fed, there's a banking crisis. What does that do to a credit crunch going forward? What does it do to financial conditions? And so what will Jay Powell's messaging be a little bit later on, Tom?
Well, let's get some analysis then, because, of course, strategists are at JP Morgan saying that the Fed can look past what is low liquidity now in the Treasuries market and continue with its rate hikes as the impact on prices isn't as severe as during the onset of the pandemic. Joining us now is JP Morgan Asset Management Executive Director and Global Strategist Paola Toschi. Paola, good morning. Thank you for joining us in the studio. So there is the call from JP Morgan. You think you can look through the lower liquidity. It's not as low as it was at the outset of the pandemic, but it has dropped off. Volatility, of course, has rocketed. They can go 25 basis points. Is that the call? And then what? Take us through to the end of the year in terms of your view on the rate hike policy reaction from the Fed in this environment.
Okay. Thank you very much and good morning. Thank you for having me today. And yes, we have seen a lot of volatility on markets in, I would say, the last couple of weeks. And the reason is that markets had to reprice the trajectory of the Fed rate hikes after, first of all, the release of the labor market report that was still very strong, after data on inflation that confirm that inflation is going down, but very slowly. But on the other side, after also the case of the Silicon Valley Bank and also other turmoil on the U.S. regional sector. Despite that, we think that and we expect that today the Federal Reserve will announce a rate hike of 25 basis points, but we think that the attention will be really on how Chair Powell will be able to balance between the need to continue to be very committed in the fight of inflation, and so the price stability, but on the other side also finding some flexibility in order to manage also the financial stability, so the other part of the story.
Yeah, so if you look at 25 basis points, is that with conviction because it's the right thing for inflation, or is it because he has no choice? If he does 50, then there's panic on the markets. If he doesn't do anything, then it means that he lacks the faith in his own financial system.
Yes, I think that this could be I would say, compromise for the Federal Reserve, because in my opinion, they have really to confirm that the fight of inflation is not over. So they have to continue to be very committed on that. But on the other side, I think that they must also continue to keep a high attention on the confidence of investors, of market, after also recent interventions that were very rapid, that contributed, as we can see on markets, to restore some confidence on markets. So we think that this could be a very welcome outcome of the two-day meeting. And I think also that the attention will be focused on the messages and also the next steps of the Federal Reserve. Because we think that after this rate hike, the Federal Reserve could pause. And in my opinion, this could be also a good opportunity for the economy to start to incorporate all these last measures and also this last rate hike. And so also the Federal Reserve could really assess the implication on the economy. We could start to see also some moderation. Also because we have already seen a result of the stress of the banking system. We can see that the financial condition, the credit condition are deteriorating. And in my opinion,
Torsten Slok from Apollo Global came out with an estimate that the banking crisis is the equivalent of about 1.5% in terms of rate hikes. To your point around financial conditions, look, we were having a chat about this during the break. The dot plots, do they actually matter? Van Raum from MLive, really smart on all things rates around the US, saying that look, the markets could be underpricing the risk that the dot plots are revised higher at this meeting.
No, I don't think that probably this could be the case. In my opinion, we could assist to a more moderate approach, and we could assist also to the intention also of the representatives of the FOMC to really find out a balance in order to continue to find the good way in order to balance these two needs for investors and for markets.
But Paola, what would you do? So, and look, the dot plots are fine in theory. The problem is that we don't really know what inflation does. But if you look at the medium-sized banks, how much do they lend to a lot of companies in the U.S.? If we're looking at a credit crunch, is it 25 basis points and done?
Yes, absolutely. That's why I would say that, in my opinion, these two parts of the story are working in the same direction because they are contributing also to reduce the expectation on growth. They are increasing also the risk of a recession. So we could expect that a recession could arrive in the second part of the year. And for this reason, we could also expect that the Federal Reserve is reaching the end of the tightening cycle, is reaching the terminal rate. We could expect, this will depend on data, this will depend also on the evolution of the banking system. We could expect another rate hike.
So how do you want to position around a pause from the Fed?
I think that the Federal Reserve could pause the next meeting, waiting for understanding the evolution of the economy, and eventually they could decide another and a last rate hike, probably in May or in June. But after that, we could have reached the terminal value, and so we could start to see the turn of the monetary policy in a much more easing and loose manner, and this will have a lot of implication for the economy, but especially for markets.
Well, if we take a step back and actually we're looking at First Republic Bank shares rising in early trading today, we understand that there's maybe a shoring up of the mid-sized lender and that they're progressing, and that would shore up a crisis of confidence. What have you learned personally in the last 3 weeks? I don't know whether it's more government intervention for banks or just simply that even if you make mistakes, it's very difficult to go from 1% to 5% interest rates without something breaking.
It is really difficult to make comments on, I would say, the trajectory, the trend of the monetary policy, I would say in the last years, not only in the recent past, because we think that probably the monetary policy, the ultra-loose monetary policy was taken for a very long period of time. And this probably is a part of the risk that we see now. And so we think that at this point, we would like to avoid another mistake, that the monetary policy has been tightened too rapidly with a huge amount of tightening, especially in the US, but also in Europe. The risk is that there could be another mistake. And this is a theme where we are discussing a lot because it could have a lot of implication on the economy and the implication of this trend.
Paola, thank you so much. JP Morgan Asset Management Executive Director and Global Strategist Paola Toschi. Coming up, UK CPI increased for the first time in 4 months. That's despite economists largely forecasting a drop. We'll discuss tomorrow Bank of England's decision next, and this is Bloomberg.
very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much like the consumer is paying them. And so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value and the kind of transparency that they want.
Are you seeing a labor shortage right now? And what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
Welcome back to the Open, everyone. 23 minutes into the European trading day. Fed. It's Fed day. And of course, we'll have to see Jay Powell walk, of course, that talk between interest rate hikes, maybe 25 basis points, and at the same time, financial stability. So UK CPI for the year to February beat even the highest estimates of the 39 economists polled by Bloomberg. The red-hot inflation data come as restaurants and retailers boosted prices and will inform the BOE's interest rate decision tomorrow. We're now joined by Jamie Rush, Chief European Economist at Bloomberg Economics. Jamie, if you look at what the market is priced in, 25 basis points, a hike, does the Bank of England just take it?
Yeah, I think they have to hike now. Core inflation where it is just too high. It's clearly a surprise to the market. Have we seen enough tightening of financial conditions to push them into panic mode? I think no, not yet. So our best guess is that they will hike as we expected, and then the pause is likely.
Do they have to rip up the playbook in terms of their forecast for inflation? They had seen a sharp drop in inflation in the second half of the year.
Yeah, I mean, actually, so if you look at their forecast, this is actually still slightly below what they were expecting. So I don't think it actually goes to tear everything up. It's just that it's clear, the more that it surprises that they're most responsive to. And it's obviously not good when the market's getting it wrong the day before the release.
I know, but so what were we expecting, actually? So February, we know, is a bit volatile because that's usually when price hikes come. But it's restaurants that put up their prices and alcohol beverages.
Yeah, I suppose some of us will be guilty of having drunk something in February and pushed up the price. Not me, of course. But no, I think that when you look at the pressure across the economy and you strip out some of those volatile items, even within core, it's just very bad news. There's services price inflation. That's the stuff that's sticky, and that's where the bad news is located. So I think it really does put pressure on the bank. It's awkward for them, but they're going to have to just live with it.
So they go 25, and then what? Draw us out in the quarters ahead, the months ahead.
So I think there's a strong case for them to pause. And I think actually, if you look at market pricing now, they've actually added another hike on top of the 25 basis points that's likely to come tomorrow. I think you have to set that against the tightening financial conditions. When you look at the cost of bank credit, the cost of them supporting themselves, that's gone up much more than we've seen for corporates, for example. There are severe downside risks here. So I think that the bank will be probably on hold.
All right, did I take a bet on you as well? Because I've lost my bet. I thought they weren't going to hike. That's what I had intimated from Andrew Bailey, and then I have that inflation print.
I mean, that was
I feel like I owe bottles of wine or vino to a lot of people. Have we taken a bet that I've lost yet?
No.
People, come and collect your bets that you won against Francine here. Jamie, thank you so much. Jamie Rush there from Bloomberg Economics.
Okay, coming up, UBS offers to buy back billions of euros worth of bonds it issued only last week. We're going to have more on that. And the rest, of course, of the Credit Suisse fallout. Your markets right now, equity markets here in Europe, flat. Futures in the US down 2%, 0.2%. The action really is in the debt markets here in the UK, where yields are rallying. 19 basis points at the front end, 3.46 on that hotter than expected inflation print. Stay with us. This is Bloomberg.
going to name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It's the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
This is Bloomberg.
Welcome back to the Open, everyone. 30 minutes into the European trading day, and here are your top stories. European stocks and U.S. futures fall before today's Fed decision as Jay Powell looks to balance fighting inflation against the banking crisis. Treasury yields are lower. UBS is said to be unwinding the First Boston spin-off, while the Swiss lender offers to buy back some bonds sold just ahead of its Credit Suisse purchase. Shares surge for a third day. Plus, UK inflation unexpectedly accelerates, likely sealing the deal on a BOE rate hike tomorrow. Coming up shortly, we're in Frankfurt live to hear Christine Lagarde's closely watched address at the ECB and its Watchers Conference. So, Tom, a lot of exciting things on the markets today.
I mean, the Fed and the Jay Powell presser are going to be absolutely fascinating, as we've been discussing, given the tensions around financial stability and price stability. Do they look to Madame Lagarde and the playbook there from the ECB with a hike, but couching it in dovish terms? And what are we looking for? What are we expecting in terms of the dot plots as well, whether they get revised and in what direction? Across the benchmark European stocks here, something of the holding pattern kicking in, down 0.1%. So you saw the banking sector really rally and rally hard yesterday, gains of almost 5%. Some profit taking coming off the banking space, but a little bit more stability coming through across that sector. Over in Germany, just a drop of 14 basis points, 14 points, 0.1%. The FTSE 100 in focus for us today, given the CPI print, particularly being reflected, though, in sterling and in gilts, currently down 0.3%. Real estate is under pressure. Let's switch it over and see how things are playing out across these sectors then. Again, banking remains in focus for us today, but there has been some moves around US government discussions on First Republic Bank and, of course, the assessment from some investors that Credit Suisse, in terms of that long tail risk, has been taken out by its absorption of UBS. Retail is gaining 0.9%, but at the bottom of the list, there you have it, real estate down 2.4%. Let's cross over and see how things are playing out then across pre-market. It was we lead up, of course, to the session in the US with the focus firmly on the Fed. Some individual stories playing out, though, and some interest there. First Republic gaining 2.6% pre-market. It rallied again yesterday, and the Bloomberg reporting suggesting that maybe the US government is going to provide something of a backstop as they work with Wall Street officials, the likes of Jamie Dimon at JP Morgan, to try and make this an attractive prospect for a potential buy. Nike down 1.7%. Profits missing, despite the fact that sales came in above expectations. And GameStop, the meme stock favorite, gaining pre-market 38%. Look at that, coming in with a surprise profit for that meme stock business, and we'll see again if that continues. They didn't give a forecast for 2023, but nonetheless, it seems that investors are liking that story once again, Fran.
So, Tom, UBS has offered to buy back 2.75 billion euros worth of bail-in bonds it issued just days before agreeing to acquire the troubled rival Credit Suisse. For more on this, let's bring in Tom Metcalf, who leads Bloomberg's UK and Middle East finance coverage. So, Tom, Good morning. Talk us through the thinking behind this move from UBS.
Yeah, it's all about the timing, right? So they issued these bail-in bonds, before the Credit Suisse takeover, a matter of days. So it's kind of almost an investor relation management strategy, right? Those investors are probably quite rightly, looking at all the things that have changed since they bought those bonds. Those are obviously material shifts. And so UBS trying to, looking for the long-term game, right? Trying to keep investors on side, saying, you know what, the fair thing for us to do is to buy these back, and then we, presumably will issue some more once, the dust has settled and people know what they're actually buying into.
Tom, just briefly on what's happening with the US then, and I touched on this, the fact that maybe the government might be looking to provide some kind of backstop for First Republic, that stock up again around 2% today. What is the latest there?
Yeah, well, the Credit Suisse situation sort of seems resolved, or at least sort of boxed off. Yeah, in America, it's all still up in the air, and I think that chatter that the government is intervening is definitely what's behind that First Republic share price. So, not quite clear exactly what that might mean, and you would think, the US will be doing everything they can to sort of minimize that, because obviously politically it's a pretty toxic idea, this concept of a bailout. But it looks like maybe the government might take out some assets, maybe there'll be more guarantees, but yeah, still to be sort of fully determined.
Tom Metcalf, thank you on the latest around US banks and, of course, that decision by UBS to buy back some of its bonds, Fran.
Now, liquidity in the banking sector and the stability of financial markets are just two topics we can dig into now with Alex Brazier, Managing Director at BlackRock for many, many years, also at the Bank of England. Alex, as always, thank you so much for coming on. Look, we'll talk about the Bank of England in a second, but this is a huge day. It's almost judgment day from the Fed. What's the right way of looking at how Jay Powell needs to balance financial stability, concerns on the banking sector, and inflation?
Well, I think in a way they're going to follow the playbook of the ECB, which is to very clearly try and separate what they're trying to do with monetary policy, which is fight inflation, and what they're trying to do with financial stability policy, which is stabilize this banking turmoil. I think they've got the tools to do the latter. They'll feel they've got the tools to do the latter. And so they'll be very clear that they're continuing their fight on inflation. And remember, in the midst of all this last week, we had a US CPI number that showed that core inflation was still stubbornly high, and they'll be very keen not to suggest that their commitment to get inflation down has somehow waned.
Alex, BlackRock have been on this for a number of months, the view that, in fact, rates are going to have to be higher for longer because inflation is going to be stickier, particularly as you move down to 4 or 3%. Does anything that's happened in the last few weeks change that view?
At the margin, but broadly, no. So the big picture here is that the Fed embarked on the fastest rate hiking cycle to, on some measures, the most restrictive levels of rates since the 1980s. It was inevitable that that was going to slow the economy, the US economy, cause economic damage, and along the way expose cracks in the financial system. And that is exactly what has unfolded. So in that sense, expecting the Fed to come to the rescue here in the way it has done in previous periods of financial turmoil would be a mistake. That's the old playbook. The Fed has deliberately created economic damage here in its fight against inflation. Now, I say at the margin because obviously what's happened now as a result of the banking turmoil is that credit conditions are tightening a bit more. And that's going to do a bit of the Fed. Well, yes, but that's a number of rate hikes in terms of quantification so far. And that's going to do some of the Fed's extra work for it. So before this, the Fed was going to go well north of 5. The tightening of financial conditions will do some of the work for it. So the recession that's likely coming is going to be a bit more credit conditions heavy and a bit less pure policy heavy. But broadly speaking, the Fed has embarked on a very rapid tightening cycle to cause damage to the economy, to fight inflation.
And I know this is very difficult to model, and we are, if you're looking at the mid-sized banks, of course, they're going to probably lend more, which could lead to what you're intimating, which is a credit crunch. But so far, have we seen, because of the banking crisis, an extra 150 basis point hike in the market so that it did the job for the Fed, or is it 50 basis points?
I think it's more like 50 at the moment, particularly since the Fed has moved in to stabilize the bank run situation that arose 10 days ago. I think the issue is more a kind of longer running one now, where mid-size and regional banks will face a higher cost of funding. They may face more intense regulation. All of that will raise their cost of funding, which they will pass on to their lending rates. And that's the channel through which this happens. So rather than a sudden, acute tightening of credit conditions, you see a longer running tightening.
If you were to quantify, or at least weigh up and map out the risks, top of mind for you and the team at BlackRock, is it a systemic credit event now? Does that take the place of inflation?
No, I think inflation is still front and center. I think what's happened in the last few weeks has shown that the authorities actually have the tools to deal with banking issues where they emerge. They've got experience and they've got tools in a way they didn't have in 2008, actually, and they've moved pretty decisively to deal with some of these problems. Now, there may be other issues along the way. As I say, when you embark on the fastest rate hiking cycle since the 1980s, things will break. And that was, in a way, inevitable. So I think the Fed will be looking to deal with these issues as it goes. But key to this is stubborn inflation. Yeah. And that's why the playbook now, we feel, has to be different. It means the Fed doesn't come to the rescue. 2008, it was fighting deflation as it used all its financial stability tools to combat the financial crisis. Now it's fighting inflation as it uses its tools.
And I know we've talked about something breaking. I'm still a little bit surprised that it's, you know, some of the banks that were highly capitalized and actually should have been better regulated, and certainly what happened with SVB is something also internal. Overall, are you expecting 25 basis points from the Fed today and then done because of credit conditions?
No, I think 25 today and then maybe one hike more. To go a bit north of 5. If you'd asked me this 3 weeks ago, I would have said further north of 5. This has done some of the work for it. But the big picture here is not so much how many more small rate rises are yet to go. It's does the Fed come to the rescue as credit conditions tighten, like it did in the past? And the answer, I think, there is a firm and no.
Let's draw on your experience at the Bank of England then. 25 basis points from the BOE on Thursday and then pause. That's the view from Bloomberg Economics.
Well, I think, yes, on balance, but it's difficult to gauge. We've had another hot CPI print this morning. But you have to see that in the light of the weak print last month. And also, you know, the Bank of England's got this problem now where it's like someone in an unfamiliar hotel room. You've turned down the thermostat a long way, but the room's still pretty warm. And you don't want to wake up in the night freezing. You've got to wait until the temperature adjusts. You know, Bank of England thinks on its own forecasts that what it's done to rates to such a restrictive level, I mean, it's equivalent to the Fed going north of 6 in some ways, will slow the economy. It will lead to a very substantial rise in unemployment and no growth over a 5-year period. Now, that's what it thinks is necessary to get inflation down. But it's got to that point now, and so it's a question for the bank of how does it not raise rates further and wait for the temperature of the economy to cool sufficiently far?
Of course, a hotel room always watch Bloomberg. That's at least something that could be quite comforting. So you expect, 25 tomorrow also because it's given to them on a platter now, given market expectations, and then for the rest of the year, possible pause?
Yeah, I think possible pause. A lot depends on the precise path of inflation. They'll want to be confident that inflation, core inflation in particular, is coming down. And that will give them the room to pause and wait for the temperature to adjust.
Alex, thank you so much. As always, Alex Brazier, their managing director at BlackRock.
Okay, let's cross over. We've got live pictures now of Madame Lagarde, Christine Lagarde of the ECB. Interesting to hear from Alex Brazier there of BlackRock that the Fed will probably take a leaf out of the playbook of Madame Lagarde. She's speaking, of course, at their conference, the ECB and Watchers Conference in Frankfurt. Let's listen in.
As you said, the euro area has been hit by an inflation shock, which is now working its way through the economy. While headline inflation is likely to decline steeply this year, driven by falling energy prices and easing supply bottlenecks, underlying inflation dynamics remain strong. And in such an environment, our ultimate goal is clear. We must, and we will bring down inflation to our medium-term target in a timely manner. But to achieve this goal, we need a robust strategy which takes into account the high level of uncertainty that we are facing today. As John Maynard Keynes once observed, I quote him here, "It would be foolish in forming our expectations to attach great weight to matters which are very uncertain." We might just be in those times where matters are very uncertain. In current conditions, a robust strategy calls for a data-dependent approach to making policy and a clear reaction function so that the public understands the sources of information that will be important to us. To that end, our future policy path will be determined by 3 factors. 1, our assessment of the inflation outlook in the light of economic and financial data. 2, the dynamics of underlying inflation. And 3, the strength of our monetary policy transmission. At the same time, I have made clear that there is no trade-off between price stability and financial stability. We have plenty of tools to provide liquidity support to the financial support if needed, and to preserve the smooth transmission of our monetary policy. In my remarks today with you, I will discuss our policy path so far and what lies ahead. And I will explain the reaction function that will govern our future rate decisions. So let us start with the path so far. Last year, inflation in the euro area surged strongly and spread deeply because it was driven by two types of shocks which hit the economy at the same time. First, we underwent an unprecedented series of negative supply shocks caused by pandemic-induced supply chain disruptions, Russia's unacceptable and unjustified invasion of Ukraine, and the ensuing energy crisis. And this significantly increased input costs for all sectors of the economy. Second, we faced a positive demand shock caused by the reopening of the economy after the pandemic. This seems long forgotten, and there is only one person with a mask on his head today. Remember 2 years ago, everybody shut down, away, not going out? And then demand arose. That favorable demand environment allowed firms to pass rising input costs through to prices much faster than in the past. We were eager to buy and to consume. This initially placed important emphasis on signaling. That is, demonstrating through actions and commitments that monetary policy would cover the necessary ground decisively. And that is why we put a great emphasis on the pace of our action, by hiking rates in large increments. I remember the long debates as to whether we should start with 25 basis points or maybe 50, and we did go for 50 precisely for those reasons. And we also communicated a clear upward path for rates so that the public could be confident that monetary policy was on an anti-inflationary path, and that rates would soon leave accommodative territory. In a sense, an emphasis on data dependence was less important because monetary policy had distance to cover across all scenarios. But as inflation outlook evolved, it became clear that a pure normalization of policy, which would imply achieving a broadly neutral stance, would not suffice in itself. The combination of shocks had two effects, on distance and persistence, which warranted further policy action. First, the shocks increased the distance of inflation from our target. Even though inflation has likely passed its peak, it is descending from very high levels, and it is projected to be too far above our target for too long. And the longer inflation is too high, the greater the danger is that it remains so. Second, the shocks also increased the risks that above target inflation becomes more persistence, so distance and persistence. In particular, price pressures have broadened and deepened. Measures of underlying inflation tracked by the ECB currently range between 4% and 8%. In this setting, we need to bring rates to sufficiently restrictive levels to dampen demand. And in doing so, we could keep a firm grip on inflation expectations and ensure that they remain anchored. That is a key reason why we are committed to raise interest rates at a steady pace over recent meetings and significantly. And that is why we decided last week that a further 50 basis point hikes was necessary. So this is the path that we covered. Let's look at what lies ahead now. Now that a sizable policy adjustment is already behind us, as you mentioned, Volker, since July last year, we have raised interest rates by 350 basis points. However, inflation is still high, and uncertainty around its path ahead has increased even more recently. This makes a robust strategy going forward essential. And such a strategy has three elements. First, with high uncertainty, it is even more important that the rate path is data dependent. This means ex ante that we are neither committed to raise further, nor are we finished with hiking rates. Indeed, as I explained last week, if the baseline scenario in our most recent projections is confirmed, we will still have ground to cover to make sure that inflation pressures are stamped out. Second, while the European banking sector is resilient, with strong capital and liquidity position, in view of recent financial market volatility, we are ready to act and to provide liquidity support to the financial system if needed, and to preserve the smooth transmission of our monetary policy. But it should be clear that there is no trade-off between price stability and financial stability. And as we have demonstrated many times, we are able to set the appropriate policy stance to control inflation and at the same time use other instruments to address risks to monetary policy transmission. For instance, we did this when we decided to use reinvestments under the Pandemic Emergency Purchase Program more flexibly and when we agreed on the transmission projection instrument. These programs ensured that rate normalization proceeded smoothly. The third element of a robust strategy is a clear reaction function. At our last meeting, we clarified our reaction function and the sources of information that would be important to us. The future calibration of the rate path will be determined by and will require continuous monitoring of three key inputs. And that's what I will try to clarify now, those three key inputs that we will be watching very carefully in the weeks and the months to come. The first input is our assessment of the inflation outlook in light of the incoming economic and financial data. This will be informed primarily by our staff inflation projections. Monetary policy must be forward-looking, given the lags with which policy works. And the staff inflation projections are the best mechanism for distilling incoming economic and financial data into a comprehensive picture of medium-term inflation dynamics. The future path will depend on whether we see inflation converging durably to our target in our forecast and the level of confidence we have in this convergence as captured by the balance of risks. Our latest forecast sees headline inflation at 2.1% in 25 and core inflation at 2.2% in 25, which is a downward revision compared with our last projection round in December. But the confidence band around these forecasts is now unusually wide. As the cutoff date for the projection round was in early March, the forecasts do not incorporate the effects of the recent financial market tensions. And those tensions have added new downside risks and have made the risk assessment blurrier. More generally, many of the assumptions in the projections, such as those on fiscal policies, on energy, food prices, are volatile. This implies additional uncertainty around the baseline for both growth and inflation. Now, some of this uncertainty will recede as the fallout from recent events in financial markets becomes clearer. But faced with overlapping shocks and shifting geopolitics, the level of uncertainty will most likely remain high. To confirm the outlook in our projections over time, we therefore also need to look at additional indicators that can be observed in real time. And I come to my second point. We will be drawing on the dynamics of underlying inflation. Now, underlying inflation is not a policy target. But measures of underlying inflation can very well serve as a complementary cross-check of our forecasting process. Underlying inflation is typically quite inertial and therefore gives us an indication about the persistence of inflation into the medium term. We will be looking to see a sustained downward turn in underlying inflation measures to be confident that the inflation path will converge to our target in the medium term. So far, we do not see clear evidence that underlying inflation is trending downwards. In fact, we see two forces pushing underlying inflation in two different directions. To one side, falling energy prices are weakening a key driver of underlying inflation pressures. Imported energy prices have played a central role in pushing up inflation to all economic sectors, given the huge energy shock we have faced. And this is why measures of underlying inflation that capture the more persistent effects of energy cost are already now showing a decline. That's going in one direction. Now let's look at the other direction. To the other side, we have increasing domestic price pressures that could offset some of this disinflationary pressure. Measures of underlying inflation that capture items sensitive to the business cycle, such as our supercore, or items with low import content are still strengthening. If this continues and aggregate demand picks up from its current compressed levels, we could see a handover from imported to domestic price pressures that keep overall price pressures high. The key issue in determining which of these two forces wins out will be developments in wages. The euro area has suffered a large terms of trade loss owing to rising energy prices, the cost of which must ultimately be shared between firms and workers. And it is important that there is fair burden sharing between them, with both accepting that they cannot fully recover the income that the euro area has paid to the rest of the world and the ensuing loss of output. So far, real wages have decreased substantially, while firm profit margins have expanded in many sectors. But the labor market is quite tight. Labor shortages are increasing, and the terms of trade shock has largely reversed. So this is leading workers to use their bargaining power to recoup that lost income.
Okay, listening there to the ECB President Christine Lagarde speaking at the ECB Watchers event in Frankfurt. You can continue to watch this on the terminal, of course. We will continue to bring that on the T Live for live coverage of Madame Lagarde. Really, the key message from this is that they are nowhere near being convinced that inflation has been addressed across the Eurozone. Lagarde saying that there's no evidence that underlying inflation is trending down. The ECB must and will bring down inflation to target. Lagarde saying that we've communicated a clear upward path for rates. There is no trade-off between price and financial stability. The euro is gaining. Yields are up on German debt at front end, 268. Euro trading at 107. That is it for the European market open. Surveillance early edition is up next. Stay with us. This is Bloomberg.
Should diminish as this process plays out. But if both parties attempt to unilaterally minimize their losses,
Fitzpatrick are the exception in finance, not the rule. Morningstar has taken an in-depth look at women in the industry, and the numbers are startling. The firm found that in 2020, women made up 14% of global fund managers. That's largely unchanged from the year 2000. Morningstar also calculated that while the number of women at the top of the corporate ladder has increased, it won't be until 2060 that women will reach parity with men in the C-suite. Studies have shown that increasing the number of women managers leads to better decision-making and moderates overconfidence. European Central Bank President Christine Lagarde insists that male domination of the banking industry made the 2008 collapse of Lehman Brothers more likely. As Lagarde put it, if it had been Lehman Sisters rather than Lehman Brothers, the world might well look a lot different today.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
The Fed, as we know, has interest rates at elevated levels. I don't think they should raise rates tomorrow, but neither do I think that that is the end of the tightening cycle, because inflation is still running at quite elevated levels.
It is too soon to expect that the Fed will throw in the towel, so to speak, on their inflation fighting.
Everything is so interrelated. If the Fed is hawkish, then that's going to mean higher real yields. It probably means wider credit spreads. It probably means a stronger dollar.
I think they'd be well advised to pause here. You don't want to play around with banking crises.
This is Bloomberg Surveillance, early edition, with Anna Edwards and Matt Miller.
It is 9 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. The Fed's caught between inflation and a sudden banking crisis. We will learn today whether policymakers choose to keep raising interest rates or put the hikes on hold. More fallout from the Credit Suisse takeover. The Swiss government freezes bankers' deferred bonuses. Meanwhile, UBS offers to buy back billions in bonds it sold just before the deal. And Nike posts sales that beat expectations, but profit at the athletic wear giant comes up short. Welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London with Kriti Gupta in New York. Anna Edwards and Matt Miller, as you may have noticed, are off. Kriti, we've heard from the ECB, Madame Lagarde speaking now. The BOE, arguably, it's a clearer picture from them, given red-hot inflation that comes through from the UK. The Fed, though, it is uncertain.
A lot to digest for sure. When you look at the markets here, though, it's an interesting day because, of course, to your point, the Fed is going to be in the spotlight today. It's finally Fed Day, which, of course, in theory, should mean a little bit of risk-off sentiment. Tom, this has been the trade going back over a year. The idea that futures have been down, stocks have been down in the lead up to the Federal Reserve. This time, just a little bit different, given that we had that rally yesterday. But nevertheless, futures taking a little bit of a breather today. But I wouldn't call it major conviction in either direction. Down about 0.2% on the benchmark. I want to take a look at the bond market, though, because it's all about the pricing. 25 or pause seems to be the two options on the table, but don't rule out, say, a 50 or a 25 basis point cut, as Nomura and Citi once said. We'll see if those calls stick throughout the rest of the day. Of course, the two-year yield at 4.12 here. We're looking at a 3 basis point move lower. Look, if you're looking at a terminal rate of 4.75, hypothetically, as a pause, there is still a major dislocation in the front end of the curve. So that's going to be an interesting trade to kind of watch to see where the Federal Reserve goes next. If there is that 25 basis point hike, you're going to feel it in the Treasury market. The folks that are shorting Treasuries perhaps benefiting from that trade. Go out further on the curve. You're looking at a 10-year yield of 3.58. Meanwhile, a crude kind of trading with a 69 handled. I'd argue post-Fed, Tom, crude is going to be the story, down about 0.7%. What's going on in Europe?
All right, that's an interesting call. We'll keep across the commodities picture, of course. It's a muted picture here in Europe. The DAX over in Germany just holding on to gains of a little over 0.1%, given the rally that we saw yesterday. Over in France, the CAC 40 is off by 0.1%. And in Spain, the IBEX just clinging on to some very meager gains. A bit of a holding position in the equities markets. The UK under a bit more pressure, down 0.2%. But the focus and the interest is really in FX, and particularly in the bond markets as well, of the gilts, given the inflation print that's come out in the last couple of hours out of the UK. Let's switch it on, see how things are moving then cross-asset. I want to zero in, of course, on what's happening at gilts then. The 2-year, 347, look at that move higher, 19 basis points as investors readjust to an inflation print that came in at 10.4%, well above the forecasts of 9.9%, and just baking in expectations that the BOE, which is up on Thursday, will have to move at least 25 basis points. Again, across the benchmark European stocks, just a gain of 0.1%. Banks are back, though. The solid gains that we saw yesterday, gaining almost 5%, the sector yesterday, posting additional gains today of 0.7% so far in the session. A little bit of stability then around that sector, at least for now. Here's the pound, 122, gaining 0.5%, a rally for sterling, again tying in to that CPI picture. We mentioned Madame Lagarde. The euro is also stronger, reiterating the need to continue fighting inflation. Critty.
Yeah, certainly something we're going to be keeping an eye on. Happening right now, though, to your point, Christine Lagarde speaking at the annual ECB and its Watchers event. Let's actually dive in and hear what she has to say.
And business investment also contracted at the end of last year. The greater role played today by sectors that rely on discounted future earnings, such as tech, could also make monetary transmission more powerful. What we will have to monitor carefully in the weeks and months to come is whether there is a further strengthening.
Okay, that is Madame Lagarde there speaking at the ECB Watchers event in Frankfurt. We'll continue to keep across the lines coming out from the president of the ECB. Let's bring in our chief European economist, though, Jamin Rush, for the analysis of this and a call, of course, on the BOE. But we'll start with the ECB. Listening in there, she's very insistent that inflation dynamics have yet to show any signs of properly and significantly abating in the Eurozone. They are determined to get back to that 2% target and saying, again, there is no conflict, there's no contradiction between price stability and financial stability. Your take on what we've been hearing from the ECB's Lagarde?
Well, I think on that latter point, there are now two ways you can be hawkish as a central banker. You can be worried about inflation, or you can be hawkish about the separation of financial stability and monetary policy. And I think that's what we've seen at the ECB. People who are considered doves on inflation are also, they can be still hawkish about that separation. They're not in favour of pragmatism about the rates path. They want to separate those things completely. So I think that's one lesson from the ECB's latest meeting. Lagarde, what we're hearing is the shift in the reaction function a bit. So previously, they just focused on underlying inflation. That seems to be the major driver, basically operating policy in the rearview mirror. Now she's placing a bit more emphasis back on the inflation forecasts, and they're thinking, of course, about the transmission of policy and how that's going to affect the economy. So she set out three things. And because they haven't got any guidance, so they had to set out a reaction function.
Yeah, she talked about the fact energy prices have come off, but then she also touched on wages and the throughput and how long this is going to take. Services, of course, and inflation there remains sticky. There's a deep concern they haven't really addressed this. Where does it leave your assessment and the team's assessment of where rates go from the ECB in the months and quarters ahead?
So our view, so before the banking crisis began, our view was that they would take rates to 4%. From what we can see about the tightening of financial conditions since, you maybe get to a terminal rate of 3.75, maybe 3.5. We're not at the stage yet where we can say the banking crisis is going to take all further rate hikes off the table. So we don't think they're going to pause. We think they will do 25 basis points for the next few meetings. Condition, of course, on things not blowing up further.
Okay, that's the call from Jamie Rush and the team at Bloomberg Economics. Thank you very much indeed, as Madame Lagarde gets to the end, it seems, of her speech there in Frankfurt. Now, UBS is offering to buy back about 2.75 billion euros worth of bonds it issued just days before agreeing to acquire troubled rival Credit Suisse. For more, we're joined by Bloomberg's senior finance editor, Stephanie Bianchi. Stephanie, can you talk us through the thinking then behind this move from UBS?
Sure. And as you say, it's about $3 billion of bonds that will be offered from today. And these are bonds that were offered just days before this now, I guess, infamous deal by UBS for Credit Suisse. And it's really giving those investors to reassess what they bought into before this deal happened. So perhaps have a second thought about the risk that is now involved with these bonds. So it really will be interesting to see what appetite there is for this buyback.
Stefania, we're hearing that there may be further American government involvement to shore up the banking sector across the Atlantic. What kind of involvement might that look like?
That's right. It's from one troubled bank to another. So what we're hearing is that Wall Street leaders and US government officials have been in talks to see what sweetener they can offer to any potential suitors that may come along for this bank, for First Republic. We know as well that Janet Yellen said earlier on Tuesday that the government will take extraordinary measures if that's needed to shore up this bank. So really what they're looking to do is perhaps stave off any further bank collapses and any further disruption to the financial sector as a whole.
Well, certainly something we're going to be keeping our eye on. Stefania Bianchi all over that story on the banks. We thank you as always. I want us to go to some earnings news here. Nike posting quarterly sales that beat expectations as the sportswear brand worked down its excess inventory. But profitability came up short amid markdowns and high freight costs, add-on material costs. And it's not a pretty picture. Bloomberg's Joe Easton joins us now. Joe, walk us through the earnings. For me, I feel like I could put Nike in the category of American global bellwether alongside the likes of, say, Starbucks or Caterpillar.
That's right, Chrissy. Well, I mean, it's an absolute powerhouse, isn't it, in terms of its position in the market. But for me, the earnings were pretty strong, really. I mean, the revenue was up almost 15%, around $12 billion in terms of the quarter. There's not many companies in the space that can do that. The shares, though, did obviously slip after the market hours in New York and a little bit this morning. But really, that's because this stock is kind of priced to perfection. It trades at about 35 times the earnings. So it's one of the most expensive stocks on the street in that space. So I don't think the decline after market is really reflecting the strength in the earnings. Yes, the margins were weak, but that's mainly because of input inflation, wages, energy, things that are affecting so many companies. To me, I think the top line indeed is particularly strong for Nike.
Joe, where's the growth coming from in the months and quarters ahead? Are we looking at China? I mean, they face a lot of competition from some of the homegrown brands. I'm thinking Anta and others. Is that an opportunity still for them?
I think it is a big opportunity because that was potentially a weakness in the report from last night. China didn't come back as quickly as expected, so there is potentially some upside in that growth to come. And China is also their most profitable region simply because they make a lot of their products there, so it costs them a lot less to get it to consumers. So China is the big growth spot. The other growth is direct to consumer, which they're trying to do more. They're trying to rely less on companies like Foot Locker and JD Sports and sell stuff via their own website, via their own shops like Nike Town that we have here in Oxford Street. Although it gets quite busy down there, I tend to avoid it myself. But I think that the direct-to-consumer business is potentially where they could also see some growth as well as the China space.
All right, Joe Easton there with a take on the profits and the earnings coming through for the Nike, the opportunities maybe in China, and some shopping tips as well if you ever visit Oxford Street. Thank you, Joe. Right, happening right now, Christine Lagarde is speaking at the annual ECB and its Watchers event. She says the European Central Bank will take a, quote, robust approach that allows it to respond to inflation risks as needed, but also aid financial markets if threats emerge. We will continue to monitor for headlines, and you can, of course, watch it on Live Go. It seems she has wrapped up the speech. We'll get more analysis of that, of course, throughout the next few hours. Also happening right now, Francine Lacqua and Bloomberg's editor-in-chief, John Micklethwaite, are giving opening remarks at the Bloomberg Invest Summit in London. And later this hour, we're going to bring you Danny Berger's interview with Man Group CEO Luke Ellis. That is live from the summit. And tonight, we bring you David Rubenstein's interview with Citi CEO Jane Fraser. That's going to be a fascinating conversation, 8 p.m. New York time. This is Bloomberg.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compaq merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
After a week of turmoil, what's the Fed's next move?
The job of reducing inflation is not over.
Are they worried about the signal it would send if they did nothing?
Trust Bloomberg for the fastest coverage and exclusive analysis.
Central banks groping their way through a dark room looking for Schrodinger's cat.
Does this indicate that the Fed is petrified?
Does bank supervision take precedence?
If you want to fight inflation, you better sort out your financial system first.
Bloomberg Surveillance. The Fed decides. Today on Bloomberg, your global business authority.
I think it is too soon to expect that the Fed will throw in the towel, so to speak, on their inflation fighting. I think also not a complete pause may not only be counterproductive from the vantage point of the medium-term inflation objectives, but also could send the signal that they know something worse that the markets are yet to learn.
Carmen Reinhart there speaking, the former chief economist over at the World Bank, speaking with Bloomberg Television yesterday. Now, the Fed is really why we're all here at work today, caught between inflation and a sudden banking crisis. We're going to learn how Fed Chair Jerome Powell and his colleagues respond later today. Let's bring in markets reporter Valerie Teitel for a preview of the Fed decision. Valerie, I know we said between inflation and a banking crisis, but it feels like it's a story of inflation and a hard place. What is the Fed potentially going to do? What are the options here?
Look, Critty, I think it's very likely the Fed the Fed meets up with market pricing today and hikes 25. It has only taken 4 sessions to gone from nearly pricing in a pause to now pricing in 25 basis points. The Fed does not like to surprise, so they're very likely to hit this kind of market pricing. But the bigger question is, what are those dots going to show about the path forward? Will they revise them higher in a bid to try to show some confidence that the banking sector, the banking turmoil is contained? Or will they perhaps keep them where they are and say that the lagged effects of monetary policy are upon us and it warrants a change in direction from here? We have heard some similar things like that from analysts across the street. Let me talk you through a few of them. JP Morgan's Mike Ferroli saying that the slower loan growth coming from these regional banks could shave 0.5 to 1 percentage point off GDP. Mike Wilson saying that the risk of a credit crunch has increased materially. And then Apollo mentioning that the recent financial tightening equates to 150 basis points of a Fed hike. It's going to be all down to the Fed's own assessment of this banking turmoil and its impact on lending conditions that the market's going to hang on to every word.
Valerie, when it comes to the BOE, the signaling prior to today had been that maybe, just maybe, they would pause tomorrow. And then we had another scorching CPI print. What are the expectations around the Bank of England?
A scorching print, Tom. It was the largest beat when it comes to inflation since 2009. 2009, the largest beat. It shocked many of us across the market. And now you have to think about what the UK is facing at the moment. The labor market is still hot. Fiscal policy was eased in the recent budget, and economic activity is still showing strong. This has led the market to price very quickly going moved from a pause to a hike at tomorrow's next meeting. The gilt curve really took a pummeling. Geez, 2-year yields rising almost 20 basis points so far this session. This curve is bear flattening and cable is strengthening along with it. It looks like a hike is on the cards for us tomorrow.
Yeah, the volatility in the global debt market is really historic, I have to say. Bloomberg's Valerie Teitel, we thank you as always. And of course, don't miss our special coverage of the Fed decision. That's starting at 1:30 p.m. New York time, 5:30 p.m. in London. Plus, of course, a slew of great guests throughout the day. Happening right now, though, Francine Lacqua and Bloomberg's editor-in-chief, John Micklethwaite, giving their opening remarks over at the Bloomberg Invest Summit in London. So be sure to tune in there. And shortly, we'll bring you Danny Berger's interview with Man Group CEO Luke Ellis live from the summit. Stick with us. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Seeds, typically between the time you start and they get out in the farmer's fields, is about 8 years. Now we have a pipeline of innovations. We've been funding the CG system for 20 years now. It's funded at about $1 billion a year. If people care at all about adaptation, that thing will be funded at $2 billion a year. I mean, there won't be anything close to the impact of climate-related seeds, climate-related maize, rice, wheat, sorghum, millet. And thank goodness, because of human genetics, we know how to do the editing. Thank goodness, because of AI, we know how to find the alleles. Because of drones, we can measure stuff in the field. So there's huge advance in terms of how the whole seed ecosystem moves at full speed.
Hi, I'm Francine Lacqua. Join me on Leaders with Lacqua as we explore what drives the most influential people on the planet. Leaders with Lacqua on Bloomberg Television, TV Go, and Bloomberg.com.
Our studios in New York and San Francisco, our new hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York alongside Tom McKenzie in London. Let's keep you up to date now with news from around the world. Here's the first word. Xi Jinping used his visit to Moscow to firmly align with Russia against the United States. Still, the Chinese president didn't give Vladimir Putin something else he wanted, a commitment to buy a lot more natural gas. That shows that China may be hesitant about appearing too close to Russia. It was Xi's first trip to Russia since Putin invaded Ukraine. It's a move that's certain to anger North Korea, the U.S., and South Korea, planning to hold their largest ever live fire drills in June. The exercise will involve mobilizing high-tech military equipment. The U.S. and South Korea are winding down training drills this week. North Korea has responded by threatening to turn the Pacific Ocean into a firing range. The CEO of TikTok will tell Congress that China has no authority over the data his app obtains. Shou Chew will also argue that TikTok does more to protect young users than rival social media. That's according to prepared comments reviewed by Bloomberg News. Chew testifies before a House committee Thursday. There are calls for TikTok to be banned in the United States. Tom, a lot to digest on the TikTok front, a lot to digest in these markets. It feels like the news flow certainly isn't stopping when it comes to the financial world.
Yeah, and we have a fantastic event that's taking place here at the Bloomberg headquarters in Europe, in London, of course. Let's cross over now to Danny Berger, our fellow anchor, who's in conversation with Man Group CEO Luke Ellis. She started by asking him, is the crisis over? Listen in.
Just to remind everybody, so it was up 30% yesterday. Yay. But that means that it was, as opposed to being down 90%, it's now down 87%. Right? I mean, 30% when you're down 90% is really nothing.
Is that where the risk is when you say that some banks might not exist? Is that where you're looking toward these more American regional banks? Or is it another Credit Suisse type bank that, at least at one point, was one of the most systematically important?
So it definitely applies to smaller, so whether it's regional banks in the US, it's challenger banks in the UK, it's, you know, in the end, what this has all reminded us is in the modern world where everybody's got a phone in their pocket, and if they want to move all their money from A to B, you can do it while listening to me, and you probably won't even miss anything I say in the time it takes you to move all your money from bank A to bank B. What that means is that at any time of stress, people are going to move their money to one of the banks that they think the government is behind. And that means the deposit base of any of the smaller banks becomes flighty. And the moment you've got, banking doesn't work if you haven't got a stable deposit base, as we've just seen. And they are naturally less stable now.
I think this is a really interesting point because not even just with mobile banking, but technology also allows us to tweet any concern we have about the bank, for VC founders to tweet saying they're advising all their companies to pull out money from a bank. Does this show us what crises will look like from now on, given the technology-enabled nature of them?
So yes, things happen at a much faster speed, whether that's a crisis or it's good news that information travels much faster. And so, yeah, look, we had a run on a bank with no newspaper headlines because it happened before the newspapers had even got there, with no queues around the bank. That's how the modern world works, and it throws certain parts of the banking system into question, and therefore regulation's got to respond to it, and it sort of means the big, highly regulated banks, where they are too big to fail, become the place everybody's going to have an account open that they can move their cash to at the last minute. It means smaller banks are going to have to pay higher returns on deposits, and that then means they're in, they haven't got a critical advantage.
Right. How are you thinking about how that translates to the wider economic environment? Mike Wilson over at Morgan Stanley thinks that there could be a credit event. The latest Bank of America fund manager survey also says that a systematic credit event is now the highest risk over inflation. To you, what is the biggest risk?
So I think there's a causal link in there. So we still have very significant inflation. The UK just showed it's not going down monotonically.
Still double digits?
It's still double digits. That is scary. The US still has an inflation problem, and particularly when you look at wage inflation in the services industry, while that is 6, 7, 8%, you're not going to get back down to 2% inflation. The Fed, it was really sort of easy to forget Powell's presentation to the Senate 2 weeks ago. With everything, what he was saying is we have to push harder, and effectively we have to break something, right, in order to get inflation down in the US. I'm afraid that if they want to get it back to 2%, they have to have more people looking for work than there are jobs available. At the moment, that ratio is the other way around. When you've got that, then yes, you've got the sort of negotiating power is in the employees, and so you get wage inflation. If if you want to get inflation, anyway. So they sort of have to break some stuff. I mean, this bit when people say, yeah, we're going to get rid of inflation without breaking anything, we're not going to increase unemployment, we're not going to, like, something's going to break.
Right.
And, you know, we're seeing part of it is in the banking system where people got into the wrong position. It will, so I think it's a sort of, you start with, if you want to get rid of inflation, then they have to keep rates high enough to cause pain, and that will break things. Something at the boundary will break, and then you have to deal with it.
What do you make of the argument that, and you alluded to this, something has broken, now the Fed can stop, other central banks can stop?
In a difficult way of saying it, not enough has broken. Look, I mean, Credit Suisse is big news because it's a brand name that we all know throughout our career type of thing. Even, you know, but the reality is Credit Suisse has been, I don't know, I'm not sure whether shooting itself in the foot is a polite expression anymore, but, you know, they've been sort of working their way up both legs with a gun for the last 5 or 6 years. You know, I mean, it's a constant thing. And so it was inevitable that, you know, Credit Suisse wasn't going to survive. And it happened that, you know, it's this last squeeze is what did it, with a sort of demonstration of a sort of run on deposits. But, you know, that one is relatively unique. While the problems are in smaller banks, whether it's regional, whether it's local, sort of, it isn't an existential risk to the system. You know, look, if we get to, you know, pick your favorite, but I mean, Bank of America is the one with the biggest unrealized losses in their hold to maturity box. You know, I mean, I don't think there's a problem there. I don't think there will be a problem there. But that's the, you know, if we end up there, then we know we're in a real crisis.
In terms of that, it has been a period we've seen over the last week of assets that are considered risk-free or close to risk-free have been the demise of SVB. AT1s in Switzerland, more risky than perhaps most people had thought, given that they've been zeroed out.
I got to say,
yes,
you know, the one rule of investing in credit is you've got to read the document, right? And it said in the Credit Suisse AT1 documents, I mean, it said what would happen. The Swiss government wasn't pretending. The rules are different in Switzerland than they are in the UK, or they are in France, or they are in the US. The US banks don't use this stuff as much, but the one rule in credit investing, and this is, you know, to that question that sort of might, you know, will a systemic credit event cause the problem? You know, I don't think we've seen the lows in equities for this cycle. Personally, I think we have a big sell-off somewhere in our near future. I mean, I don't mean this week, but I mean, you know, coming. Could it be caused by credit? Will it be caused by earnings first? Don't know. I mean, you have to see how it develops. But people who, you know, if you invest in a bond or you lend money to someone and you don't read the document, you deserve whatever happens to you.
But is it not a symptom of the zero rate environment, that people were taking more risks and paying less attention to them? Are there more shoes to drop?
Yeah, I mean, look, yes, people got used to I mean, for 10 years, there was effectively no credit risk in the world because it's quite hard to go bust as a company when you can borrow money at zero forever, right? I mean, it's like you have to work really quite hard to make a mess of that because money was free. You know, there was no reason to have a diversified portfolio. You know, this is about strategies for wealth creation. For 10 years, diversification was stupid, right? You wanted the most concentrated portfolio you can have. There was no point in risk management. If it went down, you just bought more. And that was the right strategy for the 2010s, all the way up until, you know, we got to 2022. But once inflation is out and in the system, as it now is, I would say it's exactly the wrong strategy. And so in a pivoting from, you know, there's a lot of people still sticking with, yeah, but, you know, I just buy every dip in equities and hopefully it'll work out. But I don't think it will for the next 5-10 years while we have an inflationary period. You know, diversification really helps in that type of thing. Risk management really helps. And, you know, I think you want a completely different portfolio. Obviously you did in 2022, but I would say, you do for the next, I would guess this is the rest of the decade type of thing.
Have you seen that change in what's in demand at Man Group too?
So you know, our client base is institutional.
Okay, Danny Berger in conversation with Man Group CEO Luke Ellis there. You can continue to watch this event at Live Go. I'm Tom McKenzie in London with Kriti Gupta in New York. Anna Edwards and Matt Miller are off today. And Kriti, as we listen into that conversation about the risks in the financial sector, that ties us to the look ahead to the decision from Jay Powell and the Fed.
It really does. And look, you heard it from Luke Ellis there. You got to read the document when it comes to the bond market.
Yeah.
It just probably in the same way you have to read every single word that the Federal Reserve Chair Jerome Powell is going to say today, which brings us, of course, to the spotlight event of today. It's Fed Day, and you are seeing a little bit of caution baked into the markets ahead of Fed Day. And simply what we're going to see at 2 p.m. New York time. Take a look at futures here, only down by 0.1%. No real conviction, no real momentum in either direction. But take a look at bond yields. That's really where I think all the action is. Yields actually lower on the day. How is that possible if the market is pricing in a 25 basis point hike today? At least a 75% chance. Remember, a pause option is still on the table. And then, of course, you have your outliers. A 25 basis point cut from Nomura, perhaps even larger cut or hike from other firms as well. We're looking at a 2-year yield of 4.12. Really keep in mind whether how much of this is really technicals versus dislocations in the market. We're going to get to that throughout the rest of the show. The 10-year yield, 3.58. But, Tom, I think once we get through this little kind of period of Fed focus and banking turmoil, it's going to be all about the commodities market because we are looking at NYMEX crude with a 69 handle down about 0.4%. I also want to quickly
the
hit
commodities market.
Sorry, go ahead.
Carry on, Kriti. I jumped in too early.
No, that's all my fault. I'm just so excited about these pre-market movers. This is really important. I got to talk about Nike here. This is the one. Although I'm told that it's pronounced Nike across the Atlantic. That's a conversation for another time. Nevertheless, down 1.4%. Look, their sales came out pretty good, but their profitability missed. This is a market that is punishing you if those margins are too slim, and that's exactly what you're seeing here in Nike. Although, put this into perspective with some of the other hits we've seen, 1.4% is not that much relative to the volatility we see in these markets. Nevertheless, green on the screen when it comes to some other volatile names. First Republic, for example, higher by just shy of 4%. Again, in the volatility context that we've seen, 20, 30% moves in one day. 4% is nothing. First Republic perhaps getting a little bit more assurance that they are going to be seeing a deal in their near future. GameStop as well actually came out. Tom, get this. First profit in 2 years. Those shares rallying by 43%. You've got your volatility dose there, Tom.
Wow, yeah, I saw a line in the story about GameStop. The fact that they're selling these collectibles has been key to driving and getting into profit for the first time, as you say, in 2 years. Look, it's the banks doing the heavy lifting again across European equities. That relief is continuing to percolate through the banking stocks. Whether that maintains and continues, of course, is going to be crucial. Ties us as well, again, to the Federal Reserve decision. But so far, that index, that sector gaining 1.5%. And on the context, building on the gains of almost 5% for that sector yesterday. So banks at the top, you've got the likes of real estate near the bottom when it comes to the sector-by-sector picture here in Europe. That's the benchmark, gaining 0.2%. The story in the UK is one that inflation is very far from ebbing. A surprise increase, 10.4% year on year, coming in well above the estimates of 9.9%. And that's leading to a readjustment in terms of the views around the Bank of England. They, of course, make their decision tomorrow. A 16 basis point move higher in terms of yields at the front end, 3.44 now for your 2 year. The pound is bid, gaining 0.6%, trading at 122, closing in on 123. Kriti.
Yeah, let's bring it back to the macro, the economics here. We want to bring in Anna Stupnitska, global macroeconomist over at Fidelity International. Anna, a pleasure to have you on the show. Look, a lot of different moving parts here for the Federal Reserve, really kind of stuck between a rock and a hard place. To what extent has the ECB set the tone for the Federal Reserve?
I think they have set the tone, and we do lean towards a 25 basis point hike today because it will be, again, just like in the case of the ECB, an important signal that the central bankers have the confidence in their tools to manage financial stability, and they will try to attempt this tool separation. So I think we will have a similar move from the Fed today, and then a more cautious approach going forward, meeting by meeting. But also crucially, we think that the terminal rate in the dots is probably going to remain the same. It's not going to be revised up, and that's again going to be a hike, but with a more dovish signal for the path ahead.
Well, Anna, if we do indeed see a pause, which I believe a minority on Wall Street are actually looking for, but still some major names, JP Morgan, for example, Goldman Sachs, saying that we might indeed get a pause from the Federal Reserve today. Is that cause for panic, or is that cause for repricing, given that the next meeting perhaps won't see that?
Yeah, I think, well, perhaps both really, because it really depends on how Powell communicates this. I suspect they will try to say we are just in the wait-and-see mode, we want to reassess, but obviously given the hot labor market, given inflation, given the strong economy, they will have to continue hiking, and if anything, that hiking timeline might actually be moved to the next meeting. I think it's going to be even a more difficult decision, a more difficult communication for them to send the right message to markets.
The assessment from some in the markets is that the banking crisis and the changes in loan conditions is going to and has led to a tightening, of course, of financial conditions, some putting it at close to kind of 1.5% equivalent in terms of rate hikes. Does that suggest, Anna, that a lot of the heavy lifting has been done for the Fed? And how do you start to think around positioning for this?
Yeah, we do think actually that there is a lot of tightening in the system. And in fact, when we look at credit conditions in the bank lending channel, we know they have already tightened significantly. And what has happened so far will lead to slower credit growth, if not contraction, a few months down the line. So already a lot of tightening is there. The market stress is doing some work for the Fed. So I do agree it maps to some number of hikes already. And so that means that we should be thinking of positioning for the end of the tightening cycle. We remain very cautious, but we think the end of the tightening cycle is close.
Anna, does that take you into tech stocks? The NASDAQ is up, what, 15, 16% year to date? That's been something of a go-to for investors as they start to price in maybe a pause, maybe a cut.
For the time being, just from a multi-asset perspective, we are cautious, we are risk-off, and we are looking for opportunities, obviously, to re-engage, but we think we're not out of the woods, and so for the time being, we don't take much risk.
Anna, how are you thinking about QE versus QT? One of the calls that's really caught my eye here is Nomura's 25 basis point cut call, in addition to an end of quantitative tightening. If you look at the balance sheet, just from the Federal Reserve's perspective, after they insured those deposits from First Republic, Signature Bank, and the like, the balance sheet has spiked up about $300 billion. Should we be viewing that as quantitative easing to some extent?
Yeah, there's been a lot of discussion on this in the market, and I think it is clear that the expansion in the balance sheet we've seen so far is not equal to QE. It's not equal to QE because it will not lead to credit creation. This is a different mechanism, and so it's unlikely to lead to relaxing the banking standards and more credit. So it's more about liquidity. It's more about that protecting those transmission channels, especially for regional banks. And I do think that the Fed, as they start communicating a more cautious approach and potentially signaling the end of the hiking cycle, they will have to make a decision on QT as well.
Okay, I want to get your views on the Bank of England. That event, of course, coming up tomorrow, and the red-hot inflation print, 10.4%, taking many by surprise. You're seeing that reflected in the pound and in gilts. How much of a challenge does it face, or does it actually lead to clarity for the BO? It's pretty simple. They've got to go 25 basis points. They've got to hold.
Yeah, still I think it's a very difficult decision, and they have obviously laid some ground for coming to the end of the cycle, some ground for being dovish, and I think up until this inflation print, going for a pause would have made more sense. Now it's more difficult, and I do think they'll probably have to hike again, following that the ECB, the Fed template. But I think we can be pretty confident this is going to be last hike for the BOE in this cycle. The backdrop is weaker. The recession is coming earlier in the UK. We have seen some easing in some pay measures. So the labor market is potentially easing a little bit. And so I think they will have to pause after this hike.
Okay, Anna Stupczyńska of Fidelity International, looking ahead to the Fed later today, of course, and then the BOE tomorrow. Thank you. Still happening right now. Danny Berger in conversation with Man Group CEO Luke Ellis at the Bloomberg Invest Summit in London. You can continue to watch this conversation and more from this event at Live Go.
But
this
in
is Bloomberg.
Banking, I mean, there are how many thousand regional banks there are in the US. To have one that's suddenly doing a profile that's completely different than the others, it's more likely to be a problem than it is that they've invented some.
So intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it's very different, and it's not something people have had to operate in for a long time.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit Search Go to find answers now.
The euro area has been hit by an inflation shock, which is now working its way through the economy. While headline inflation is likely to decline steeply this year, driven by falling energy prices and easing supply bottlenecks, underlying inflation dynamics remain strong. And in such an environment, our ultimate goal is clear. We must and we will bring down inflation to our medium-term target in a timely manner.
ECB President Christine Lagarde there speaking earlier in Frankfurt. Of course, it's a big day for central banks around the world. From the comments to Lagarde to, of course, Fed Chair Jerome Powell speaking today. Joining us now for the key takeaways from that speech, Bloomberg's Maria Tadeo in Frankfurt, and, of course, a preview of that Fed Day commentary today as well. Michael McKee in Washington. Mike, I want to start with you there. We're starting to see a very kind of hawkish tone from the ECB, one that I think surprised a lot of the market that they stuck to that 50 basis points. To what extent have they set the tone for the Federal Reserve?
I think they're similar but different. There isn't as much of a banking crisis going on at the moment in Europe, so it's a little bit easier for Christine Lagarde to say that. Of course, the two banks that merged were Swiss, not even in the Eurozone. And the U.S. is still dealing with a lot of small banks, which you really don't have as much of that kind of construction in Europe, that are troubled. And so the question is, if the Fed raises rates, does that put them into more trouble? I think Jay Powell will and his colleagues will decide that it won't, at least not that bad. Things are seem to be getting better. And they do need to send the message that inflation remains job one, the same way that Madame Lagarde did this morning.
Maria, let's bring you in at this point then. It was hawkish. It did sound hawkish from Madame Lagarde, and the thrust seemed to be, look, we have this 2% target, we're going to get there. There was a nod, of course, to financial stability, but it was all about inflation.
Absolutely. And look, one of the key takeaways for me, and we have now heard from the head of the European Central Bank 3 times in a week, and the message has been the same consistently. When you look at Thursday, that was decision day, they went in for 50 basis points. She said no trade-off between price stability and financial stability. Then you have the Credit Suisse deal on the Sunday. She comes in on the Monday morning, again, repeating there is absolutely no trade-off. Today, she hammers down for the 3rd time that same message. This is a single mandate central bank that has to bring down inflation to target closer to 2%. This is the entire credibility of the European Central Bank in repeating this message that it won't be derailed from that. So to me, that is the first takeaway. The second takeaway is that, of course, there had been a lot of chit-chat about the forward guidance. Remember, for a while, we had very explicit forward guidance where it was almost very easy to calibrate the size of the hike going into a meeting. And the question was always, what happens in the next meeting? I think to some extent, we now have to make a difference between forward guidance and very explicit forward guidance. That very explicit, where you can measure in basis points already what happens down the line, that has been muted. But nonetheless, when you look at the forward guidance, that message today coming in general terms over the sense of direction was still clear. There is room to cover. They now have a 3-point criteria. You look at the data, you look at core inflation, you look at the strength of the transmission, and therefore you act accordingly. But the path is still one in which the European Central Bank is clear. They need to take action to bring down inflation.
So, Maria, before you started covering the ECB and geopolitics for Bloomberg TV, you were a credit reporter. Put on your credit hat for a second and talk to us about the volatility you're seeing in the bond markets around the world. How is that factoring into the ECB right now?
Well, a credit reporter, government reporter, I did many things before I joined TV, but it's a little bit of a blur, I must say now, just how life moves fast when you do TV. But overall, I think when you look at credit, the big story here, obviously, is the wipe out of the AT1s that happened on the Credit Suisse deal and the repercussions that that could have then on the European translation for it. And in that front, the European Central Bank has also been clear, very elegantly, but though a subtle dig at times too at the Swiss regulators and the Swiss government and maybe even UBS, that they do not set the precedent for European legislation, that there is a very clear statutory order in terms of who takes the losses and who should absorb the losses, and that is a reassuring message, or a message that they hope will be reassuring for European banks. And what happened in Switzerland, this is a case that relates only to Switzerland. The European jurisdiction is run separately, and it has nothing to do with that.
Yeah, so far that reassurance, at least across the bond equity market, seems to be working, at least to some degree. Mike, let's bring you in then on that point. Maria saying that, look, they've essentially dropped the forward guidance at the ECB. What kind of guidance are we expecting from Jay Powell? Is there going to be a revision around the dot plots?
There's probably going to be a revision around the dot plots, but there's great confusion about what the dot plots are. There are 18 now, normally 19, but Lael Brainerd is off right now. 18 members of the Open Market Committee. Each one submits their own forecast for inflation, unemployment, and growth, and they also suggest what they think the appropriate monetary policy setting is to get to those forecasts. So you have 18 different ones that are then melded together, and we pick one in the middle, call it the consensus, and the market decides, well, that's what the Fed's guidance is. It's not really. The Fed's guidance is 18 different people with 18 different views. That's the hard part for the market to get. So yes, we'll probably see a change today, but does it mean anything in the long run? I would think not. The Fed is going to be very, very data dependent, more than usual, because they're watching what's going on with the banks, but they're also close to the end of their tightening cycle, even if they think they need to do more. And so they don't want to go too far and send the economy into recession. So you might see a tick up in December. The last time they made a forecast, they said they'd get to about 5.1% on an effective basis. This time we might go up another 25 basis points to 5.35 or something like that. I think we won't go much beyond that. And the hard part for the market to understand is what this really means for Fed policy going forward. Not a lot of guidance.
Not a lot of guidance from the Fed or the ECB. Mike, thank you, as ever. Michael McKee, of course, in Washington, Maria Tadeo in Frankfurt. Stay with Bloomberg for our coverage, of course, of the Fed decision and news conference. Coverage starts at 1:30 p.m. New York time. This is Bloomberg.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. You know, lots of testing, lots of thinking about what could go wrong, lots of research. You know, when I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of like a motif theory, put all these things together. I feel like I do that in my due diligence.
This is Bloomberg's Surveillance Early Edition. I'm Tom McKenzie in London with Kriti Gupta in New York. Now, a look at what's ahead today. Throughout this morning, of course, we will continue to hear from a number of ECB speakers from the ECB and its Watchers Conference. That's happening in Frankfurt. EU leaders are also meeting in Brussels. On the agenda is Ukraine, energy and competitiveness, with the US Inflation Reduction Act in focus. At 7 a.m. Eastern Time, UK Prime Minister Rishi Sunak answers questions from opposition leader Starmer in the House of Commons. That's after hotter than expected inflation data this morning. And of course, it is Fed Day. We get that early, eagerly anticipated decision. That's 2 p.m. Eastern Time. That is it for Early Edition. Markets here in Europe are up, equities gaining. Surveillance is up next. This is Bloomberg.
talk to us maybe about like how important data targeting or targeting of an audience actually is? Because I think we hear these things like, oh, it makes it harder for advertisers if they're not able to track your data. Why is that so important? And like, can you maybe give us some numbers around how valuable a targeted ad is versus an untargeted one? I don't even know if untargeted ads exist on the internet.
Oh, yeah. Well, and just on to sort of add on to Tracy's question, like, let's say I go to golf.com.
Yeah.
Okay. The ads that I get, like, how much is it? Oh, he's on golf.com. He probably wants to read about golf, as opposed to ads that I get that maybe, you know, the last 10 sites I went to is like pets.com or something like that.
Yeah.
And so how valuable is it for golf.com to be able to know that I also like pets?
I mean, there's all sorts of open and maybe unsolved questions about the value and precision of online advertising. The classic example is like you go and you buy a pair of sneakers and then all you see are ads for the same exact sneakers, like just following you around the internet, right? It's like, I just bought these. Why do you, like the world's biggest tech companies that so supposedly know a lot about you, like can't solve that
You
problem.
bought one pair of sneakers.
Yeah,
you must
you
want
might want
more.
another one, right?
Well, I do, but I definitely don't need a second stone.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question. Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
We believe that the U.S. economy was going to stall even before these banking events happened.
Our base case, both in Europe and in the U.S., is that we're not done yet on the hiking cycles.
The Fed will be thinking about how much credit tightening is going to be happening as a result of the problems at the banks.
You really have to pay attention to the Fed on the third guardrail, which is bank supervision.
If the Fed were to pause, we don't think that the suggestion there is that there is a crisis of ruin.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It is decision time for Chairman Powell, live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. Equity futures right now on the S&P down about 0.1% on the S&P 500. Lisa, this S&P 500 back to where it was before the banking mess. We've done a full round trip.
Everything's been a full round trip. So yay. In other words, did anything actually happen, right? Yesterday was the first time you had 2 consecutive days of decent trading since the first Silicon Valley Bank collapse and all of the drama there. So there's a feeling, okay, stability. Does that mean all things go for the Fed and they can ignore all of the round trips that we got in the meantime?
So 4 things: decision, statement, forecast, presser. What are you focused on right now?
I'm honestly, it's going to be the press conference, even though he's had a real record of perhaps not necessarily sticking to a script that has any relevance 5 days later. But I think that it will be interesting to hear kind of what he indicates going forward.
Okay, you tell us what you really think about Chairman Powell and news conferences.
Do you disagree?
Julian Emmanuel can't keep himself together. We're going to get to Julian in a minute.
But do you disagree?
Do I disagree about Chairman Powell? If he goes off script, he struggles.
Okay, so what's he going to do?
And I don't think today is a day to go off script.
So is it just going to be reading a statement?
President Lagarde did. Let's see.
Okay.
Let's see. I mean, I can't predict what he's going to do in this news conference, but sure, yeah, there's been time after time where he struggles in the news conference when he goes off script.
So do you think that it will give people comfort if he just takes a sheet of paper and he's like, wait, hold on a second, and like pulls out a piece of paper? I'm serious. Like,
ultimately, it depends what the message is on that sheet of paper. Did you see what we got from Lagarde today?
Yes.
Pretty punchy stuff. There's no trade-off between price and financial stability. We will not entertain trade-offs on our primary objective,
which is inflation. And basically saying we have all the tools we need to fight any kind of financial instability, so we're going to be focused on inflation. Inflation keeps surprising to the upside. And this is where really, I mean, you look at UK this morning coming out with another hot print. This is the conundrum, and it's not that different for Jay Powell.
Well, they dealt with their own financial stability issues back in September, October time, and look at them now. We're talking about another hike tomorrow off the back of elevated inflation. What do we get? Double-digit CPI again.
Yep.
In the UK. That's brutal stuff. Let's give you a taste of flavour of the price action just right now. Equity futures are down by about 0.1%. There's no real drama here. Onto the bond market, yields are lower by 4 basis points, 4.1% on a 2-year. I've said this a few times in the last 24 hours. Worth saying again, the 2-year yield is exactly where it was at the close on the day the Fed last met. Just get your head around that, because it certainly has not felt that way. We've been all over the place. On a 10-year, yields in 3 or 4 basis points. Lisa, your 10-year 357.33.
Let's take a look at some of the round trips that we've gotten on that 2-year yield. I really enjoy looking at it. It looks like a terrible roller coaster. I keep thinking that this is really what a lot of people are watching with today's 2 p.m. Fed rate decision. That is really the main event. And then that 2:30 p.m. press conference. I was really rude, John. You asked me what I was looking for in the 4 segments of this afternoon. What are you looking for?
Aside from the news conference, the projections, obviously, the projections aren't about whether their forecasts are right. It's about what they choose to signal in the SCP. And I'd be very interested to see what they choose to signal. Do they choose to signal high for longer? Or have they made a conclusion, drawn a conclusion about what the last 2 weeks means for the outlook? I don't know the answer to that yet. The last time around, the median dot for 23 was 5.1%. Let's see if that changes in these projections later on this afternoon.
Or maybe they'll scrap them all together, which would be also a signal.
It's an option, but can you imagine how much that would scare people if they just came out and said, yeah, this is this bad, we've got no idea, we're getting rid of them. They did that in the pandemic, but it was obvious in the pandemic what the direction of policy was. Throw it all away. We're going to cut. It's low forever. That was pretty obvious for us all.
It's a little disingenuous, though, to give a projection that you know is going to be wrong because nobody can predict anything. I'm just saying, theoretically.
They do that every single meeting.
Okay, fair enough. Let's move on. All right, 2:30 p.m. We also get Treasury Secretary Janet Yellen testifying to the Senate Financial Services panel. We've been hearing a lot from her. She seems to have garnered a bit more stability in some of the regional bank stocks. Today, we're seeing an ongoing rally in First Republic Bank. Those shares up 3.4%. Although we're talking about this rally, and when you actually take a look at the stocks, they're so far off the highs that we still have a long way to claw back the same kind of feeling of stability that we had earlier. And at 5:45 p.m., Jane Fraser, Citigroup CEO, is going to be speaking at the Economic Club of Washington, D.C. That's followed by an event for peer-to-peer with David Rubenstein. I want to hear what she has to say about their role in supporting regional banks, about their role in terms of what they're doing with their deposits. How does that sort of create a conundrum wrapped in an enigma for them?
Oh, right, okay. Do you think that's the language she'll use a little bit later?
Absolutely.
Doubt it. Julian Emanuel joins us now, Chief Equity and Quantitative Strategist over at Evercore ISI. Julian, good morning to you, sir.
Good morning.
Great to have you with us around the table. Luke Ellis and Man Group, a man that you know, came out this morning and told our colleagues in London, we have not seen the lows in equities this cycle. Do you agree with him?
I do.
Why?
History tells you that, and again, this is dependent on your view of whether there is or isn't going to be a recession. I think it's pretty easy to make the argument that the events of the last couple of weeks have increased the probability of recession. I think at a minimum has taken this idea of the no landing scenario off the table. Thankfully, I was tired of that talk anyway. But there has never been a bear market that's bottomed before the recession has started. There have been recessions without bear markets, but never a bottom before the recession started.
This assumes we're past the point of no return and we are heading towards a recession. Is there a solution out there to the banking problems that could mean in another 2 weeks we're talking about exactly the same kind of things we were talking about just 2 weeks ago? No landing, a cycle that continues, the Fed that has to do more. Is there a solution out there for you?
I don't think that there is, because I think the change in psychology, the fact that 2 weeks ago, again, we were doubting whether the laws of finance had been repealed, i.e., was all this tightening in the pipeline seemingly having no effect whatsoever. And now here we are. That's sort of a Rubicon that you really cannot undo without a degree of further development of the issues, which, you know, again, as forceful as the policy response has been, and we applaud that for sure, there is likely to be more of the onion to be unpeeled.
What's worse for risk assets? A 25 basis point rate hike by the Federal Reserve or no rate hike?
So we don't believe that the no rate hike scenario implies the Fed knows something that we don't. I think to think that is probably just misguided, given the fact that Chair Powell teased the potential for 50 basis points 2 days before one of the biggest runs on the bank in all time. I think that's risk management. That's an acknowledgement of data dependency. Frankly, 25 or pause doesn't really mean that much either way. It's what he says that means.
Well, and a lot of people would agree with you, but I want to stick on that risk management idea. There is a question of whether it's risk management for the banks or whether it's risk management for inflation, which is still a problem. And this is something that Andrew Hollenhorst over at Citi keeps raising an issue with, saying people have the wrong comparison. Inflation is the big boogeyman. It is not some sort of financial stability crisis. Do you agree?
We are actually much more optimistic on the path of inflation. Now, to be fair, Ed Hyman's forecast that you're going to have a recession in the second half of this year and bleeding into early next is part of the reason we're more optimistic about inflation. But a lot of our proprietary surveys, rents are actually starting to turn down, whereas, owner's equivalent rent is still on the flagpole. We think that's a data mismatch. Wages are starting to actually cool. We think you can get to somewhere in a 2 handle by next year.
Is that including the tightening of lending standards you're expecting off the back of these financial stability issues?
It has to.
Yeah.
It absolutely has to. And from that perspective, again, we would like to see the Fed step back and acknowledge that there's been an extraordinary amount of tightening in the system. And oh, by the way, if you think about it, if you're charitable in postulating that policy works on a 6 to 9 month lag, as we've seen several Fed governors suggest in recent weeks, you've still got a ton of tightening that's about to hit over the next 6 months.
The problem that I've had, I think, in the last couple of weeks, just in terms of the way this has been discussed, it's been framed as some kind of binary choice today. Focus on financial stability or focus on price stability. I hear a lot of comparisons to the UK, that the UK was able to handle one thing and focus on the other thing all at the same time. Kind of ignores what the underlying policy risk actually is, the underlying policy issue. All financial stability problems are not created equally. In the UK, back in September, October time, the underlying policy risk came from the fiscal authorities, the government, and it was inflationary. It wasn't disinflationary, it was inflationary, which almost complemented the policy effort on the monetary policy side of things. Keep hiking. The issues we have now in the United States in the banking system are arguably disinflationary because they're going to lead to tighter financial conditions. So are we really seeing a policy conflict for Chairman Powell and this committee today?
Well, that again is the intellectual problem we have in getting our hands around this in the entirety, is that you really shouldn't separate the two. And frankly, part of the challenge, again, goes back to the idea of the second part of the dual mandate, which we've all conveniently set aside, full employment, and recognizing the fact that instability in terms of financial conditions is going to cause that unemployment rate to rise. It's inevitable.
Just really conscious, Lisa, of how quickly this has moved in 2 weeks. 2 weeks ago, Chairman Powell's wrapping up day 2 of his semi-annual testimony, the 2-year yield's peaking north of 5%, and we're having a conversation about today, which is March 22nd, 25 or 50. Now it's 25 or 0, and 0 may be even done. Cycle finished.
Right, exactly. That's something that we heard from Tiffany Wilding over at PIMCO. The question isn't to hike or not to hike 25 basis points. The question is this the end of the rate hiking cycle? And when do they start talking about cuts? I think you raised a really important point, though, the distinction between financial stability issues here versus what was experienced in the United Kingdom. And here's the issue. How do they signal that it's not a crisis, but that it's a material addition to what they've already done, that basically it's an acceleration of the policy that they've already implemented in a way where they don't need to do that much more? It's a distinction, but this market doesn't do nuance well. And so how do they do that well?
Does the Fed know something we don't know?
Well, if they
I
did.
mean, to Julian's point, I get it, I'm on the same page with you. If they really knew something, what was he doing 2 days before a bank blew up?
Correct.
Teeing up 50. But it doesn't matter what I think. It's about how the market behaves and how it will respond to it later. And there is a belief out there with a lot of people that the more dovish they are today, the worse they believe the situation is.
There's a belief that crowds are collective wisdom, and the collective wisdom has been a little bit, I don't know, having issues recently.
It's changed about 5 times.
Yeah. It's like,
I keep saying this. We've not got through Q1 yet. Equities right now on the S&P down 1/10%. Julian's going to stick with us. We're going to catch up with Stuart Kaiser a little bit later this morning.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The Federal Reserve is caught between inflation and a sudden banking crisis. We'll learn how Fed Chair Jerome Powell and his colleagues respond later today. Most economists expect the Fed to increase interest rates by a quarter point, but some say policymakers should hold off to shore up financial stability. The decision comes out at 2 p.m. New York time. Inflation in the UK rose unexpectedly for the first time in 4 months. The Consumer Price Index rose 10.4% from a year earlier. That followed a 10.1% jump in January. Food and drink prices were among the culprits, rising at the fastest pace in 45 years. Now, all that may boost arguments that the Bank of England should raise interest rates as soon as tomorrow. Xi Jinping used his visit to Moscow to firmly align with Russia against the U.S. Still, the Chinese president didn't give Vladimir Putin something else he wanted, a commitment to buy a lot more natural gas. That showed China may be hesitant about appearing too close to Russia. It was Xi's first trip to Russia since Putin invaded Ukraine. It's a move that is certain to anger North Korea. The U.S. and South Korea plan to hold their largest ever live fire drills in June. The exercise will involve mobilizing high-tech military equipment. The two allies are winding down training drills this week. North Korea has responded by threatening to turn the Pacific Ocean into a firing range. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
He
story.
is there, the kind of upside.
After a week of turmoil, what's the Fed's next move?
The job of reducing inflation is not over.
Are they worried about the signal it would send if they did nothing?
Trust Bloomberg for the fastest coverage and exclusive analysis.
Central banks groping their way through a dark room looking for Schrodinger's cat.
Does this indicate that the Fed is petrified?
Does bank supervision take precedence?
If you want to fight inflation, you better sort out your financial system first.
Bloomberg Surveillance. The Fed decides. Today on Bloomberg, your global business authority.
I have made clear that there is no trade-off between price stability and financial stability. We have plenty of tools to provide liquidity support to the financial support if needed, and to preserve the smooth transmission of our monetary policy.
Pretty hawkish stuff there from President Lagarde of the ECB, following on from her news conference last week. Euro-dollar very close to 108 this morning. Good morning to you all and welcome to the programme. Euro-dollar looks like this at 107.89, positive 0.2%. Equity futures down about 0.1%, going into Chairman Powell's news conference a little bit later, and Fed decision, a statement, the forecast. In the statement, in the early part of the statement, there is this phrase, ongoing increases. Lisa, I wonder if that gets dropped today.
No forward guidance. If they say it, and this time it means there potentially are no more rate hikes. I mean, basically, everything will be parsed and then interpreted through a lens that people want to interpret it through. So I guess that it's sort of what does the market want to see, and that's what we'll find out later.
By the time we get through the news conference, I wonder if we've even remembered what they did in the statement and the ultimate decision.
That, I think, is a very good comment, because I don't know how relevant the 25 basis point rate hike or not really is at this point. It is really the ongoing guide. Are we seeing the end of the rate hiking cycle? And if they indicate that we have, that could be potentially more supportive or more, dovish than even not hiking 25 basis points.
A couple of banks we've got to talk about. First Republic is one. It's up in the pre-market by, let's call it 2.7%. I think I'd rather say 40 cents at this point, because once you get down to these kind of levels,
thank you,
Lisa, it's not really worth reading the percentage point change day to day, because they're just monster moves.
Yeah, and everything's a monster move off of a pretty low base, especially how much you've already seen the fall. The question here is, what's the path forward? This morning, Dow Jones is reporting that First Republic has hired Lazard to potentially review strategic options, potentially using a capital infusion, a sale, asset trimming, et cetera, et cetera. This, according to people who spoke with the Dow Jones. How much do we see this being supportive of some sort of future recovery, or how much is this basically? I mean, how often do you see a company come out and say, we're examining our strategic options, and then be like, all right, we're all good?
Yeah, when you're examining your strategic options, it's because you don't have many, and it's a problem.
Yes, thank you.
That's often the case. UBS is examining its strategic options with Credit Suisse through most of the weekend. UBS right now is down about 0.4%. Monday it was higher. Tuesday it was up by 12%. Let's get over to Zurich and catch up with Marion Hofdemer. She joins us now. Marion, what's the latest on this integration between UBS and Credit Suisse?
So there are still pieces coming out of this, but the latest we saw this morning is you had an announcement with UBS buying back their bonds, actually. And the sense that we're getting here is actually it's a decision made in the context of the credit spreads widening for that bank after their purchase of Credit Suisse. So we're seeing a little bit of the risk associated with Credit Suisse prior to the merger panning out and infiltrating UBS. So it sort of makes sense to give an opportunity to the holders of that debt, of UBS's debt, to reevaluate whether or not they want to hold that debt post this merger.
One of the biggest implications of this entire affair, Marianne, has been the implications for the contingent capital bonds that really have underpinned a certain sense of stability in the European banking system since the financial crisis. Have we reached some sort of stability there in terms of European regulators pushing back against Swiss regulators and saying, no. Equity has to get wiped out first, and then cocoa gets hit?
Yeah, that's been a huge source of questions this week and sort of instability in that market. I think there's a little bit of a debate as to whether or not this was how things were supposed to go. But from FINMA's point of view and from the regulators in Switzerland's point of view, they always had this sort of option. And so it's up to them whether to trigger this AT1 and in the way that they want to trigger it. And that's sort of where we're landing at right now. But I think there's certainly some parties in there who are holders of these AT1 bonds and holders of other AT1 bonds who are asking bigger questions and wondering whether there's a legal case to be had here.
It's going to take a while, Lisa, to see this play out. What are we, day 3?
It'll all change tomorrow.
Day 3.
There has to be an extra risk premia, though, baked into some of these bonds, given the uncertainty in some of these clauses and the fact that they could get wiped out before even some equity holders.
UBS down about 0.5%. Marion, great to catch up. Fantastic work over the last weekend as well. Marion Hofdemer there out of Zurich. Julian Emmanuel alongside us today from Evercore. Julian, great to have you with us. This came from Goldman Sachs and Sharon Bell this morning. They said valuation for banks in absolute terms in Europe never been cheaper outside the GFC and European sovereign crisis. Some people might say for good reason. Other people might say this is a buying opportunity. What would you say?
We actually lean towards it being a buying opportunity. Look, again, going back to a global tightening cycle, the likes of which we haven't seen in 40 plus years, to think that there would be things that, that you wouldn't have things break was naive, okay? However, the bigger picture, and this is one of these times where you have to parse between the long run being a series of very volatile short runs, as it frequently has been, not just the last year, but the last 3+ years. The fact is that having purged the concept of negative interest rates from the psychology of European investors, I think actually lays the groundwork for a better future for European financials.
On a broader level, though, there is a question of what this "it's not a bailout" kind of behavior is longer term for the profitability of these banks, what the utility of them is, and whether they are treated as such and less as profit engines. How do you bake that into your assumptions, given the likelihood of more regulation and potentially fees for deposit insurance?
Well, again, that is a difficult concept, and it's something that took a lot of people a number of years coming out of the financial crisis to really wrap their arms around. And frankly, when you think about the concept of deposit insurance for all, it really does hearken the idea of a more utility-like return for the group. And actually, frankly, and I don't think this has been discussed, the concept of deposit insurance for all is actually a reasonably inflationary concept in the final analysis.
Explain.
You're going to have to create money if you're going to have to plug holes where there's money and liquidity issues.
Regulators have argued that the banks are going to ultimately bear the cost of this, not the taxpayer. You looked skeptical. There is this question of whether this does impede profitability on a broader level, because if there is any distress whatsoever, the banks will be on the hook to deal with that. How do you bake that into valuations? Does that basically mean that U.S. banks are less valuable long-term to you than even European banks?
Well, I think it's certainly a shift between the two, okay? You saw valuations in U.S. financials just, orders of magnitude above those of European counterparts. That's converging. It's not going to converge totally. There are lots and lots of systemic issues, one of which being the fact that inflation in Europe is a much more intractable issue, not permanently, but certainly now, than it is in the U.S. Because of structural rigidities. And all of that really leads in. But again, going back to this idea of the end of negative interest rates, that's a reason to think that valuations will level off probably a little bit more in favor of European banks.
Well, time horizon matters here. You've got an end of cycle call. Do I want to own banks up against the end of the cycle?
Well, we're equal weight in banks now, and frankly, it's one of those times where, we've been proponents of the value trade for a very long time.
Yeah.
When we started getting conviction, behind Ed's call for a recession late last year, we came off the overweight there, thankfully. It's probably a bit early, but I would suggest that, again, you've seen several shoes drop. There are probably going to be several more shoes drop. And the next bout of price weakness will probably be a time to dip one's toe back into the sector.
Hey, Julian, this was great. It always is. Thank you. I think the conclusion for so many people, Lisa, if we get all deposits insured, it's you paying the insurance premium at home. I mean, you'll be paying a monthly fee on your bank account without a doubt that's going to be paying for this.
Right. And the banks are saying it's actually us, and we're saying, yeah, right, we're going to be the ones that end up paying for it. I mean, Julian just started laughing. He's like,
everyone feels the same about this.
I would agree, because honestly, if it's not profitable for the banks, why do they want to hold your money?
You're going to pay what? $15 a month? I don't know. Take your pick.
Put it on the Netflix bill.
But to the extent that banking is free, won't be any more after that. And
is it really free?
It's not free.
I mean, you don't even know
it's not free. Have you heard about how the bank works? The duration mismatch.
I know.
They borrow
it's
short,
potentially
they lend long.
dangerous. It's
risky.
risky.
It's terrible.
Oof.
Found out last week.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compaq merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
2 days of gains on the S&P 500. If we had another 2 days, we'd be talking about 50 basis point hikes again.
You're not wrong.
You know how quickly things change, don't you? Futures right now on the S&P, negative about 0.1%. On the Nasdaq, we're down 0.2%. Chairman Powell doesn't have 2 more days. He's going to make that call a little bit later, together with his committee. That decision comes at 2 p.m. Eastern time. In the bond market, we look like this: 2s, 10s, 30s, shaping up as follows. Your 2-year, 4.1552. This 2-year has been on one heck of a trip since the Fed last met. The low was 362. That was just a few days ago on a US 2-year. The high was 5.08%, and that was just a few weeks ago on a US 2-year. I had a guest yesterday that said the 2 years been trading like a meme stock. I think it's been trading like a penny stock too. It's been remarkable what this has done over 2 weeks, Lisa.
You've been saying that. I just wonder what the implications are. We're talking about one of the benchmark rates. When it starts whipping around by a percentage point, depending on the day you look at it, what are the broader consequences of that? I mean, how do you then lend with any kind of certainty if you can't make a projection out of 2 days of bank stock returns and what that means for Fed policy?
Last year, the problem was if you couldn't price the risk-free rate, how do you price risk? And we thought we'd come into 2023 and that story would resolve itself. And here we are. Look at us over the last 2 weeks, struggling to keep up with this.
Well, but the irony is people say, you know what, it's short-term noise. Longer term, there's much more stability in rates. And there's much more stability in our understanding of them. But if you start to look at credit markets, they are starting to whip around in tandem with some of the volatility. So you raise a really good point. The long-lasting lags of that, is that the credit tightening that we're going to be talking about?
This market was screaming the Fed is done. I have to say this market was screaming the BOE's done a few times based on the guidance we had from the governor of the Bank of England. Let's take a look at FX, euro, dollar, and sterling. Sterling 122.86, positive 0.5%. UK inflation coming in at double digits year over year, 10.4%. We were looking for a 9 handle, 9.9%, something like that, Lisa. So big upside surprise going into the BOE tomorrow. Outside of that, euro dollar 107.83. If you missed the comments from President Lagarde, these were really punchy a little bit earlier. No trade-off between price and financial stability. We will not entertain any trade-offs on our primary objective. She couldn't have been clearer, could she?
Especially because she basically said that the ECB had plenty of tools to address financial stability. That's not a concern. But that there is evidence of underlying inflation that is having an issue, right? That's stickier. And she's talking about that. This is a problem for them. This is the preeminent problem. Is it the same for the Fed, though? And that, I think, is what a lot of people are wondering.
Well, the ECB is further behind.
Right.
So that's a big difference. I was told the inflation story was different in the US, though. And that meant the Federal Reserve had to stay at it because things were so much tighter in the labor market and there was this wage pressure and all of that good stuff.
What do you do when the collective wisdom of crowds isn't that wise? What do you do when there's no more clarity?
Second time you've said that in the last 30 minutes.
I've been thinking about this. You can't get a signal from this market because nobody knows anything.
That's a very sophisticated way of saying that the people that make market pricing aren't wise.
No, I'm just saying they don't have any additional wisdom on a scenario that is highly opaque. It's driven on narrative. You could also argue
You're offending a lot of people. They're waking up this morning, they're getting ready for Fed Day, and they're just getting smacked around the face by you.
No, I'm
saying
offending.
They're just not wise.
I'm offending a whole lot of algorithms and short stopping
Good
out.
comeback. That was smart. All right.
Mm.
Fed decision a little bit later. Split. Nomura says cut. Other people say hike. Other people say pause. I mean, you could take your pick. Sarah House says this. In the pause camp, as we assume financial markets stabilize in the coming weeks, then we look for the committee to hike rates by 25 points at its May 3rd meeting and by another 25 basis points on June 14th. So, a pause today, but perhaps we resume hiking in future meetings. Now, I don't think this is this crazy. It's not that crazy, Lisa. It's, you know, I joked if we had 2 more days and 2 more days of gains on the S&P, we'd be talking about 50 again.
So just to build on that, I want to amend what I said earlier. I wasn't insulting all the traders. What I was saying was, how do you have wisdom when the facts change day to day? And I think that that's what Sarah House's comments speak to, which is there is a great uncertainty about the path forward just simply because the facts are changing and what matters is changing.
Sarah House joins us now, senior economist at Wells Fargo. If, as we assume, markets stabilize in the coming weeks, Sarah, you think even after a pause today, they might resume tightening? Now, the pushback, Sarah, and you know what it will be. If they pause today, how do they stop us from pricing in even more cuts? Never mind more hikes.
Yeah, so I think they can do that a couple ways. So one is in the statement, so noting that if, as financial conditions perhaps ease after the recent volatility, that they expect ongoing increases are still on the table. So keeping that ongoing increases language, even with a pause today. And then I think love them or hate them, the dots are an important tool. So I think you have to remember that the dots signal the most likely outcome of policy. And so I think we could see those shift higher. And I think that would indicate that even with a pause today, that the Fed is not done tightening yet, that there is still more work to do on inflation, and the Fed still remains very much committed to that.
Sarah, there are a lot of people who are looking at what the Fed decides today and saying we actually don't care unless they make a serious policy error. Inflation is going to guide the course, as is banking distress. I was interested in what Andrew Hollenhorst over at Citi said because he's had a lot of conviction. Recently, he said relative to 2008 or any time in the last 40 years of history considered here, inflation is more of a constraint on Fed policy. Do you agree?
Yeah, I think that's been a guiding principle for them over the past year and what's set off this aggressive tightening cycle. And so I still think it's a constraint, but I think you can't have price stability on a sustained basis without financial stability. And so I think that's what perhaps warrants still taking a little bit of a breath at today's meeting, but then continuing on with tighter policy as the dust settles and remaining focused on that price stability side of the mandate, because there is still certainly major inflation challenges that we're seeing here in the U.S.
So do you think that, just putting aside the financial distress for 1 minute, which seems to have stabilized over the last 2 seconds, I am curious, going forward, whether the inflationary outlook in the U.S. is different than what we've seen in the European sector?
Well, I think the Fed is further along in their tightening cycle, and so I think that does help in terms of, while there's a lagged effect, there is still an effect from tighter monetary policy. I think the labor market remains probably the biggest challenge to getting inflation down to 2% on a sustained basis. So we had a little bit hint of improvement on the wage front in the last employment report, but that it's a pretty volatile series. So you're still looking at employment costs running over 4% annualized. The production non-supervisory side of those wage numbers in the last employment report showed closer to a 5% annualized pace on the wage front. And so I think there's still a lot to be done on that aspect. And you're still looking at a very tight labor market. And so I think that remains a huge challenge to the inflation outlook as we look out over the course of this year and even on into 2024.
Sarah, Chairman Powell has this phrase, the whole committee does, the totality of the data. When they talk about the totality of the data, does that take on a new meaning given the last 2 weeks? Does that include bank stocks?
I don't think it includes bank stocks per se, but I think it does include the overall tightening in financial conditions that we've seen, and it has been extraordinarily rapid over the past 2 weeks. And so I think that, considering that that's the channel that Fed policy works through, I think they do have to take that into consideration. So yes, inflation is too high, but they're well aware that it does tend to lag broader economic activity. And so I think they're taking in those financial conditions in addition to the very strong labor market data that we've seen, the still high level of inflation that we're seeing, as well as what's been pretty resilient consumer spending over the past few months.
The other phrase they've used as well is sufficiently restrictive. We've heard that since December. Are we getting closer to that point? Matt Lazzetti at Deutsche Bank suggested the difficulties of the past 2 weeks or so push us closer towards being sufficiently restrictive. Do you agree with that?
I think so. I think we're getting closer to where policy will ultimately settle. So I think we're looking at, certainly a higher terminal rate relative to what was being guided at coming out of the February 1st meeting, just given that ongoing momentum in the data. But I think the recent tightening in financial conditions and the stress that we're seeing in the financial system perhaps knock that down a little bit and make it seem like the terminal rate maybe doesn't have to be raised quite as high as what we were looking at only 6 weeks ago. So I think the recent events do get us a little bit closer to what will ultimately be that sufficiently restrictive stance of policy.
Sarah, I want to build on that for just a minute, because it seems like you're not alone with that. That basically the events over the past couple of weeks signify that perhaps this economy isn't quite as resilient as people previously thought, and that the strains are more significant. And therefore, the end inflation rate will be lower, and so will the terminal rate. Do you agree on the inflation rate point, that inflation will come down to perhaps a lower place than people imagined a couple of months ago?
I don't necessarily think that it'll come down lower to where we ultimately land. I think we're maybe seeing just the channels of which inflation will come down, and through that tighter financial conditions, I think perhaps it's happening a little bit more quickly than what we were thinking about 3 weeks ago, as it seemed like the economy just couldn't be slowed down. But I think now we're seeing more material tightening in those financial conditions, which is going to pass on through credit growth in the economy and contribute to that slowdown.
Hey, Sarah, wonderful to hear from you. Sarah House of Wells Fargo, looking for a pause from the Federal Reserve a little bit later, together with Goldman Sachs and a few others as well. Looking for a pause, but ultimately, Jan Hatzius and the team at Goldman acknowledge the same thing, really, Lisa, that even if they pause today, who's to say they've got to be committed to the end of the cycle? Why is it the end of the hiking cycle if they pause today after the difficulties of the past 2 weeks?
It matters less whether they're committing to it or whether perhaps the market implies that going forward. We saw home builder activity and just the housing starts in terms of the number of homes sold yesterday in that data actually come in much higher than expected. The sort of revival of a housing market left for dead because suddenly mortgage rates are lower. The unintended consequence of a sudden easing in financial conditions before the job is done. And I don't mean easing of all financial conditions,
sure,
right? Because we have seen a tightening. But with respect to the lending rate, does that reignite certain sectors that have been most affected by the policy?
You know, we talked about the totality of the data. You have to talk about the totality of the decision. Hike or no hike is not the story. You've got the decision, the statement, the projections, the news conferences, the news conference. That's a lot of different mediums to really attack this decision today, beyond just 25 or pause.
Yeah. So what's worse, a hawkish pause or a dovish hike, right? I mean, honestly, my head's spinning, and I think.
Well, Julian said something in the last hour, so Julian's right. I mean, look, I think we can all sit here, and I'm sure some people waking up this morning, good morning, agree that the Fed doesn't know things we don't know. I think that's the take, right? Particularly on the economy. But when it comes to financial stability, you would think they'd got some real-time information that we don't have about the financial system. The counterpoint to that is, if they had that, what on earth was Chairman Powell doing, teeing up a 50 basis point hike right before banks failed? It doesn't matter what I think about this. I think there's enough people out there who do believe that the Fed knows things that we don't know, and who also believe the more dovish this Fed is today, the more worried they are about the financial system. And if they're concerned, you should be too. That's a conclusion that some people are going to have.
If your head is spinning from the game theory on top of game theory, join the club. But you're not wrong. These are the machinations that people are going through to try to get a handle on something that is uniquely difficult.
I'll keep going back to it, Lisa. The ECB, based on our reporting, this is precisely the way they thought about their decision last week. They were concerned about the signal it would send if they didn't hike after pre-committing to going 50.
And you have to wonder, if the Fed's following the ECB, as we heard from Rich Clarida, formerly the vice chair of the Federal Reserve, then why wouldn't they raise 25 basis points?
We'll catch up with Mr. Clarida a little bit later. Special coverage, the Fed decides, and an absolutely brilliant lineup for you, which includes the former Fed vice chair, Priya Misra of TD Securities, Diane Swank of KPMG, and Bill Dudley, the former New York Fed president.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. A rescue of First Republic Bank may rely on U.S. backing to encourage a deal to shore up the lender. Bloomberg has learned that Wall Street leaders and U.S. officials have floated a variety of measures to make First Republic more attractive to a buyer or investors. The bank has lost 89% of its market value this year. It's decision day for the Federal Reserve. Will policymakers announce a quarter-point interest rate hike or pause to shore up financial stability? It's a difficult balance placed on Fed Chair Jerome Powell between his fight against inflation and a sudden banking crisis. The decision will be released at 2 p.m. in Washington. Shares of GameStop are soaring in pre-market. The video game retailer reported a surprise fourth-quarter profit, its first in 2 years. GameStop has struggled with profitability as the industry has moved away from discs to online downloads. One bright spot for the company has been its sales of physical collectibles. And in sports, Japan beat the U.S. 3-2 to win the World Baseball Classic in Miami. It all came down to Shohei Ohtani when he struck out Mike Trout, his longtime teammate on the Los Angeles Angels, for the victory. Ohtani was voted the WBC's most valuable player. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Seeds, typically between the time you start and they get out in the farmers' fields, is about 8 years. Now we have a pipeline of innovations. We've been funding the CG system for 20 years now. It's funded at about $1 billion a year. If people care at all about adaptation, that thing will be funded at $2 billion a year. I mean, there won't be anything close to the impact of climate-related seeds, climate-related maize, rice, wheat, sorghum, millet. And thank goodness, because of human genetics, we know how to do the editing. Thank goodness, because of AI, we know how to find the alleles. Because of drones, we can measure stuff in the field. So there's huge advance in terms of how the whole seed ecosystem moves at full speed.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
DOJ or other authorities.
Could face bigger challenges next.
Fed was going to keep rating World Cup. This is a 3.
As the economic picture does.
The OK is getting ready to make.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
I think that we will have a significant number of more banks that will not exist 12, 24 months from now that exist today. Which ones will be taken over, which ones will have a shotgun marriage? Clearly, the central banks and regulators are trying to stop things disappearing of their own accord, but the shotgun wedding is all with us.
Luke Ellis there, the Man Group CEO, speaking to the Bloomberg Invest Conference a little bit earlier today over in London. That's quite a statement to make there, Lisa. I think that we will have a significant number of more banks that will not exist in 12 to 24 months.
There are a lot of people who agree with that there's going to be a roll-up in the smaller and mid-sized banking sector because of this implausibility of the mismatch of deposits that can go at any time with longer-term liabilities. I just wonder if the big banks get involved or if this is isolated to, smaller banks joining forces to become larger ones.
Well, certainly the conversation here stateside is the big banks get together to do something about First Republic. First Republic is higher in the pre-market. There was this story we put out yesterday, Lisa, about government backing to encourage a deal. I was sitting there thinking, well, what would that look like? What does that look like?
I mean, we're trying to find out the details, and we have some early reporting. The ultimate problem is that a lot of these banks hold mortgage debt, other liquid assets, especially now, that is, if they were to sell it, really, really devalued relative to where they hold it. So how do they then make additional loans while also dealing with outflows from deposits without capitalizing, without crystallizing these losses? Maybe they could have some in-kind kind of deal from the government where they park it there and then get the money and then don't have to sell.
Let's get to Terry Haynes, the founder of Pangea Policy, over in Washington, D.C., to talk about some of these issues. Terry, I think there was a famous politician who was once asked what went wrong, and he said, events, dear boy, events. And events are hitting this White House hard over the last few years. And here's another one, a banking crisis. What do you think the next steps are, Terry?
The next steps politically or for the banks?
In terms of policy for the banks, Terry, what can they do? And do you think now that ensuring all depositors is kind of inevitable?
No, I don't think it's. I think it's the farthest thing from inevitable, frankly. Let me start very, very simply. The lens that you will see the politicians look through and act through is this systemic or is it not? Today, the indications are, and they have been for, I think, over a week, frankly, that this is not systemic. So what you will end up seeing is you'll end up seeing some rise from the Federal Reserve, as you and Lisa talked about earlier. You'll see people like Yellen continue to say, well, we'll continue to intervene where we think is necessary. You'll see politicians running around talking about things that are very likely not to happen, including things like universal deposit insurance. And meanwhile, what will end up happening is that the core problem won't be addressed. And the core problem is basically here that we have a banking regulation crisis causing a banking sector crisis, which is the idea that you've got a dearth of supervision and examination that are shaking markets' confidence in the sector.
Terry, can you explain that and where the balance of decision-making is right now? Are there more politicians who are inclined to increase regulations on banks or not, who don't want to necessarily impede the profitability of banks that just a couple of years ago, they basically lifted by virtue of some of the watering down of Dodd-Frank?
Well, the answer to your question, Lisa, is yes. The politicians are on both sides, and the signal I would that's to me that's noise. The signal is that what you see from that is that there is an understanding that there's not a systemic problem, so they're kind of retreating to their corners, and both sides politicizing the issue. Republicans by talking about, this is all they took banks took their eye off the ball because they're too worried about ESG. Democrats talking about how what really needs to happen is more support somehow. And in the middle, you've got outrage, and I think somewhat justified, that result in legislation about clawbacks and the like. And all that is important, but to me, what it signals is that there's not enough attention being paid to the simple fact that the bank regulators, both in the state as well as the federal government, and let's remember that SVB and Signature and the like were state institutions, state regulated, with a federal overlay. So that you have a situation here where the regulators have all fallen down on their jobs and need to correct that very quickly in order to help foster stability again.
Terry, you've mentioned several times that this is not a systemically important kind of problem or systemic banking issue, and yet some of the provisions that they triggered in order to step in the way that they did, and I'm talking about U.S. regulators, came under the systemically important moniker. There is this issue of the fact that a lot of these smaller and regional banks have a lot of dominance in specific sectors and do have broader relevance. So how do you pair the two ideas when talking about policy?
My view of this has been all along and continues to be, I mean, based on the facts as they happen, is that the body language and the verbal descriptions by all the policymakers have been that this is not systemic. They used some systemic tools, yes, and frankly, when I saw a couple of descriptions in press releases of, we used our systemic this under section that, I winced a little bit because I thought, well, you're giving a bad impression here. They used a couple of emergency tools that are within their ability to use, but at the same time, looked at broadly. Clearly what they think is that it's not systemic, and that, I'll take that all the way up to what Secretary Yellen said yesterday. I mean, clearly what they're talking about is not a systemic problem.
Terry, whenever there's a crisis of any kind, we take our attention off everything else. And Terry, that's what's happened over the last couple of weeks. We haven't been talking about what's been happening with Xi, what's been happening with TikTok. Let's start with Xi. Terry, I just want to go there just briefly. In the last couple of weeks, we've seen the Chinese leader broker conversations between Saudi Arabia and Iran, then go over to Russia. Terry, what have you taken away by the movements, the actions of the Chinese leader over the last 2 weeks or so?
My view to markets for at least the last 2 years has been that Russia exists as a client state of China, and you've seen the formalization of that, number one. Number two, I think American foreign policy has been making a lot of bad mistakes over the last decade. The lesson that Xi draws from what's going on in the Middle East, for example, going back almost a decade, where the United States essentially let Russia have a sphere of influence in Syria, then promptly leveled about half the country, is that it can continue to play there with impunity. And what you've got, as ever, is you've got a lot of states, not only in the Middle East, but in what's now called the Global South, who frankly are weighing their bets and trying to figure out where the wind is blowing. So this is a difficult time for American foreign policy, and they need to get a whole lot more energetic, a whole lot more quickly if they're to turn the tide on this.
I have no doubt we'll be talking more about this in the weeks and months to come, Terry, even the years and decades to come too, unfortunately. Terry Haynes there of Pangea Policy. Terry, thank you, sir. Thank you very much. TikTok is one way this is playing out, one forum for it. The TikTok CEO, got it written down here, Lisa, testifying before the House Energy and Commerce Committee tomorrow.
And there's going to be a big focus on what provisions they've taken to insulate the data, to also protect children from a whole host of potential woes that people have raised. The real issue is this is job protection. How do we keep the business under our own rubric and not offset it or offload it to, Meta or Snap or some of the others that have been surging in, the recent couple of days?
We have these hearings and you get the feeling that the people on the other side of the CEO have already made up their mind. They've already made up their mind about what they want to do. Is this a genuine hearing where it's a fact-finding mission and you work out what you're going to do next? The reason I ask, is there anything that this guy can say in this hearing tomorrow that's going to change the minds of those lawmakers?
You just said this so diplomatically, and you're expecting me to come out and be like, of course not. Are you kidding? There's absolutely nothing that he can say. The question is just going to be, how much meat is there behind some of the questioning in order to say, we're actually going to ban it, or we're going to pile on from the CFIUS recommendation and actually mandate some sort of sale? How far do they go? How far are they willing to, given the base of users where, 3/4 or more of all teenagers in the U.S. are on TikTok? So how do you then cater to a demographic that's your up-and-coming voter base?
Don't you get the feeling that a sale is more likely than a ban?
100%, which is the reason why...
They don't really want to go in the banning direction.
What kind of retaliation do you get from China? I mean, honestly...
They'll retaliate against the tech firms that aren't in China. They can't, can they? I mean, that's the other issue we've barely discussed,
yes,
reciprocity.
Where does it go? But this is perhaps the Xi Jinping and, Putin meeting.
Futures on the S&P, just about positive.
Our studios in New York and San Francisco. Our new hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television.
Let me talk about Starbucks for a moment. You've been on the board for how long?
Wow, a long time, since 2006.
Okay, and when you got on the board, did you have to go to Starbucks every day and
I go to Starbucks a lot.
And
Yes.
when you check in, do you have to wait in line like everybody
Yes,
else?
I wait in line like everyone else. That's an important part of the process to see how everything's working, how long it takes, what's happening in the store. I take pictures of the cases. I do all sorts of things when I go in now.
So what's your favorite drink? Can you say? Is that a state secret?
I make a joke about this. So I like my coffee black like me.
Okay. Now, Howard Schultz has been a mentor to you a bit. Is that correct? He's the founder of Starbucks.
Sure, for sure. Very important.
So what did he do that made Starbucks so successful? There are other coffee chains around the world, and it wasn't like he invented coffee chains. What did he actually do that made it the biggest in the world?
He really started off from the very beginning saying that he wanted to create a different kind of company and that he had this point of view about leading through the lens of humanity. It sounds like it could be a cliche, but it's not at all. It is very much in the DNA of the company, how we look at things, how we do things. It's always through this point of view of people. And so at the end of the day, I think he put people first, not only in terms of the partners of the company, but also in terms of the customer. And at the end of the day, that is what has made the company so great.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
We believe that the U.S. economy was going to stall even before these banking events happened.
Our base case, both in Europe and in the US, is that we're not done yet on the hiking cycles.
The Fed will be thinking about how much credit tightening is going to be happening as a result of the problems at the banks.
You really have to pay attention to the Fed on the third guardrail, which is bank supervision.
If the Fed were to pause, we don't think that the suggestion there is that there is a crisis of brewing.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
From an absolutely beautiful New York City this morning. Good morning, good morning. Stuart Kaiser of City, killing me in the commercial break. Lisa, I thought you were a serious person.
Yeah. And we just start laughing.
Just amazing.
No, I am.
What a
I'm very
welcome.
serious.
Lisa Abramowitz, very serious. I'm Jonathan Farrow. Equity futures right now just about positive on the S&P 500. The Fed decides in about 7 hours' time.
Wow, you're good at that clock. I mean, honestly, this to me is going to be a really interesting decision. How much will it matter? Do we have a sense of how the market will respond? Will it respond at all? Or is this going to be entirely subject to whatever, First Republic does tomorrow?
It's super hard to call. It's not just about 25 or pause. It's what you put in the statement. There's a phrase there about ongoing increases. Do you get rid of that? Then it's about what you put in the projections, what you want to signal. And then it's the language the chair uses in the news conference. Where does he want to lean? Towards price stability, towards financial stability.
We haven't brought this up, but how much credibility does the Fed have at this point, given the sort of change, I would argue, in the approach and the important mandates over the past couple of months?
It took a hit, certainly in the last 2 weeks, without a doubt. To go there in front of the committee at the House and the Senate and talk about increasing the pace, potentially opening the door to that off the back of the strong data we've had. Then a few days later to see bank failures in the United States, the biggest bank failure since 2008. that's a real credibility I hit for this chairman.
That said, you raised a point earlier that I thought was really important and really good, which was that the tightening that we're seeing and the financial system stress that we're seeing in the U.S. is very different from the UK that we saw earlier. And you're talking about how it actually runs very much in tandem. It's complementary to what the Fed is trying to do. So how much do they lean into that and try to quantify, like Apollo's Torsten Slok or others, how much of a rate hike that's equivalent to?
I saw Hatzius do the same. I don't think they can. I don't think they know. Can you draw the conclusion about the direction, that it is disinflationary, it will lead to tighter standards? I think you probably could, but it's too difficult and way too soon to start talking about this equating to 25 basis points, 50 basis points. I don't think you can even go there, can you?
No, I think it's a valid point, especially because we've had 2 days of stability, so now it's risk on, and maybe, you know, as you said, another 2 days and 50 basis points back on the table, 100%.
Without a doubt. Let's whip through the price section for you. We're looking for a 25 basis point hike. That's the consensus, but some people out there are looking for a pause. Wells Fargo one, Goldman another. There's a few out there too. Nomura looking for a cut. I don't know what needs to happen between now and the meeting and the decision to get that cut, but who knows, okay? Outside of that, in the FX market, euro-dollar 107.89, positive 0.2%. I'll keep mentioning the comments we got from President Lagarde if you are just tuning in. President Lagarde was really punchy a little bit earlier on. No trade-off between price and financial stability, Lisa. She said, we will not entertain any trade-offs from our primary objective.
And so we have to ask the question, is the inflation picture that much different and actually hotter in Europe than it is in the U.S., which is ironic because we were talking about the exact opposite about 6 months ago, and then it was hotter in the U.S. So are they going to send a signal to the Fed or not? Today at 2 p.m., we do get that Fed rate decision. A lot of people are expecting a 25 basis point, but this is the first time in the past year that we haven't had at least one full rate hike baked into the pricing in markets ahead of the meeting. And to me, this is a really interesting conundrum for the Federal Reserve. 2:30 p.m., that press conference will be really interesting. Does he stick to the script? And if he does that mean that there is some sort of consensus on the FOMC? Then at 2:30 p.m., counter-programming as U.S. Treasury Secretary Janet Yellen. She'll be testifying to the Senate Financial Services panel. How many questions are we going to get about First Republic Bank, what the type of insurance is to all deposits, what the willingness is by a lot of politicians to back that? We've heard some, I guess, reluctance and a teaming up on both sides, really, with even Democrats coming out kind of feeling a little skittish about backing some of these banks even more at this moment.
You get the feeling they've spoken to each other, right?
Yeah.
2:30 coming out at the same time.
You think? You think that this is counter-programming to try
No. That's not what I'm suggesting. I've got no idea about the scheduling. I would have just thought, knowing that they know what time they're going to be speaking today, they've got to be speaking from the same hymn sheet.
They have to. Yeah.
You know?
I mean, they have to. And they have to basically be complementary. And so let's hear how that works. At 5:45 p.m., we hear from one of the big bank CEOs, Jane Fraser of Citigroup, speaking at the Economic Club of Washington, D.C. Then she'll be in a conversation with David Rubenstein of Peer-to-Peer, which airs on Bloomberg. There is a question of how much are the big banks going to support the medium-sized banks, given that this potentially could be systemic, but even more, it's a great PR move for when they're called before Congress next time.
What's that?
We helped support the medium-sized banks. We are part of the solution. That's been their big kind of talking point.
Is that what you actually think this is, a PR move?
I don't really know why they're backing all of the smaller and regional banks. I think
our next guest is from Citi. Just, throwing that out there.
Hi, how's it going?
Keep Stuart out of trouble, all right? Let's park that. We're going to isolate that concern and talk about something else, which is what the Fed might do later.
What tools are you going to use to isolate that? Just shutting me out?
Stuart Kaiser. The head of U.S. equity trading strategy at a bank called Citi. Don't worry, Stuart, I'm not going to go there. I'd never do that.
She did not quit her talking points with me. I think we can all agree with that.
It's a different network. I won't make that awkward. All right? Stu, let's start here. We stay tactically positive. What is tactically positive?
Right now, it's about 48 hours. I would say. No, seriously. I mean, from our perspective, you mentioned First Republic. I think until, in our view, you get some real private capital going into U.S. regional banks, it's hard to feel, more structurally positive about the market. But, if you take the ECB last week as a bit of a script, they tried to discuss the banking support stuff pre-meeting, have the meeting focus on policy. And I think if the Fed's able to accomplish that, you can get equities modestly higher. Will there be a lot of follow-through, into the end of the week and next week? Hard to say. Again, I think you need to go back to the regional bank stuff. But I think very tactically, kind of next couple of days, we do think the market's going to continue to move higher, and then it's going to be a read and react from then.
So you think Chairman Powell, same hymn sheet as President Lagarde?
I don't know if he's going to say the same things, but I think the construct of let's try to discuss banking support the day before the meeting, which I think they floated some ideas there, allow the central bank to focus on policy specifically, so that his press conference is not dominated by financial stability concerns. I think if they're able to engineer that, then that's probably a net positive for the markets. We were up yesterday, so it's hard to see exactly how much follow through we would get, but that's kind of the very tactical script we're following.
One thing that's been notable is the interpretation of the Fed's comments and their actions has really been based on where people want to see it and what they want to understand. And it seems like this market's wanted to rally, at least over the past couple of sessions. Do you think that there's a signal in that people want to look past this and still get on the trade of the recovery?
I think that's been the case all year, to be honest with you. The market's been very resilient. I don't know that we're in buy the dip mentality, but I think that, the sell-offs we've gotten have been, fairly shallow, and people have been pretty happy to re-engage to the long side. And I think there's a fundamental aspect to that as well. I mean, there's a lot of risks in the system, but I think you'd have to argue the risks this year, before the banking, issue, were better understood and I think less extreme than they were last year. So our view was the risk reward of the market was better this year, and folks do want the market to go higher. When you start talking about 2008, it's it hurts sentiment.
Well, to say the least, that's well said. And if we do get the stability that we have seen over the past couple of sessions, I wonder if some sort of dovish hike or a hike with some indication that they're not really baking in further rate hikes in the near future would be incredibly constructive for equities who are looking at the momentum that we've seen in the data, potentially softer path of rate hikes, risk on.
Yeah, like our view on the Fed here is they want to be hiking 25 basis points for the next couple of meetings, all else equal. And anything that takes them off that path, I think, is negative. If they're forced to pause because of financial stability concerns, that's bad for markets. If they're forced to step back up to 50 basis points because inflation's accelerating, that's bad for markets. So I think you're in a situation here where if they can guide to staying at 25 basis points, which is almost impossible for them to do, to be fair, but if they can hike 25 basis points the next couple of meetings, not be knocked off that path by exogenous issues, then yeah, that's positive for markets. I think markets rally. You saw the markets didn't like when you started talking about going back to 50 again, right? I mean, we're in a situation where I think the market feels we're getting near terminal. Clearly, rates have gotten to a level where financial stability concerns are starting to enter the equation. So if the Fed can just be at 25, I think that's a good thing. If they get knocked off that path, I think it's a negative for risk.
And let's talk about tech outperformance. Only 2 weeks ago, I had people coming on the program with me, with Lisa, with Tom, saying that there is a secular component to the inflation story, that it's the end of tech hegemony, and that we're going to get new leadership. 2 weeks later, rates roll over, tech rips again. If there's a secular component to the story, then there's a secular component to the story. It can't just change in 2 weeks, can it?
Well, the Fed's view on rate hikes changed in one month of data. So I guess it can. Look, I mean, our view on tech is I understand the logic, but I feel like this is a 2022 discussion when valuation was extremely high. And when you attacked valuation so aggressively last year through the rates channel, our view is that changed risk reward considerably for the sector, and it can continue to work. And, if I told you we're in a period of instability, both, from a policy perspective and from an economic perspective, owning large cap tech with big balance sheets, high free cash flow generation, and strong buybacks at a valuation that's not as high a hurdle as it was last year, we think that sets up good risk reward for tech, and we've been pointing, folks in that direction.
So when you say tactically positive, you mean overweight tech in the short term?
Yeah, well, I think we're overweight tech more medium term even. I think our view is if the markets are rising, tech is going to be the outperformer. And I think that's largely it's what we saw in January. Surprisingly, even it's what we saw in February, and frankly, it's what we've seen the last couple of weeks. So I think if the markets are rising, we feel like money's going to continue to flow. Money's going to continue to flow into tech, and that's going to lead you to the upside. Does that mean over the next week you might not get? The last week has been crazy. Tech up, energy down. I think a lot of investors are looking at that and saying, hey, I need to kind of fade these really sharp moves. But if you're telling me, 2 to 4 weeks out or 6 to 8 weeks out, yeah, I think if the markets are higher, I think tech's leading that.
Just real quick, how much is this due to all the money that's in index funds?
It matters, 100%. It matters. I mean, they're obviously a large weighting. Look, our U.S. equity strategists think that structurally speaking, tech is going to become a smaller overall weight of the equity market over the next couple of years. But from my perspective, I'm much more tactical, fortunately or unfortunately, and I think, look, next 1 to 3 to 6 months, my view is tech can continue to lead. If you look at what long only did last year, they sold a lot of tech, and we've gotten some pushback. Well, they've started buying tech. They've only rebought less than half of what they sold last year. So our view is that there's still room for that group of long-only investors to add to tech, and that should be positive for the sector.
Jane says, great work. That was good. Stuart Kaiser of Citi. Stuart, thank you. It's good to see you. Futures positive by 0.1% on the S&P 500. Coming up a little bit later this hour, Betsy Duke, the former Fed governor from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The Federal Reserve is caught between inflation and a sudden banking crisis. We'll learn how Fed Chair Jerome Powell and his colleagues respond later today. Most economists expect the Fed to increase interest rates by a quarter point, but some say policymakers should hold off to shore up financial stability. The decision comes out at 2 p.m. New York time. Inflation in the UK rose unexpectedly for the first time in 4 months. The Consumer Prices Index rose 10.4% from a year earlier. That followed a 10.1% jump in January. Food and drink prices were among the culprits, rising the fastest pace in 45 years. Now, all that may boost arguments that the Bank of England should raise interest rates as soon as tomorrow. Xi Jinping used his visit to Moscow to firmly align with Russia against the U.S. Still, the Chinese president didn't give Vladimir Putin something else he wanted, a commitment to buy a lot more natural gas. That showed that China may be hesitant about appearing too close to Russia. It was Xi's first trip to Russia since Putin invaded Ukraine. It's a move that is certain to anger North Korea. The U.S. and South Korea plan to hold their largest ever live fire drills in June. Now, the exercise will involve mobilizing high-tech military equipment. The two allies are winding down training drills this week. North Korea has responded by threatening to turn the Pacific Ocean into a firing range. And unionized workers at Starbucks will welcome their new CEO today with strikes at about 100 stores across the U.S. The baristas are demanding that the company drop its alleged anti-union coercion. Lakshman Narasimhan officially took over at Starbucks chief executive this week. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
multi-trillion-dollar industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Hi, I'm Francine Lacroix. Join me on Leaders with Lacroix as we explore what drives the most influential people on the planet. Leaders with Lacroix on Bloomberg Television, TV Go, and Bloomberg.com.
Week wake of turmoil. What's the Fed's next move?
The job of reducing inflation is not over.
Are they worried about the signal it would send if they did nothing?
Trust Bloomberg for the fastest coverage and exclusive analysis.
Central banks groping their way through a dark room, looking for Schrodinger's cat.
Does this indicate that the Fed is petrified?
Does bank supervision take precedence?
If you want to fight inflation, you better sort out your financial system first.
Bloomberg Surveillance. The Fed decides. Today on Bloomberg, your global business authority.
I have made clear that there is no trade-off between price stability and financial stability. We have plenty of tools to provide liquidity support to the financial support if needed, and to preserve the smooth transmission of our monetary policy.
Imagine that the words of President Lagarde are replaced with Chairman Powell. And Chairman Powell comes out later and says this: I have made clear that there is no trade-off between price stability and financial stability. We have plenty of tools to provide liquidity support to the financial sector if needed and to preserve the smooth transition of our monetary policy. Imagine if he said that in the news conference a little bit later.
I feel like the response would be if you go to an arcade and all of a sudden it goes, wah, 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 game over. Like it would sort of be like that in the market.
First question. They said, is there any trade-off? And he turned around and said, no trade-off between price and financial stability. We will not entertain trade-offs. That is really punchy stuff from President Lagarde. If Chairman Powell says that later, that's one heck of a hawkish news conference.
That would be one heck of a sell-off, I would assume. And honestly, I don't want to game out what the market does because that's always a perilous game. But I do think that that would lead to quite a bit of selling and repricing dramatically on a two-year yield and Fed funds expectations that have already repriced so significantly over the past couple of weeks.
So I've said a few times there are 4 different ways to look at this: the decision, the statement, the projections, the news conference. So those 4 things. On the projections, the median dot for 23 was 5.1% last time around. Is it still 5.1%? Matt Lazzetti at Deutsche Bank thinks that maybe you get to 25 today, but ultimately we've got closer to that moment of being sufficiently restrictive, whatever that means, and that maybe the dots stay the same. I've said a few times in the last 24 hours, I don't think the dots today are about trying to deliver an accurate forecast of anything, because it is tremendously difficult to deliver a forecast that is accurate at the best of times. This is about signaling today. It's about signaling your intentions around what you understand to be the trade-off between 2 different things, if you even believe there is a trade-off between what's happened in the last 2 weeks and what your monetary policy objectives are.
A number of economists have come out over the past 24 hours and talked about the Fed as a risk mitigator, as ultimately an agency that really wants to just eliminate and do the least risky option. In this case, what Matt Lazzetti is talking about probably would be the least risky option, both hiking rates, keeping things steady, saying we're well on our path without acknowledging the ups and downs, the whipsaw action that we've seen over the past couple of months.
Let's get to the price action and start with equity futures on the S&P 500, positive by about 0.1% on the S&P. Equity futures higher this morning by a little more than 0.1%. If we can turn to the bond market and try and get 2s, 10s and 30s up and look right the way through the curve, that would be great. Your 2-year, your 10-year, your 30-year. There we go. 420 now on a 2-year. As high as 5.08% in the last week or so, as low as 362 in the last couple of weeks. This 2 years been all over the place. The curve has been all over the place as well. 2s, 10s at one point was negative 110, and then it went to negative 60 on my screen at the moment, negative 58, but went lower than that, or rather higher than that. You know what I mean by that.
Yeah.
Less inverted.
Yeah, exactly.
Getting a little bit of steepness delivered from the front end. I'll turn to foreign exchange, euro, dollar, and sterling, and take a look at sterling, because the move we've had today off the back of higher inflation, higher than expected inflation out of the UK, back with a 10 handle. It sticks, 122.85. Cable right there, positive 5 or 0.6%. We can head over to Frankfurt. There is an ECB and its watchers conference in Frankfurt. What do you make of that?
The fact that,
especially for ECB watchers.
Well, you had a really nice name for it. What was it again?
No. What did I call it? I forget. What did I call it?
Nerdfest.
Is that what I called it?
No, maybe that was
my kind of language. Is that what you've called it? That's rude.
I did.
Maria today I was there. That's not nice. Maria, we heard from President Lagarde a little bit earlier. What did she say?
Down.
I'm pretty sure Maria Tadeo can't hear us.
Yeah, I think
based on that.
which is great.
Based
It's
on that
probably a
face
good
that
thing.
she gave back to
Maybe-
us. Although
maybe she
sometimes she
did.
pulls that face at Tom even if she can hear Tom. It's
That's
like,
I can hear you now. So just pretend. Oh, she
got
can
no
hear us
interest.
now.
You can hear me now, Maria. Let's talk about President Lagarde. What did she say earlier?
No, I can hear it. Look, I think, first of all, this is the third time, which is very unusual, that we hear from the head of the European Central Bank in a week. We obviously had decision day on Thursday. Then we had Madame Lagarde in Brussels on Monday, and today here at this Watchers Conference in Frankfurt. The message every time, it's exactly the same. There is no trade-off between price stability and financial stability. That means that the mission to bring down inflation, she said, quote, is non-negotiable. This is a single mandate. Central bank inflation too high needs to go down to 2%. And again, repeating, yes, there has been turmoil in the banking sector, but that is not going to be a trade-off. Now, the other important thing is, when it comes to the forward guidance, we had grown almost used to this idea that every meeting we knew already what was going to happen. And the question was, what comes next? Can you calibrate 2 basis points? I think she's given herself some flexibility to the extent that there is still forward guidance in the sense that we know they will continue to hike. Can you calibrate specifically how big going into May? At this point, not really.
We heard from the German head of the central bank some pretty hawkish language as well. And this really raises a question to me. How much does Christine Lagarde represent the collective wisdom of the ECB? How much dissonance is there at a time where there are divergent fates within the different separate countries, and yet inflation still very much at the forefront for all?
Yes, and this has always been the perennial issue for the European Central Bank. By the way, you really do have to set monetary policy for countries that are very different. And obviously, we talked about 19 countries. Now it's 20 because Croatia just joined now. But the thing that I always heard about Christine Lagarde, which maybe is worth mentioning, is that obviously she's not Mario Draghi to the extent that this is a very, highly regarded with a very great reputation as an economist. But what people will say behind the scenes in Frankfurt is that while she may not be as good on the technical side of things as Mario Draghi was, she is good at building that consensus and bringing everyone together and making sure that everyone feels heard. When you talk about also the hawkishness of the German central bank, a lot of the language also coming from Christine Lagarde reflects that too. I mean, she repeated the stamina to bring down inflation to 2% has not gone away, even though the jitters in the market and potentially the banks too may have gotten a lot of the headlines this week. But then she repeated, they do not see this as a trade-off. It's not one or the other. They can handle both.
Maria, after her last press conference, a lot of people said Christine Lagarde did a tremendous job really parsing through both the issues and delivering a message that was clear with an applause from markets. Now that the whole Credit Suisse issue has occurred, UBS has agreed to acquire Credit Suisse. Do people still feel the same way?
Look, and that's a very good point, too, because on Thursday, to be fair, a lot of my contacts actually told me that was one of her best press conferences to date. It was clear, simple language. The market was able to really digest its 50 basis points, and they were able to do it at a moment in which there was still turbulence, maybe not as big as there was over the weekend, but it was a tricky week to make that kind of decision, and the market was able to take it. I think beyond that, what they're now trying to do and really hammer this message is repeat that European banks are well capitalized, that they're well regulated, that some of the issues that happened at Credit Suisse and obviously now with the takeover from UBS are specific to Switzerland. And another message that she's repeated many times this week is that when you look at the wipeout of the T1s, that reflects a decision that was done by the Swiss regulators. It does not set a precedent for European banks, and this is a very different situation. Another point, just very briefly also, just to show the difference here. Yesterday, we also had comments from Mr. Enria, who, as you know, he leads the supervisory board of the ECB, and he also said, given the situation, the ECB is confident that buybacks and dividends can go ahead as planned for European banks.
Hey, Maria, great work. Maria Tadeo there at the ECB and its Watchers Conference. I've been to that conference. It's a good conference. Yeah, no, it's good. You hear from the president of the ECB, it was Draghi at the time. and then you get to catch up with all the economists that cover the ECB and the other ECB officials as well. It's a productive time.
I would love to be there. I mean, not just
You
because
want to
I'm
do
sitting
the
in
Fed
Tom
and its
Keen's.
Watchers conference.
Well, I'm not just because I'm sitting in the seat and asking for a road trip, but I actually think that would be fascinating to see what they're seeing on the ground in terms of credit tightening and banks.
Bob Michael of JP Morgan coming up next.
You're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Equity futures on the S&P 500 positive by 0.1%. 5 or 6, 7 hours away from a Fed decision, looking for a 25 basis point hike. Said this a few times, there are some banks out there looking for a pause, including Goldman Sachs and Wells Fargo. We catched up with Sarah House, caught up with her from Wells Fargo a little bit earlier on this morning, who suggested even if they do pause today, they can restart hiking, which was Jan Hans's point over at Goldman Sachs as well. In the bond market, what a round trip it's been on a 2-year. The last time they met, the day of the close, 4.1% on a 2-year. Right now, 4.2%. A lift again today, up by 3 or 4 basis points on a 2-year. We've been all over the place, north of 5, south of 4, 4.2% at the moment, somewhere in between. On a US 10-year, 361.32, which is where the 2-year was only a couple of weeks ago or something like that. Anyway, in the FX market, let's get to foreign exchange for you and round things up there. Euro dollar just short of 108, 107.95, positive a quarter of 1%. Cable stronger, the pound stronger against the US dollar, 122.79. Lisa, up a half of 1% there. Ultimately, off the back of this inflation story in the UK, a 10 handle, 10.4, upside surprise.
Which is not exactly what they want to see. So we've been talking about banks for the past couple of weeks, and that's been the entirety of the movers. And yet there have been other stories that have been emerging that are relevant because they speak to this question of how long we can remain in this inflationary environment before profit margins get crimped. And I wanted to take a look at some other companies outside the banking sector that kind of speak to that. Nike came out. They beat quarterly earnings in a really robust way. They've been doing really well, getting rid of some of their inventories, working down their excess inventory. But profitability is the problem. Their high freight and material costs, and they are expecting that to really weigh on profitability going forward. It's interesting that even after that big beat, those shares are lower, more than 1% because of the longer-term outlook. GameStop shares. This is one of the meme stocks, up almost 50% after beating expectations. They had a surprise fourth quarter adjusted profit, basically talking about some progress, perhaps because of all the money that they've been getting from meme traders. And in sympathy, AMC shares up more than 10%. Remember when we were talking about the silly money being done? Well, maybe it's not, right? That people are willing to, not to say that it's silly. I'm not going to, talk about anyone's trade like that. But this question of, the shares that move the most on a sort of risk-on feel have not changed that much. And I think that's relevant because it speaks to the moment we're in and where some of the movement wants to go.
First Republic, now just about unchanged. On that name specifically, because I want to avoid meme stocks.
You're going to just totally avoid it, okay.
First Republic, and talk about the banks. That stock's been all over the place. Now we're talking about another solution. 11 banks, 30 billion on deposit, First Republic. That doesn't get it done. Now they're talking about doing more. There's this conversation about a government backstop, government support. What is the government's role in this?
It's a great question, especially because you do have banks also involved. So why are they involved? What are they looking for from the government? How much is it to stem some of the potential illiquidity in their asset pools that they have that were really underwritten during a time of much lower interest rates? There's also a bigger point here, which is that the banking industry is built on trust. We've talked about this many times before. If you have a bank that is talking about strategic options going forward, that in and of itself is not the greatest thing to shore up confidence. So
Agreed.
How do you get some sort of stability without that strategic option being executed on?
Certainly the tone of things over the last couple of days better outside of that one bank, and we'll see if that continues.
If it continues, though, what does that mean for monetary policy?
We'll talk 50 all over again.
I know, I love that. I love that comment of yours.
It's ridiculous. If we find a banking solution, are we back to where we were 2 weeks ago, which is a conversation about no landing and all of the above? Or have things really changed?
I would argue no. I would argue that this has materially changed the outlook, not because there's some systemic banking crisis, but because the cost of capital has gone up materially for some of these banks. Suddenly, the deposit outflows are coming into the fore, and there is a restriction on the amount of capital that some of these smaller regional banks that account for so much of the credit creation have to lend out and to generate some of the growth that it has.
The majority of people out there, I think, coalescing around that view for sure in the last week or so. We get lucky. We get to catch up with Bob Michael twice in a week. Once on a Sunday evening. And this is more normal, Bob. Good morning to you from JP Morgan Asset Management. Bob, Mike McKee messaged me earlier, and he wanted to know, one, is Bob Michael on today? And two, what does Bob want me to ask in the news conference? What is it today, Bob?
Well, I think he's got to ask that the Fed was set up, the Federal Reserve Act of 1913 was designed to prevent a run on banks. So they must have seen this. They must have seen the depositor outflows. Are they seeing anything else that worries them, and what is that? And I think there are things in the commercial property market, there are things in the bank loan market where the resets have doubled and tripled what borrowers are paying. So there's still a lot out there.
So, Bob, how do they parse a message that goes from we want credit conditions to tighten to, oh, my goodness, it's not a financial crisis, but things are tightening too quickly? How do they parse that line to a market that doesn't like nuance?
They don't need to, Lisa. They've told us they're data dependent. Look at the data. They've won. They don't need to pile on. Look at inflation. If you look at month-to-date 10-year tips, they're down 30 basis points to 2.1%. Inflation expectations are coming down. Look at the University of Michigan consumer sentiment. 1-year inflation expectations, they're down the most in 2 years. That's pre when they started to hike rates. They're at 3.8%. And then if you go back to the charter they were set up to prevent a run on banks, well, they pushed it to the point where they had to step in and stop a run on banks. So they've achieved the maximum pressure they needed to bring inflation down. It's happening. It's in the data. You pause and you wait.
Then how do you make sense, Bob, if they probably saw the outflows from depositors from some of these banks before that speech, that testimony from Jay Powell, where he opened the door to a 50 basis point rate hike? How do they signal that the scenario has changed so dramatically in 2 weeks, given that a lot of what you're talking about, the winning of their war, would have been won before what we saw with Silicon Valley Bank?
Honestly, it really doesn't matter. These are the long and variable impacts. They're already catching up to the economy. We're seeing it. They're starting to bite hard. What's going to happen over the next 3 to 6 months? Let's wait and see what happens. For sure, we've looked at every time the Fed has stopped hiking rates. On average, it's been about 13 months to recession. So they could stop here, and then let's see what happens over the next year. We think with quantitative tightening, it actually pulls that forward into the end of this year.
So, Bob, at the start of the year when credit was ripping, high yield was doing really well, you resisted the urge to pile in as well. So I'd be interested to know what you've actually been doing over the last couple of weeks as things have started to go the other way and you weren't on the wrong side of the trade, so to speak. Bob, what did you do?
I'm holding on to our conservative position where we've had hedges in the CDX market. You're going to have to pry them out of my dying hands. This is the start. This is not the end.
So let's talk about spread levels. So spread right now is at 480. Was as tight as about 390 a number of weeks ago. Can you just talk me through, Bob, levels? You and I have talked about this before, but the basic argument goes something like this. It's a higher quality index. It won't gap wider in the way that it has done in recessions previously. Bob, you've pushed back against that notion. Why?
Yes, because I've lived through every other cycle in the high yield market. People forget this market isn't 100 years old. It's just over 30 years old. And you hear that same story all the time. This time it's different. But the problem is that fear always replaces greed. People are scrambling for up in quality. We've seen in the last week, you don't know where the problems are going to happen, so you just try to de-risk. Every single time, high yield goes to a minimum credit spread of 800 basis points over. I think we're easily on track for that. I know last time I was on Sunday, I think it was the evening, we talked a little bit about non-bank lenders, which are us in the market. So we're already starting to hear from our clients that they want to know what we hold in their portfolios. They're asking all their managers. So we're going to start tightening credit conditions ourselves just because our clients don't want us to take the kinds of risks that they were comfortable a year or so ago. That's not just us. It's every manager, it's in the public markets, and it's for sure in the private markets.
So, Bob, how much has that accelerated over the past 2 weeks? And John asked me earlier, even if this issue with some of the medium-sized businesses, medium-sized banks rather, is resolved, and we do get some sort of backstop that staves off some sort of contagion risk or any of these concerns, how much have credit conditions tightened over the past 2 weeks anyway that will be persistent?
Well, they've tightened everywhere. We talked about the central banks waiting for those cumulative long variable lags to catch up. So they're going to catch up. So unless they start cutting rates or ending QT, that's going to be progressive. So central banks are still tightening credit conditions. When you look at senior loan officer surveys, banks for sure have been tightening credit conditions. And I think with what's happened over the last couple of weeks, there's no going back on that. And then I talked about non-bank lenders. We're all doing the work for the Fed anyway. They can hit the pause button. The banks are still tightening credit conditions. And as I said, non-bank lenders are as well.
I hate these analogies, Bob, but you mentioned commercial real estate. A lot of people are pointing at it. And if you could say where we are in terms of the devaluation in commercial real estate, are we at the beginning? Are we at the middle? How much further does it have to go?
Well, it depends where you are in the snake. I think for sure that property companies are already having problems with offices in central business districts, right? And you're just now starting to see that in some commercial mortgage-backed securitizations. But there's the whole REIT market, there's the CMBS market, there's the whole regional bank market where a lot of their loans are into the commercial property market. And then there's the GSIB banks. So these things don't just tend to happen and go away. They tend to build, and they're with us for a while.
So, Bob, just a final question from me. A number of weeks ago, you said to me, the whole curve, 3 handle, 2s out to 30s. We've seen that. Are you saying right the way down to 3%?
Yes, I didn't say 3 handle, I said 3%.
There we go. There's the call.
3.00 minimum.
Wow.
Wow,
Bob Michael
minimum.
of JP Morgan.
2s to 30s.
Asset Management, 3.002s to 30s. Bob, thanks for that, and thanks for the correction too, because it's an important one. It's about 99 basis points of difference between just being at a 3 handle and being at 3.00.
His point is a provocative one, especially because people used to think that we were going to be in a higher inflationary environment and that we were going to see higher real yields for longer. And suddenly that leads a lot of people to pile into duration, and you wonder if that's creating some stability on the long end, despite the volatility on the short end.
Subtle difference, though. I think it's an important one. It's back to 3, not back to 0, which ultimately is this point that it is high for longer. Bob's point is that every cycle, that low gets higher and that high gets higher as well. So higher lows and higher highs.
Higher highs.
That makes sense, I hope. 361 on a 10-year right now. Your 2-year 4.22. Betsy Duke, the former Fed governor, joins us next.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. A rescue of First Republic Bank may rely on U.S. backing to encourage a deal to shore up the lender. Bloomberg has learned that Wall Street leaders and U.S. officials have floated a variety of measures to make First Republic more attractive to a buyer or investors. The bank has lost 89% of its market value this year. It's decision day for the Federal Reserve. Will policymakers announce a quarter-point interest rate hike or pause to shore up financial stability? It's a difficult balance placed on Fed Chair Jerome Powell between his fight against inflation and a sudden banking crisis. The decision will be released at 2 p.m. in Washington. In Germany, Chancellor Olaf Scholz's advisors predict there won't be a contraction this year. They'll estimate that GDP will rise 0.2%, but they warn that the situation remains tense and inflation will continue to weigh on Europe's largest economy. Virgin Orbit is resuming some operations on Thursday. The satellite launch firm founded by Richard Branson temporarily halted activities last week. A failed launch a few months ago threw the ambitious space program off course. And in sports, Japan beat the U.S. 3-2 to win the World Baseball Classic in Miami. It all came down to the final moment when Shohei Ohtani struck out Mike Trout, his longtime teammate on the Los Angeles Angels, for the victory. Ohtani was voted the WBC's most valuable player. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. You know, lots of testing, lots of thinking about what could go wrong, lots of research. You know, when I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com webinars.
If it is a dovish hike the way it seems to be building as a consensus, I think the market takes that as risk on to a certain degree. If they do a dovish hike, you get really comfortable that they're going to be done hiking sometime within the next 6 to 12 weeks at the most.
Marvin Lowe there of State Street going into this Fed decision a little bit later on this afternoon, about 6 hours away from that decision down in Washington, D.C. Equity futures right now on the S&P 500, almost totally unchanged on the S&P. Yields going nowhere to 361. This is kind of what you'd expect going into a pivotal move, potentially, from the Federal Reserve. Lisa, 25 or pause is now the conversation, the consensus leaning towards 25.
You'd expect stasis as people try to wait and see what they could potentially do. The reaction, though, is going to be interesting. How much are people going to react to the actual move versus exactly what you talked about, the statement, the projection of estimates of economic estimates. The news conference, which, I don't know. How is he going to handle that?
This is the hardest Fed decision in the last year with ease. It's just the hardest. I'm not even sure anything comes close to this in the last 12 months.
Especially because there will be questions not only about monetary policy, but also about oversight and how much they really have their handle on potential risks building in other regional banks.
If you think this moment is delicate, imagine turning up to the Federal Reserve in August 2008. That was Betsy Duke, the former Fed governor. Betsy joins us right now. Betsy, can we start there? Can you describe what that was like, starting on the Federal Reserve in August 2008?
So it was August 2008. I was sworn in about 30 minutes before my first FOMC meeting, which was the last normal FOMC meeting there ever was. And after my second FOMC meeting, we went into the chairman's office and voted to lend $85 billion to AIG. So that's how I started my Fed career.
Well, Betsy, can you tell me how different this moment is relative to what you went through all those years ago?
You know, it's different, but it's the same. You know, the Fed's job stays the Fed's job, regardless of what the current events are, whatever the crisis of the day. The Fed has to keep its eye on what its job actually is.
Well, let's talk about what its job actually is. There are dual mandates. One of them is inflation. That is the first and foremost one, but it's also oversight. How much has the lack of supervision over certain banks complicated their role right now?
I think supervision has been a complicated factor. And I think it's supervision, not regulation. Those terms are often used interchangeably, but regulation applies to the rules of the road, if you were. Supervision is being in the banks, paying attention to what's happening at each individual banks, not to banks as a whole. And that's where it seems to me that the problem lies.
And this raises a question about how much signal there is from a Federal Reserve, where the chair went before Congress and really opened the door to a 50 basis point rate hike just days before a collapse of one of the biggest banks going back to the financial crisis. I'm curious what you make of that and how much signal there will be in terms of their visibility and other problems in the banking sector today.
So the role of monetary policy is not to protect the balance sheet of the banks. And the tools that the Fed has to deal with the financial system are very different than the tools that the Fed uses in monetary policy. So the primary tool in the financial system is the Fed's ability to lend. That's why the Fed was established, to lend in liquidity crises, which this at its core is. So the facility that they established the weekend after SVB failed is right in their wheelhouse. That is their primary tool for dealing with financial stability.
A lot of people,
and I think they'll separate it from the monetary policy decision.
A lot of people argue that it's not quantitative easing, that this is not a reversal of quantitative tightening, that yes, the balance sheet rose by $300 billion, but it's a different mechanism. It's not buying, it's lending. It's a different type of stimulative effect. Do you draw the same distinction, or do you think that this is basically the end of quantitative tightening?
Actually, they would have to offset the increase coming from the loans with a further sale of the securities on the balance sheet to offset the quantitative easing, if you will, that's going to result from the balance sheet growing because of the loans that they're making. If you go back to, again, 2008, the whole QE1 was not actually, did not change the size of the Fed's balance sheet at all. It simply replaced the lending that the bank had done during the crisis with securities. So it kept the Fed's balance sheet from contracting, but it didn't expand the Fed's balance sheet. It wasn't until QE2 and 3 that the Fed's balance sheet started to expand.
Betsy, a lot of the post-crisis apparatus that the Federal Reserve came up with was designed to communicate low for longer. The dot plot was an effective tool to do that. You could just show, going out years, that we weren't looking to hike rates for a long, long time. Betsy, how do you think the dots will be used today for signaling?
So at his last press conference, Chairman Powell was very, very clear that he expected the projections to come out in the SEP, the Summary of Economic Projections. He expected those dots to be higher with the new projections. And I don't see any way that that doesn't happen. So the decision in the room needs to, for Fed's credibility, I think needs to match what its projections are. So I would focus not just on what the decision is today, but what do those projections say about what the terminal rate is? And I think that's going to be the big surprise.
Betsy, you think that they're going to increase those dots. They're going to increase the projection of where Fed funds rates will ultimately end up despite some of the turmoil recently. What's going to be the justification for that? Are they going to double down on this idea of inflation and that we still haven't gotten restrictive enough despite signs of credit tightening that has been accelerated over the past few weeks?
Well, the way I interpreted the comments was that the expectation was that inflation would come down more slowly than they had expected. And the dots come from expectations of inflation. If you remember, there was a lot of discussion in that press conference. And at one point, Chairman Powell said, you know, my forecast is different than yours. If your forecast is right, your rate projection will be right. But if my forecast is right, then your rate forecast is going to be wrong. And I think it'd be a mistake to not remember that, not pay attention to it.
Betsy, just one final thing. One thing we've talked about over the last couple of weeks is whether the Fed knows things that we don't know when it comes to financial stability. When you watch the news conference later, are we watching a chairman that knows things that we don't know about the financial system?
I think you will find that he certainly knows things that we don't know. But whether they are things he's trying to hide, I don't think that's necessarily true. Again, his credibility is his most important asset. And so he's not going to be trying to hide anything. But when they talk about the strength of the banking industry, right now the banks are strong, capital is strong, asset quality is extremely good. This is an interest rate risk issue, a liquidity issue. And, you know, it goes back to the basics of banking. This is more like the S&L crisis than it is like 2008.
What are the flows of information that the Fed has access to in real time that we don't see, Betsy?
I don't know how much it's really that different. I mean, they get a lot of information, and you have a staff that compiles that information and reports it out on a regular basis. The banking information is going to be coming through the supervisory activities in the reserve banks. And my guess is right now that the supervisors are in every bank looking to see what the liquidity risk management looks like, what does the interest rate risk management look like, and what does the capital look like? Because you can plug a temporary liquidity hole with the borrowing that the Fed's doing, and that will keep banks from having to sell the securities that they own. But if those deposits are gone forever, if there's a shift in the industry from the smaller banks to the larger banks and it remains permanent, then that's a problem for the smaller bank portion of the industry.
Betsy, this was wonderful. I'd love to do this again ahead of the next Fed decision. Thank you.
All right.
Betsy Du, thank you, the former Fed governor. Joining us this morning, looking back to 2008 and maybe some differences, some similarities.
I thought that she was brilliant there, and it was really interesting to hear her insight. And what she said there, that the biggest surprise might be in the projections of where the terminal rate ends up. And they might stick to their earlier comments and that perhaps they just have a different view than the market. To me, that's pretty significant stuff.
That's out of consensus. Let's
Agreed.
put it that way.
But with a pretty informed view
Sure.
of thinking of the
We'll
Fed.
catch up with the former Fed vice chair a little bit later. Looking forward to get Rich Clarida's views on this as well. Alicia Levine of BNY Mellon's going to join us next. First Republic just distracted me just for a second, down about 8% this morning. Good morning to you.
Welcome back to a special Miami Open update for Bloomberg TV and Radio. From Tennis Channel, I'm Erin Coscarelli. Carlos Alcaraz heads to the Sunshine State, looking to become the 8th man to complete the Sunshine Double after lifting the trophy in Indian Wells. But the Spaniard faces a tricky path to the final. He could renew his rivalry with Jannik Sinner in the semis. And don't forget, you can watch all the action exclusively live on Tennis Channel.
We've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and your work. I know I deal with that all the time. This is really a people-first company. Even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that this is something that many business leaders are focused on, and time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at a 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been, and will continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
Our studios in New York and San Francisco. Our new hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
not going to be at a 2% inflation reading by the end of the year?
The recent data just don't show much slowing, and I do think that is important to the Fed's decision this week.
The market certainly is worried that we reached a point where central banks are constrained to hike.
For us to go to solidly 25, potentially nothing, and then a cut is completely based on systemic risk.
We shouldn't panic if we see them pause. Personally, I'd like them to pause.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
6 hours to go. The Fed decides. Chairman Powell in the spotlight, live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. Equity futures just about unchanged on the S&P 500. It sounds like a simple decision. It's 25 or pause. It is so much more complicated than that for this FOMC.
We just heard from a former Fed governor that it's actually not going to matter 25 or pause. What's really going to matter is where they see the terminal rate. And if they increase that, what sort of counter consensus message does that send to a market that's already been in turmoil?
And this is why it's so difficult today. It's not just about making the call 25 or pause. Got to get the statement right. There's a phrase in there, ongoing increases. Does that go? Got to get the forecast right, the press conference right, the tone of it. As for the forecast, 5.1% is the median dot for 23 in the projections right now. I think a lot of people out there at the moment, even if they're at a hike or a pause, they think things are going to stay unchanged for the median 23 dot.
But that would be a change in and of itself because the signal was that it was going to go higher.
Sure.
So the signal was that we were dealing with inflation that was hotter than people previously thought, and they would have to deal with that. If they take that back, they have to explain that. Well, then, do you think that what we've seen over the past couple of weeks with banks materially brings down the path of inflation, materially adds to your tightening in a way that you're going to recognize in your dots?
The brilliant Alicia Levine is alongside us today here in New York. She's got a line, Powell has no good choices today. There are no good choices today. I'm just going to whip through the price action, and then we'll get Alicia's thoughts on it. Equity futures right now unchanged on the S&P 500. Yields up by a single basis point on a 10-year 362. We've talked about the journey of the 2-year since the Fed last met, from 4.1% all the way to 4.2% with a lot of zigging and zagging in between, Lisa.
I feel bad for the 2-year. It's got to be tired. Its journey's been long. It's been tumultuous, and we've been all along.
You don't sound like someone who slept either. You feel bad for the front end of the yield curve.
Look, you got to bear with us because we've all been up since for the past week and examining all of this. Well, it never ended, and we're dealing with head spinning realities, right? All of the complications you're just talking about parsing through, then try to give a market response to that, which always is wrong initially anyway, and it's always exactly what you don't think. So it's sort of, what's the point? Let's go back to bed.
Alicia Levine joins us right now, the head of equities and capital markets advisor at BNY Mellon Wealth Management. Alicia, wonderful to catch up with you.
Great to be here today.
No good choices today.
No good choices today.
25?
We do 25 because the market is giving the Fed 25 in the pricing, and so in a sense, it's the easier decision. I'm not sure they should do 25 here because I think what happened in the last couple of weeks was possibly the beginning of a credit issue as smaller and medium banks start to withdraw on credit provision. But the Fed will go 25. And as you said, it's all in the messaging. And as we've seen, sometimes the messaging can be really complicated. I would look to Christine Lagarde, and I'd look to the inflation number in the UK this morning, as you were talking about earlier, as to signals of why we're going to do 25 today. And as to the dot plots, I think the dot plots pretty much stay on track here for those reasons. I think Christine Lagarde managed to message very well that they're keeping the two separate and can keep it separate. And I think that's what the Fed ultimately is going to do today as well.
Let's take the headlines from Lagarde earlier. There's no trade-off between price and financial stability. We will not entertain trade-offs from the primary objective. What does that look like if Chairman Powell repeats exactly those same words later in the news conference?
So I think you keep ongoing increases in the statement.
Okay.
If he keeps to that kind of, we're going to keep the two separate, and in your mind you need to keep this thing separate, then I think you keep the ongoing increases with the open-endedness. I don't think the dots change, but you do keep the ongoing increases. But being open to that the Fed has the tools necessary to deal with the financial stability issue. And those two things will be separate. In the end, as we've seen all over, inflation on the way down has not been linear. And I think opening up the dovishness that the market may want to see risks that other piece of it. And I think Lagarde really showed the way to how to capture this right here. So I would suspect that he's going to separate it as well. Now, did something actually happen in the real world 2 weeks ago with the banks? And I think the answer is yes, right? In the real world, credit contraction has likely accelerated.
So let's take a step back and talk game theory, because that seems to be what we're all doing right now, to try to game out what they're signaling versus what they're going to do versus what they know versus what you believe. And I wonder if, as a market participant, you think that Jay Powell has less credibility, not only in having the authority on what they're going to do, but having any extra visibility into the path of a market that has been highly indetermined.
So I think Jay Powell's credibility is intact here. He's been very single-minded on the inflation issue. There was some talk earlier in the other press conferences talking about disinflation 11 times, but I think ultimately that the pivot was real, and I think the pivot is still there. And I think the thought that the Fed actually does have the tools to understand the financial stability issue and what's happening with the banks is a very real and true thing. And so if they hike today, it is a signal that they think they've ring-fenced this and can prevent further deterioration.
So if you say that there really has been something material that has happened in the economy, what's your investing change as a result?
Right, so that's the big question, right? We talk about the economy, but in the end, we have to invest our clients' money. So our thinking on this originally was that the recession seemed to be pushed out maybe to the end of 2023 into 2024. 2 weeks ago, when that inflation, all those inflation reads came in really hot, and the economy seemed to be on fire. What we said today is that this event actually changes that. The recession comes back into 2023. Earnings likely go lower. We're pretty low in earnings this year anyway. We're neutrally weighted on equities. We never really went for the full, disinflation is here, climb back in, hand over fist, get greedy, because we simply didn't think that this was going to be so easy to get out of. In the end, this is going to be a hiking cycle, the fastest in 40 years, 450 basis points today, 475 basis points in 12 months. How do you get out of this without a recession or without something cracking? Well, in fact, something did crack.
Yep.
So, and that tends to be not just one thing. So when there's an issue in the regional banks, they pull back on lending, and that's what happens. And as you know, more than 50% of the lending to various sectors of the economy comes from these banks with $250 billion or under in assets.
So let's work through the sequencing. Bank liquidity issues, credit issues because of tighter lending, recession gets brought forward. We can agree on the date when this really kicked off. February 8th, the Wednesday evening, overnight into Thursday. Wednesday, the 8th of March, 39.92 on the S&P. We're above that now.
Right.
Why?
Because the market is pricing in that the regulatory authorities have ring-fenced this, that they've prevented further deterioration in the system, in the banking system. Had there been doubt, you would have seen more of a deterioration, but it simply hasn't happened. So the equity market is saying, look, the Fed and the FDIC and the regulatory authorities have done the right thing, and they've done it well. And the stragglers left will be dealt with.
All things being equal, then, is a slower pace of rate hikes and potentially fewer of them, which is what people have been expecting and pricing in, stimulative for risk assets?
It will be taken as such. It shouldn't be, but it will be taken as such. The market is on a hair trigger waiting for the pivot, right? I mean, if you think about starting last July, it was the pivot, then we pivoted from the pivot, then we went back to the pivot, then we pivoted from the pivot.
It's nuts.
It's nuts. It's really nuts. I don't understand why that with the 6% inflation, the market is not understanding that actually the Fed is going to keep on hiking as long as they ring fence the stability issue. And they will keep on hiking.
We're missing a point, aren't we? We're just kind of not trading the recession. We want to trade the recovery to the recession we haven't had yet.
We want the trade after the trade.
Totally.
Right? There's been a different trade in the last couple of weeks. And the market wants the trade after the trade because it's all happened so fast. Think of how quickly those deposits left the bank, right? It was people on apps. So the systems move quicker, trading has moved quicker, regimes seem to move quicker. And the market wants to price it in before we get through the recession.
Oh, no joke. I think we've had 3 different regimes in the first quarter alone.
Just take a look at the 2-year yield.
I mean, we came into this year and it was all rate cuts, recession. Then it was boom, no landing, more hikes, maybe 6. And now it's financial instability, pause, the hiking cycle's over.
And it's March 22nd. We haven't even finished the first quarter.
We haven't finished Q1.
Right. So the market keeps on pricing in the pivot. That's the key thing. We keep on coming back to it. We hold 3,800. We hold that level. I suspect we keep on bouncing around in this range between 3,800, 41, 4,200. It's going to be a very unsatisfying year because there will be signs that there's some credit contraction along the way. Your earnings will come down. Our portfolios are prepared for that. We thought this 6 months ago. We never believed that there was no landing. How do you have no landing when you're hiking like this and you start from a 9% inflation rate?
Just real quick here then, what do you tell clients?
Look, we were underweight bonds last year, as we should have been. We went neutral on bonds, so we increased our weighting to bonds. We are conservative. We are telling clients it's going to be very volatile. We do think you actually end the year higher than you ended 2022. It's just not going to feel very good. So with our higher rating on bonds and our neutral on equities, we can pivot around there. But in the end, we don't hold cash in our portfolios, and so we do relative trades, and we think we're well positioned for this. In the end, the call on the real economy has been fairly accurate. I'll say that. It's what the market does with that, which is
always the hard bit.
Which is always the hard bit. But I think that the table pounding on bonds is the right call.
I'd always prefer to be wrong about the economy and just right accidentally about the market.
That's correct.
You know?
Yeah, better to be lucky than right.
Right?
Yeah.
Alicia, this was great, as always. Alicia Levine of BNY Mellon. Nothing about the last 2 weeks has felt good.
No.
And the market is higher based on where it closed on March 8th.
Rally's going to rally.
Go figure. Euro-dollar reclaims 108. A punchy President Lagarde. Will Chairman Powell do the same thing later this afternoon from New York? This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The Federal Reserve is caught between inflation and a sudden banking crisis. We'll learn how Fed Chair Jerome Powell and his colleagues respond later today. Many economists expect the Fed to increase interest rates by a quarter point, but some say policymakers should hold off to shore up financial stability. The decision comes out at 2 p.m. New York time. Mortgage rates in the U.S. have fallen to a 5-week low. According to the Mortgage Bankers Association, the contract rate on a 30-year fixed mortgage dropped 23 basis points last week to just under 6.4%. Meanwhile, applications to buy a home rose 2.2%. Inflation in the UK rose unexpectedly for the first time in 4 months. The Consumer Prices Index rose 10.4% from a year earlier. That followed a 10.1% jump in January. Food and drink prices were among the culprits, rising at the fastest pace in 45 years. Now, all that may boost the arguments that the Bank of England should raise interest rates as soon as tomorrow. Xi Jinping used his first visit to Moscow to firmly align with Russia against the U.S. Still, the Chinese president didn't give Vladimir Putin something else he wanted, a commitment to buy a lot more natural gas. That showed that China may be hesitant about appearing too close to Russia. It was Xi's first trip to Russia since Putin invaded Ukraine. And it's a move that is certain to anger North Korea. The U.S. and South Korea plan to hold their largest ever live-fire drills in June. The exercise will involve mobilizing high-tech military equipment. The two allies are winding down training drills this week. North Korea has responded by threatening to turn the Pacific Ocean into a firing range. Global news powered by more than 2,700 journalists and analysts. I'm Lisa Mateo, and this is Bloomberg.
Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
Welcome to Balance of Power. This is Bloomberg. After a week of turmoil, what's the Fed's next move?
The job of reducing inflation is not over.
Are they worried about the signal it would send if they did nothing?
Trust Bloomberg for the fastest coverage and exclusive analysis.
Central banks groping their way through a dark room looking for Schrodinger's cat.
Does this indicate that the Fed is petrified?
Does bank supervision take precedence?
If you want to fight inflation, you better sort out your financial system first.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg, your global business authority.
We don't believe that the no rate hike scenario implies the Fed knows something that we don't. I think to think that is probably just misguided. Frankly, 25 or pause doesn't really mean that much either way. It's what he says.
The Fed is petrified.
All right, okay.
I could watch a Bramo promo all day.
That makes
Seriously,
one of us.
Absolutely love it. Julian Emmanuel there of Evercore a little bit earlier on. We're looking for a 25 basis point hike. That's the consensus view. Some people are looking for a pause. Goldman Sachs one, Wells Fargo another, NatWest, Credit Suisse making calls for a pause today. Other people say cut, including Nomura, a cut to 450. I mean, there's a call.
That is a call that no one else really seems to agree with, but that is a call, and it really bakes in this expectation that we're going to see other bank failures in the small to medium-sized region. Basically, how many others out there are dealing with the same kind of liquidity mismatch? On a larger sense, does it matter? What if they hike rates and nobody cares? Because it really has to do with the projections and the press conference.
There was some language that Marko Kolanovic of JP Morgan used earlier this week in the investment bank. He said, past the point of no return. Have we done that now? In the last 2 weeks? Have we gone past the point of no return, or are we one solution away from talking about the things we were talking about 2 weeks ago, which is something I've raised repeatedly in the last couple of days, Lisa, because I don't know. You know where the consensus is right now. Alicia Levine sat there from BNY Mellon just 10 minutes ago, and if you're just tuning in, this is basically what she said. You get liquidity issues, they turn into tighter lending standards, that turns into credit issues, and then you bring the recession forward, and ultimately for that reason, she's not very constructive on equity markets right now.
Which is the same kind of sentiment from Bob Michael over at JP Morgan Asset Management, saying even they are tightening credit conditions. They are the credit lenders, and they are definitely increasing the risk aversion. I do wonder, though, with headlines like what came out this morning, that mortgage rates fell to their lowest level in 5 weeks. On the flip side, when people start pricing out rate hikes and start pricing in cuts, how much does that ease on the margins in areas that were initially most affected by the rate hikes? I mean, these are sort of some of the dueling narratives, the dueling crosswinds that people are trying to parse through, and everybody has a different take on the implications.
I would put the emphasis on the supply of credit in the next few weeks and not the price of it, given how difficult it might be to actually receive it regardless of the price. I think that's going to be the interesting part. And of course, I know there's some association between what the price is and what the supply is, but ultimately that's where I'd put the emphasis if we're talking about tighter lending standards. That's what it's going to come down to.
That's a great point, especially because just recently there was a Federal Reserve survey that showed that the number of auto loan applications that were rejected rose to the highest levels going back to 2016 to 9%, more than 9%. This speaks to your point. Even if rates come down, people still aren't going to be taking them out, because what bank is going to want to extend that loan at a time when they've got much more constrained capital?
That's going to be the difficult issue. Let's see how it plays out. I mean, this is literally 2 weeks old. 2 weeks old. Dan Iverson at PIMCO, I keep going back to that phrase, multi-month process. He said this is a multi-month process. Let's see how it plays out. This is how it's playing out in the markets right now. No drama at all in the equity market. Futures just about unchanged on the S&P, down by 0.06%, if that's anything to write home about. The Nasdaq were down about 0.2%, a bit softer there, but the Nasdaq's absolutely ripped. Last week, what a move. Last week up by almost 6%. In the bond market, we've covered this extensively, haven't we? This 2 years just been everywhere. It's up 7 basis points this morning to 423.54. The 10 years up a couple of basis points to 363. If we can finish on foreign exchange, just the lesson of this morning from Europe and the UK, the ECB President Christine Lagarde was just so punchy. We will not entertain trade-offs are the primary objective. I just can't imagine what the market would look like if Chairman Powell adopts that language in the news conference later. Euro dollar did kiss 108. It's come back down to about 107.95 with positive 0.2%. And the lesson in the UK, you can have financial stability concerns, and then months and months later, you've still got to hike interest rates because inflation's at double digits, 10.4% year-over-year CPI in the UK. And I would also use that point, Lisa, to really frame the difference between what the UK and Europe is going through relative to the United States. They're probably something like, and this is a guess, of course, 6 months behind the Federal Reserve, and its efforts around really attacking inflation, and the inflation story in Europe is very different.
And that's the reason why people perhaps are drawing a distinction with what Christine Lagarde can do and the read-through to Fed Chair Jay Powell. Although I will say, a lot of people are still looking at them in tandem, and it was only 6 months ago that people were saying that the inflation in the U.S. was a lot stickier than in Europe. So these things can shift.
Well, think about what's happened. The ECB went 50 basis points on Thursday. Credit Suisse, let's call it what it is, essentially failed over the weekend and got taken over by UBS. And now everyone's sitting here a few days later and saying, what a great decision by Christine Lagarde. But just like you went 50, a bank failed later. Of course, it's not the ECB's fault Credit Suisse has gone under. They've had problems for a decade. But the fact is, we're sitting here a week later saying that was a great decision to go 50 basis points, and how well handled that news conference was.
Although if you look beneath the hood, did you see German two-year yields yesterday?
Yeah.
They ripped price down, yield up, the most going back to 2008. So quite a lot of volatility along this great decision. It's not as if it's been a clear message in Europe either.
We're going to spend some time with Mike McKee through the whole of today. I want to touch base with him now. Mike McKee joined us down in Washington, D.C. Mike, what's the focus for you? Because there are so many different things to focus on. I'm sure for you, like us, it's not just about 25 or nothing. It's about the statement, the news conference, the projections. Mike, what are you really focused on when this one comes out?
Well, there are a lot of different threads going, John. One is, of course, what they're going to do, 25 basis points or pause. But I think you're right that what Jay Powell has to say later will matter more. And that'll be in combination with the survey of economic projections when we see what they think is going to happen, not only with markets, but with interest rates towards the end of the year. Because they've got to incorporate the idea of the bank issues we've had into their thinking, but do we really know what the bank issues are going to mean? There's a theory out there among some folks in the economic world that we're going to see a tightening of credit, but this isn't a bad loans situation, which would normally lead to a tightening of credit. If you're running the First National Bank of Faro and you think you're doing a good job, do you need to cut back on your lending? Maybe you don't have as many customers because rates are higher. But do you have a bad loan portfolio, or do you have a mismatch? Not necessarily. So it isn't clear yet exactly how this is going to play out.
Yeah.
So it's going to be interesting to see how Wall Street reacts to all the different threads here, because it's not just we don't know what they're going to do, but we don't know what it is that matters to people today.
Mike, just quickly here, a lot of people are pointing to the fact that, yes, it's the quiet period, but typically when facts change quickly in a quiet period, they're signaling in places like publications through certain reporters that can give you a sense of where they're potentially going to go if they're going to change what they're going to do. Do you give any credence to that?
Well, that used to be a practice of the Federal Reserve. They did it once before in this hiking cycle, that first time in many, many years. We were laughing this morning that Governor Tim Reyes of the Wall Street Journal had not opined on what his views are going to be, which could mean that the Fed doesn't think it's important to let Wall Street know something, or the Fed doesn't have enough unanimity to let Wall Street know something. But I don't think they're going to do that on a completely regular basis. I think that's kind of overblown.
Look, I think he's done a phenomenal job of covering the Federal Reserve. This is not about the journalist involved.
No.
Great access to sources, great pieces. I read them all the time.
Me too.
I do think on the other side, though, it's tremendously unfortunate for the Federal Reserve that they did do that and brought us to a place where we believe there is somehow signaling from a publication around rates in the quiet period. I don't think that's a good development at all.
He has a lot of power right now over monetary policy. People parse through everything he writes. Maybe this is the sign.
Yeah,
maybe this is the white smoke coming up from the chimney.
That's a problem.
And that's what I've heard from a number of analysts. So I just had to ask the question, is there a signal and there not being a signal, which is something that people are also asking. That's how much people are trying to twist their head around what potentially might happen today.
Can I just say this? At the National Bank of Faro, we manage our interest rate risk. Okay.
Yeah, is that correct?
And liquidity is fine.
You lend extensively to the football sector. Yeah, exactly.
Okay. We're well capitalized.
Thank you.
Just want to put that out there.
That's good.
I've learned from the best. No problems here.
So who do you lend to?
We're not reaching out to Lazard to talk about,
Strategic options.
Strategic options.
Good, I'm glad. Thank you for that plug.
might be soon after this. Who knows? Jim Curran and Morgan Stanley in the next hour. Looking forward to that. Gershon Distenfeld as well. Sarah Malik, Matt Lazzetti. Great lineup. About 30 minutes away.
Seeds, typically between the time you start and they get out in the farmer's fields, is about 8 years. Now we have a pipeline of innovations. We've been funding the CG system for 20 years now. It's funded at about $1 billion a year. If people care at all about adaptation, that thing will be funded at $2 billion a year. I mean, there won't be anything close to the impact of climate-related seeds, climate-related maize, rice, wheat, sorghum, millet. And thank goodness, because of human genetics, we know how to do the editing. Thank goodness, because of AI, we know how to find the alleles. Because of drones, we can measure stuff in the field. So there's huge advance in terms of how the whole seed ecosystem moves at full speed.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Welcome back. This is Bloomberg Surveillance. Jonathan Farrow off to his next property. Tom Keene off on vacation. I'm Lisa Abramowitz as we look at perhaps a bit of a fading after 2 constructive days in the market, the biggest 2-day pop since we saw the problems emerge from Silicon Valley Bank. Just a little bit softer here, basically range-bound as people try to understand what the Fed could do, but even more so what the reaction from markets will be to what the Fed has to do. You're seeing the S&P higher than it was before the Silicon Valley Bank essentially collapsed above 4,000. You're seeing the euro gain after some hawkish comments from Christine Lagarde and other central bankers in Europe. They are full speed ahead with rate hikes, according to a lot of the rhetoric that we've heard this morning. And the yields climbing just a touch higher, but the round trips that we have seen again and again, really head spinning for people trying to get their head around where we are in terms of a disinflationary course or not. Jonathan Pingle among them. He is chief U.S. economist at UBS, joins us now. Jonathan, can you give us a sense of how much has changed for you over the past 2 weeks?
Well, I mean,
getting the magnitude exactly right now is going to be just about impossible. I mean, I was listening to some of your earlier conversation with Jonathan. I mean, this is one of those things where we can definitely sort of sign the effect. I mean, if you thought about the First National Bank of Faro, maybe they're double checking their liquidity, capital levels. You know, they're going to be wondering what the bank examiners are looking for next. You know, on the margin, this is pretty likely to imply tighter credit going forward, when credit was already tightening in the U.S. So, you know, we'll be watching the same things you all are watching with the H.8 data, lending data for the provision of credit, but certainly it's a net negative in our expectation for the U.S. economy.
I've heard that the Bank of Faro has an unlimited credit line out to AC Milan, but I'm not going to confirm that, and that is just according to sources. I'm curious, though, from your vantage point, we heard from a former Fed governor this morning that all things being equal, this is not a credit problem, that there's not necessarily the same degree of credit tightening that people are ascribing the recent turmoil to the market, that in fact there still is a very big inflation problem. On the ground, what data are you looking at for your compass amid the noise?
Well, you know, we are still getting, real-time weekly data on everything from lending, mortgage applications, initial claims. We are getting regular, price signals from, big data sources, whether it's airfares, used cars, right? So there's still a lot of data that's coming in every day that's going to allow us to assess, what's unfolding in pretty close to real times these days. I mean, that was one of the things we really learned during the pandemic was, the availability of a lot of these new data sources. So, we are watching all of that, in particular the price data. But I think on net, we were already starting to get bearish about the U.S. economic outlook, considering, there were some tentative signs that the rebound in data we saw in January really wasn't much of a rebound. And I think if you really put yourself in the position of a bank officer these days, the guests are right. I mean, we don't look at this as a giant capital hole. It doesn't look like a sudden stop. But on the margin, this does seem more likely to imply less provision of credit than more, and less credit impulse for the economy usually isn't very good for growth.
Which raises also the issue of whether the Fed Chair Jay Powell recognizes this today. In the press conference, we heard from Betsy Duca. I was referencing her earlier, and she said this. Chairman Powell was clear he expected the projections to come out in the SEP, the Summary of Economic Projections, to be higher. And I don't see any way that doesn't happen. And she thinks that's going to be the big surprise of today's press conference. Can you give us a sense of how much you agree with that and what that would mean for your estimates of how quickly recession would take hold?
Well, we do think that, they're going to raise 25 basis points at today's meeting. And we do think that, the median dot is going to revise up for 2023 by 25 basis points compared to the December SEP. So that might sound hawkish and it might be a surprise, but we also think this comes with very data-dependent language. I mean, we think they are going to put right in the statement something along the lines of that any additional or any further increases in the target range will be dependent upon the economic data and its implications for the outlook. So I think when Chair Powell frames the SEP, he is going to frame it as, and he's done this in the past, he doesn't, it's not a commitment device in his view, and he's been quite frank about that. So we're expecting him to acknowledge that base case for the committee. They do need to fight inflation, but we do expect him to admit that this does depend upon, how events unfold going forward. Now, going to the credit impulse, though, we also do think he is going to make a strong case that the banking system is resilient, safe, sound, and well capitalized. So while he is going to deliver this message of monitoring, considering credit conditions, he is going to, I think, unequivocally sound a confident tone about the banks.
Which comes in tandem, his conversation in tandem with what we're going to be hearing from Treasury Secretary Janet Yellen as she testifies in front of its Senate panel. So they have to be on the same page as we were talking about earlier, and they're probably going to speak to that same issue. Though we are looking right now at a market that has repriced in rate hikes and then repriced in rate cuts. And it's been this sort of ping pong match, as we've been talking about for a while, between that. Right now, still pricing in cuts before the end of this year. Do you think that that's premature based on the rhetoric and based on the economic data that you're seeing come out?
Well, the economic data would not on its surface imply the Fed should be cutting later this year. I mean, our forecast for core PCE inflation for, a week from now is that it's still going to be hung up at about 4.7%. But, we are forecasting that the Fed is going to be cutting rates later this year because, we do expect a certain amount of disinflation to be setting in as we roll through the middle of the year. And we expect to see a much weaker economy in the second half than the first half. So, if you're looking at, we have low claims, yes, we have, elevated inflation right now, but our expectation is, what's been put in train with the rate hikes already, what we're seeing in credit conditions, is going to lead to a meaningful slowdown later this year.
Jonathan, how many times this year have you changed your forecasts?
We haven't changed it a whole lot since last November. The main thing we've changed in our forecast was taking on board the upside surprise in the January employment report, and we did have to nudge up our inflation projections in a report this week because of the incoming January, February data. But, the broad contour of GDP and the slowdown expected in the second half of the year has really been pretty much the same since we made a pretty big overhaul in the projections back in November, where we switched from expecting a soft landing to expecting a hard landing.
So how many times have you thrown up your hands in frustration at the narrative changes that you've heard on Wall Street that have really informed what you're seeing in market pricing?
Well, throwing up my hands as opposed to, you go from times where you look like you're doing well to, the heaps of criticism being layered upon you. But, the data is not going to go in a linear direction. I think for me, the big surprise was forecasting a 290,000 gain in the January employment report and then seeing 517 and falling out of my chair. But, been doing this a long time. High frequency forecasting is difficult. There are surprises along the way. But I do think if we think about the starting point of the U.S. economy, where the level of activity has been pushed up very high by the fiscal stimulus that's faded, we have undergone a very rapid monetary policy tightening cycle. And, we're getting to a point now in the labor market where there's sort of more and more signs that, hiring is kind of caught up with activity. I think you're at a point now where, further fiscal drag and some headwinds for households this year, the ongoing impact of the monetary policy tightening, I think all points to a weaker second half.
Jonathan Pingle, thank you so much for being with us. Jonathan Pingle of UBS, joining us ahead of this Federal Reserve meeting, decision, press conference, statement of economic projections, all of the tea leaves that people will be parsing through. Michael McKee back with us, Bloomberg economics and policy correspondent. And I am wondering, Mike, as we hash out all of the potential features of this statement and the aftermath, what economic data coming up could matter in a way that the data that we've gotten over the past 2 weeks just hasn't?
Nothing in the near term. That's the interesting thing. We don't get the PCE inflation numbers until the end of the month. And so that's going to be the next determinative kind of economic data to see where the Fed's measure of inflation is. And then we go into, obviously, the March payroll numbers when we get to April. Sorry about having to work on Good Friday, guys. But beyond that, it's just going to be a matter of waiting to see. One of the interesting things that everybody is going to be looking at that nobody looks at. Remember yesterday we did that Philadelphia Fed non-manufacturing survey?
I remember.
We have almost never reported on the senior loan officer survey. It's something people watch, but it's not a major indicator. But now it's going to be, comes out quarterly. We'll probably get it sometime towards the end of April, ahead of the May FOMC meeting. And that will give us an idea of whether banks are really tightening credit standards in the wake of all this. And I do think we have to wait a few weeks. The survey isn't taking place right now. Wait a few weeks and see how this all plays out. If there is a big tightening of credit standards, then that could make a difference to the Fed going forward. But if we don't see that, then they're going to be looking at this in sort of the same way they were before the whole banking thing started. Like, where are we with inflation, and what does monetary policy have to do?
Mike, how much do you expect to hear dissent on the Fed for the first time in a while today?
I don't think we'll see any dissent. The reason being is there is an issue out there, whether the Fed thinks it's enough to pause or not. But I think they want to show unanimity on the Open Market Committee that we are in this together and we've worked out what our views are. I think if you had a dissent, then that raises questions about were there people who see something that we don't, or what's going on with the divisions on the Fed. This isn't going to be a question of monetary policy, of whether inflation is going to be rising more, so we need to raise rates higher. It's going to be a question of bank safety, financial stability, and I don't think they want any divisions over that.
Michael McKee, thank you so much down in Washington, D.C., ahead of that decision from the Federal Reserve and the press conference at 2:30 p.m. Right now in markets, we are seeing some stability. However, if you look under the hood, some signs that perhaps some of the unease isn't totally gone. We've been covering First Republic Bank for quite a while and the ups and downs. We're now looking at a more downward trajectory, $14.90, down more than 5%. And really this raises questions. What will it take to shore up confidence in a bank that reportedly has hired Lazard to explore strategic options and is looking for backing from the U.S. government? We are going to be hearing from Treasury Secretary Janet Yellen at 2:30 p.m. about what steps the U.S. can take, and we could hear from some of the senators in terms of opposition to making more measures in supporting some of these financial institutions. In markets, quiet ahead of the Fed's meeting. Coming up, David Malpass, World Bank President. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. A rescue of First Republic Bank may rely on U.S. backing to encourage a deal to shore up the lender. Bloomberg has learned that Wall Street leaders and U.S. officials have floated a variety of measures to make First Republic more attractive to a buyer or investors. The bank has lost 89% of its market value this year. It's decision day for the Federal Reserve. Will policymakers announce a quarter-point interest rate hike or pause to shore up some financial stability? It's a difficult balance placed on Fed Chair Jerome Powell between his fight against inflation and a sudden banking crisis. That decision will be released at 2 p.m. in Washington. The UK's antitrust watchdog will conduct an in-depth review of Broadcom's proposed $61 billion takeover of cloud computing company VMware. And that's unless the company offers solutions to deal with the agency's concerns. Regulators say the deal would likely lead to a substantial lessening of competition. Shares of GameStop are soaring in pre-market trading. The video game retailer reported a surprise fourth quarter profit, its first in 2 years. And GameStop has struggled with profitability as the industry has moved away from discs to online downloads. One bright spot for the company has been its sales of physical collectibles. And in sports, Japan beat the U.S. 3-2 to win the World Baseball Classic in Miami. It all came down to the final moment when Shohei Ohtani struck out Mike Trout, his longtime teammate on the Los Angeles Angels, for that victory. Ohtani was voted the WBC's most valuable player. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
You're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone. Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
It is too soon to expect that the Fed will throw in the towel, so to speak, on their inflation fighting. A complete pause may not only be counterproductive from the vantage point of the medium-term inflation objectives, but also could send the signal that they know something worse that the markets are yet to learn.
On the psychology of the Federal Reserve and the signaling from a rate hike or not, Carmen Reinhart, professor of the International Financial System at Harvard Kennedy School. And this really has been one of the key discussions, not only what will the rate decision be, but what will the projections be, what will the signaling be. The next guest is really someone with tremendous experience, both from the Treasury Department, World Bank, and also in the banking industry extensively. David Malpass, who is World Bank president, joining us here in our studios. I want to start because a lot of people draw parallels to 2008. And given your experience there, you were chief economist, top-rated economist at Bear Stearns. Are there parallels to that moment and the one we're in now?
I think there are parallels and differences. The parallels are there was really a maturity mismatch at some institutions, and the Fed had been raising rates. Remember, a long period of rate hiking leading into 08, but then some big differences. One is this time the discount window is available to the major institutions. That wasn't the case then, and so that gives some backstop, and you're seeing it really play out now. And another big difference is the Fed itself is buying huge amounts of duration, and other central banks are as well. ECB and Bank of Japan are holders of giant amounts of duration, which wasn't the case in 2008. They at that time, remember, central banks only owned Treasury bills. So that creates a different complexion to the market and a different set of tools that the regulators have to intervene. So today, I think the big issue is where is growth going to come from into the future?
Before we get to that point, I know you want to bleed that over into the rest of the world, which is an important point. I want to talk about the similarities. You talk about a liquidity mismatch. A lot of people draw the distinction. A liquidity mismatch is not a credit crisis, is not a credit crunch. But back in 2008, and actually I would argue earlier, the liquidity mismatch led to a credit crunch. How close is that sort of direct parallel, this sort of direct bleed over into credit conditions?
As interest rates are held down, which was the case in 04, 05, 06, and now in this current or over the last 10 years, then that causes asset prices to go up. So there's a workout period after that. So I think that's what we're in now. How do you adjust asset prices if yields are going to be much higher than what you thought 2 years ago or 1 year ago? And that's the challenge facing the market. How do you allocate the losses? I'm hoping that they don't go to the poor, to developing countries, and to average taxpayers. An issue is if you've created all that asset price boom, can the losses be allocated back into the same markets? And that's a big challenge.
So could you elaborate a little bit on the disproportionate holding of the burden that you see in some of the developing nations that may affect the growth profile of the world?
Over the last 10 years or so, there was this big concentration of wealth in a narrow group in the advanced economies. That was fueled by both the fiscal deficits, the huge run-up in the debts across the advanced economies, and also the central banks themselves buying duration. That supports asset prices. Long-term assets go up when there is a giant buyer, constant buyer of those assets. And so that leaves not enough capital elsewhere in the world. We've seen the slow growth in developing countries, in part because there's not good access to global capital markets. And now going forward, the challenge is a lot of the world's capital is going to be used by the advanced economies to keep rolling over the debt. So a big challenge for billions of people around the world is where is there going to be available capital? They have this big population growth in many countries, and yet the capital goes to countries that have declining populations.
So how much does that lower your projection for global growth? And how much has that lowered it even over the past couple of months?
We had lowered it substantially a year or a year and a half ago, recognizing that there was, inflation really was a challenge, that the central banks were going to be raising, cost of capital goes up, so growth forecasts go down. So in the latest, what we've seen is advanced economy growth expectations had gone up some late last year. That's the U.S. and China in particular, as China lifted the embargo, the lockdown, and so as we're looking at it now, the growth is slow but positive in advanced economies, but in developing countries, not much investment taking place. That, I think, is the big challenge. I'll be giving a big speech tomorrow at CSIS in Washington, D.C. on the importance of private capital enabling. What are the tools and techniques, and the World Bank's in the middle of it, trying to get countries to be more attractive to capital investment.
In the meantime, we do get this Fed decision later today. How does that connect to the stripping out of capital from some of the developing world? If the Fed does go ahead and hike rates by 25 basis points and increase their forecast for where the terminal rate ends up, what kind of magnified effect could that have?
I heard you talking before. They'll be sending signals of what the prospect is. I think important is for the U.S. and the advanced economies to think about how do we encourage more supply, and that brings down the inflation rate. So central banks can be more involved or recognize they are affecting the lending that goes to small businesses, and so are there ways with regulatory policy or with the bond with this duration purchasing that the central banks do. So my view is that when central banks buy duration, that actually ends up slowing growth on average. And if you look back over the last 10 years, there's been this anomaly that they're buying huge amounts of bonds, and yet you're not getting the growth rate that you expected from that. So going forward, I think there has to be a really deep dive into how do we get more growth and capital allocation worldwide.
Until then, given that all things being equal, a lot of central banks are turning to the same playbook, and you're actually seeing the balance sheet re-expand in the U.S. How slow could global growth get?
Yeah, I think it can be even a recession, and that's not off the table. The latest
global recession.
You could have a global recession. We define that as when the growth rate isn't equivalent to the population growth rate. So you have people moving backward on average. That depends a lot on the advanced economies. The U.S. is by far the biggest economy, and so its growth rate matters. And so people are watching exactly what's going on in the loan officer survey, for example. There was just a reference to that on your show. That's an important one. Are banks lending given that they see these difficulties?
So all things being equal, are the chances of a global recession much greater today than they were 2 weeks ago?
No, I would not say that. There was a recognition of individual bank problems. They were strongly dealt with by regulators. So the bigger issue, rather than looking at the near-term impact, I think we have to just stay with the idea of what's going to be done for the next 3-year growth rate of the world. How do you get out of this kind of trap of higher and higher interest rates? And I think the solution then has to be more output. How do you get more services, more goods into the global markets in order to stop the inflation trend?
Given that, what do you hope Jay Powell does today?
No, he's the policymaker.
You're like, thank
I'm
goodness
sure
I don't have
he's
to do
going
it.
to send very strong signals.
Well, I'm sure, and I'm sure people will read into them.
Yeah.
And why are you in New York?
There's a big UN conference today on water. Water is really important. Clean water for people. It helps children grow to their full height, and it helps agriculture be able to produce. So big conference on that. And I'm also doing other events in New York.
David Malpass, thank you so much for being with us. We really appreciate it. David Malpass, the president of the World Bank. A really interesting idea there with respect to some of the central banks holding duration and how that actually slows growth effectively in the rest of the world by reserving some of the assets and investment that would otherwise go to other places. Coming up at 1:30 p.m. on Bloomberg Television and Bloomberg Radio, Bloomberg Surveillance Special, The Fed Decides. Jonathan and myself will be back here parsing through all of those smoke signals as we hear from Jerome Powell. We have some incredible commentators, including former Fed Vice Chair Rich Clarida, among many others. Right now, markets churning ahead of that decision, trying to understand exactly what to be looking for. Tell you the decision, still won't necessarily get you the market response. Two-year yields marginally higher after a whipsaw action. From New York, this is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
So you've built a successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of pre-work before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. You know, lots of testing, lots of thinking about what could go wrong, lots of research. You know, when I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of, like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
It's almost decision time for Chairman Powell, live from New York City this morning. Good morning, good morning. Equity futures just about unchanged on the S&P. The countdown to the open starts right now.
everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Farrow.
From New York, coming up, equities a little changed. It's the calm before the storm. As Fed Chair Jay Powell prepares to take the spotlight, the rescue of First Republic may need government backing. We begin with the big issue, caught between high inflation and a banking crisis.
We're facing a big Fed meeting.
Aiming both for price stability and for financial stability.
I'm anxious to see what the Fed does. Inflation is still running at quite elevated levels.
Yes, inflation is too high.
It is the inflation on the heels of many years of very low rates.
They can't quite stare the inflation bare in the eyes and do nothing.
The market is giving them 25 basis points.
Go to 25, wait and watch what happens.
What we've just seen in terms of banking system,
you don't want to play around with banking crises.
It certainly has given the Fed reason to pause.
Taking a breather on the rate hike process is prudent.
Do they pause? Another question altogether.
We say it every time that it's the most important Fed meeting. I think this one actually is.
Until the next one, and the one after that. Morgan Stanley's Jim Karen joins us right now. Gershon Distenfeld of AllianceBernstein with us too. Let's go to you first, Jim. We got the decision, the statement, the forecast, the presser. What are you focused on today?
Well, clearly it's going to be the statement, and I want to see what the Fed does in terms of communicating its terminal policy rate, because what we know from last time is they were talking about a 5.5% policy rate, and then ultimately, clearly what's going on with the banking crisis that's taking place right now, that rate may come down, or at least it should, and if it doesn't, that's going to be a surprise for the market. So, you know, as everybody's discussing, it's between financial stability and fighting inflation, so I think the Fed is in a very, very difficult spot, but ultimately, I think that they do need to focus on some inflation-fighting language, but I think their language is going to be very, very important. So, you know, my view is that they hike 25 basis points, but they have a very, very soft language around that that's going to be very data-dependent, depending on what happens with the turmoil in the banking sector.
It's almost impossible to game this out, but let's talk about the language. In the third paragraph of the statement from the last meeting, this phrase, the committee anticipates ongoing increases. Gershon, do you see reason to take that out at today's meeting?
I think the Fed is in just a real big quandary here. I mean, you hit the nail on the head. We're battling, are we going into recession? Do the events of the past couple of weeks make it more likely that we are, or is inflation going to be the main problem? You know, at first blush, you would think that, I've heard many of your guests say this morning, John, this is nothing like the global financial crisis, and it's not. The starting point is so much better for really everyone, consumers, corporations, and so you would think that this is just going to be a blip. Nevertheless, we have to be humble. We don't really know, and it's possible this is the start of something more sinister. And here's the problem the Fed has. The future path of monetary policy, not just today's decision, but down the road, is dependent on answering that very question. If recent events make it more likely we're headed into a recession, not only shouldn't the Fed be considering a 25 basis point hike today, they should be cutting rates. But if this is just a blip, if we just move on from this, and inflation is still the main problem, they have to continue to hike rates. The problem, simply put, is that the desire for monetary and financial stability is at odds with the desire to bring down inflation. Raising rates in the face of a potential recession is a really bad idea, but so too is cutting them when inflation is still a persistent problem. The Fed's in a real bind here today.
So, Gershon, we'll make it even harder for them, shall we? They've got to make forecasts today. Now, I think it's impossible to make that forecast on where you think things are going to be a week from now, a month from now, a quarter by year end, but they have to do that. And that's when it comes to signaling. This is not about a forecast. This is about what you want to signal in those forecasts today, in that SEP. Gershon, where do you think they'll come down on what they want to signal today?
Well, I couldn't agree more, John. 25 basis points is a rounding error in the real economy. And I'm not sure what they want to signal, to be perfectly honest. I think they ideally want to keep optionality because they just don't know what's going to happen. Monetary policy works with a lag. We know that. We only got to 3% on the Fed funds rate, hardly restrictive in October. So we're just starting to see the impact of all this liquidity coming out of the system. What's interesting to me today, John, is I'm not even sure what the market is expecting. If you told me what the Fed's going to do, I couldn't tell you how the market's going to react. Yep. If they raise 25 basis points, is that a signal that, you know, everything's clear, or not? If they maintain rates where they are,
Is that going to give relief to the market, or is the market going to say, wait a second, are they serious about fighting inflation? Maybe the Fed knows something we don't. So I'm not even sure what the market really wants to hear today. But the important thing for the Fed is to keep all options on the table. They have to look at the data that's going to come in over the next several months, and they're going to have to make decisions. And they just don't know today what they're going to do in the future.
I'm not sure what the right balance is. Jim, I think I've said that repeatedly over the last couple of days. I've got no clue. Jim, to Gershon's point, there is a belief out there that the more dovish they are today, the worse it actually is, because people sit there and think, what do they know that we don't?
Yeah, I think that's part of it, and we can certainly try to game it out in that way. The other thing, though, too, is that we have to understand that one of the things that created this problem wasn't that interest rates were high, it was that inflation was high and interest rates rose to respond to that. So if they don't address the inflation problem, then they don't really actually address the main problem of higher rates creating all of these other issues. So look, you know, I think we have to see this through the lens of financial conditions. On one sense, there's a potential tightening of lending and credit standards that's going to slow the economy. But on the other sense, what we also have to think about is that there's also an easing in interest rates. Just look at where two-year treasuries are. Look at where they were 2 weeks ago. Rates have come down a lot. People's terminal Fed funds expectations have come down anywhere from 50 to 100 basis points from where they were 2 weeks ago. So that's an easing in and of itself into, as Gershon was discussing, into what is potentially an inflation problem in the markets. So they are in a very, very difficult spot, but I think that they're going to rely on financial conditions, and they're going to say, look, there's an easing on the rate side, there's a tightening on the credit side. What's the net effect of these two things? And 2 months from now, let's say we get past all of this and it's an idiosyncratic event. Did financial conditions actually ease into an inflationary cycle? That's going to be an issue too. And for me, that's a really, really big risk, because then the Fed's going to have financial stability problems and an even bigger inflation problem, and it puts them in an even worse spot down the road.
Well, we've got some financial stability issues right now. A bit of breaking news. Let's cross over to Abby for that. Morning, Abby.
Morning, John. And yes, we do have the shares of PacWest Bancorp plunging right now, down 12% within the plunge since the whole banking crisis has emerged, down about 90%. And the headline that we're looking at right now, there are a few of them. In fact, the first saying that it secured $1.4 billion from Atlas Financing Facility. And we also just have a headline talking about that they see 20% of debt deposit outflows since the start of the year. Investors not liking either of these headlines. You would think that these would comfort investors, or at least the one about securing $1.4 billion from Atlas Financing. They've also drawn down, though, more than $16 billion from the federal facilities to bolster their liquidity. So it's pretty clear that this company is facing the same deposit outflow that some of these other regional banks have, and that investors are feeling rattled this morning rather than bolstered by the idea that they have secured more financing. Stay tuned. Again, this stock down roughly 90% just over the last 2 weeks or so, John.
Down 13% this morning. Abby, thanks for that. Let me go through the numbers for you. PacWest deposits as of December 31st were $33.9 billion. PacWest deposits have dropped to $27.1 billion as of March 20th. They've seen 20% of deposit outflows since the start of the year. I just wonder how much of that has happened in the last few weeks alone. That stock to 1075. We're down about 12%. Katie's going to join us a little bit later. Mike McKee's with us now down in Washington. Mike McKee, this is the problem the Fed's got right now. They talk about the totality of the data, and I just wonder if the totality of the data means what's happening with individual banks across this country at the moment.
Well, the problem, John, is there are literally so many threads for the Fed to pull on today. They've got to decide whether to raise rates or pause. What's their statement guidance going to be? The economic forecast, you talked about that, the dot plot, and I'm sure there'll be a lot of questions about whether there need to be regulatory changes and what kind of rescues the Fed might participate in. So what do they focus on? And as Gershon said, what does the market care about? One thing we figure is going to change is the Fed's promise for ongoing increases in the target range to be appropriate. I suspect they take that out now as a matter of economic prudence and say something that would essentially mean they are data dependent meeting by meeting. Here's the economic outlook forecasts, where they were in December, the last time they made projections, and where the numbers are now. As you can see, they don't match up at all. So the Fed is obviously going to have to do something there. I note in that first box on the right-hand side that 2.7% was fourth quarter GDP, but 3.2% is where Atlanta Fed says we are right now for the first quarter. So are they really slowing down growth, or do they need banks to cut back on lending? That'll be part of the questions for today. And then the big one, the dot plot. We saw in the December dot plot that not only was the median for 5.1%, but there were 7 dots above that. And it wouldn't take much, especially since one of the dots, Lael Brainerd, has gone away, to move that up. But then how high? And does that signal anything? There's been sort of a mistaken impression on Wall Street that this is a Fed signal. These are 18 different people who are giving us their idea of where they think monetary policy should be. So we could really come up with anything. I don't think you can take the dot plot as a signal of Fed thinking, but it will influence what people are thinking on Wall Street.
Hey, Mike, thanks for that. Mike McKee there. Jim Karen, Gershon Disterfab with us as well. We'll continue this conversation in just a moment. Allow me just to return back to that PacWest story. It said it secured $1.4 billion in cash from a financing facility from Atlas Partners. This after clients drew down an additional 20% of the bank's deposits. The firm is abandoning a separate push to raise capital as well. I'm sure that you know already. This stock's down about 11%. We've got some clarity on what's been happening with deposits there, and they've been getting drained in a big way. 1085, we're down about 11%. Coming up a little bit later on the Fed show, allow me to go through the lineup for you because we have a stacked lineup a little bit later. You're going to catch up with the former Vice Chair, Richard Clarida, Priya Misra, TD, Diane Swan, KPMG, and the former Fed President over in New York, Bill Dudley, now, of course, a Bloomberg Opinion. Looking forward to that conversation coming up a little bit later. Let's check out the price action for you just briefly in the broader equity market on the S&P 500 right now, just about unchanged on equity futures at the moment. Equity futures not doing much at all on the NASDAQ either. All unchanged at the moment on the NASDAQ, on the S&P, on the Russell as well. In the bond market, Treasury yields just a little bit higher at 6 basis points on a 2-year to 4.22. Coming up on this program, Chairman Powell on deck as the banking crisis unfolds.
2 weeks ago, again, we were doubting whether the laws of finance had been repealed, i.e., was all this tightening in the pipeline seemingly having no effect whatsoever. And now here we are. There is likely to be more of the onion to be unpeeled.
That conversation up next.
On the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella. World. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Our intervention was necessary to protect the broader U.S. banking system. And similar actions could be warranted if smaller institutions suffered deposit runs that pose the risk of contagion. We will need to re-examine our current regulatory and supervisory regimes and consider whether they are appropriate for the risk that banks face today.
That's the Treasury Secretary, Janet Yellen. Got some breaking news just moments ago. Let's bring in the team. Kelly Lyons down in Washington, your team coverage, joined by Shonali Basak here in New York City. Shonali, what have we got?
Listen, this extension of a lifeline to PacWest is pretty remarkable after they're announcing about a 20% deposit outflow. This, John, is the first sign of how much pain the regionals are feeling outside of First Republic. And remember, even at First Republic, we don't know what that deposit pressure even looks like. The more remarkable thing is that Atlas SP is one of the entities extending the lifeline here. Atlas SP was formed by Apollo out of a business carved out of Credit Suisse. Now, remember, this is an entity formed in early February. It's the speed of private capital. It's an interesting thing, John, because remember, once the FDIC gets involved in these situations, they have not really been welcoming to the private credit markets, private capital, to let these firms extend lifelines like this. So this is preemptive. Certainly, we have not hit the point where the FDIC's involvement was really needed in scale for PacWest, but this $1.4 billion might be a template of more types of deals we might see ahead of more firms like this hitting trouble. I took a look at Western Alliance's ticker to see if they had announced anything this morning as well. There's nothing under their radar yet, but they're another one that a lot of these companies are really taking a look at given the pressure on the stock and uncertainties about those deposit outflows.
Shonali, thank you for that. For anyone confused, just a bit of clarity. It says PacWest Telecom on the screen. It is PacWest. Don't worry. The stock is down by that much. We're down about 11.8%. That's just an error that we need to fix at some point. Kelly Lyons, First Republic in focus for all of us over the last couple of days. What's the latest there?
Well, we have reporting here at Bloomberg that indicates the government may have to step in order to facilitate any kind of further rescue, because remember, the $30 billion in deposits that 11 larger banks put in to First Republic last week did not have the desired effect. Our understanding over the last several days has been that JP Morgan CEO Jamie Dimon is trying to facilitate a deal that would see some or all of that $30 billion converted into capital infusion. Yet it does seem like maybe the government is going to have to accelerate that process because, again, they are trying to stop another bank failure from happening. Our reporting from our wonderful colleagues here at Bloomberg indicates that there are a few different options they are considering to orchestrating that deal, including potentially the government taking out some of the more problematic areas of First Republic's balance sheet, because those unrealized losses have been, we understand, a sticking point for investors. There's also other potential options, including offering liability protection, applying capital rules more flexibly, easing limits on ownership stakes. All of that said, at this point, this is just talks. Our reporting indicates a lot still remains unresolved here, and yet you still are seeing continued pressure on the stock. In pre-market trading is down about 2% at the moment, John. This and PacWest as well, these regional banks remain in focus here in Washington and elsewhere.
Hey, Kelly, thank you for that. Kelly Lyons, Shonali Basak, great job as always. Stay close. Not much drama in the equity market, I've got to admit. About 10 minutes away from the opening bow, call it 12. Equity futures totally unchanged. Back with us, Jim Karen, Gershon Distenfeld. Gents, you know how this works. A lot of people have made it simple over the last couple of weeks. Jim, it goes something like this. The banking issues lead to credit stress. You have to bring forward the recession, downgrade credit. BlackRock did just that, downgraded credit. They said this would dent confidence, it would hurt growth. Do you agree?
I do agree with that. And I think what we have to really distinguish is this a systemic event or is it a heavy blow to confidence? I think it's a heavy blow to confidence. Is it a credit crunch like in 2008 or is it a credit tightening? I think it's a credit tightening. So ultimately, whatever you thought the recession risks were 2 weeks ago, it has to be higher today. Whatever you thought inflation might have been, going forward, it's probably also lower because you're going to have slower growth going forward. So it's really a trade-off in terms of all of the tightening that we may see. It's very, very likely to see in the banking sector and from the banking sector. When does that start to show up in the economy? Is it in the third quarter? Is it in the fourth quarter? Is it right away? Usually these things work with a bit of a lag. And I think that lagged effect is really what's creating the uncertainty. So look, I mean, most people don't expect that we're going to grow more than 1% this year anyways. So if we're going to shave off 0.5% or more, that's actually a meaningful amount, meaning shave off 0.5% given the tightening of credit standards. That creates more of a negative outlook for 2023, and it's something that we need to be concerned about.
Gershon, bottom line, your words, I prefer high yield credit to equity risk at these valuations. Why is that?
I think very simply, I've heard for decades now about how equities don't have any duration risk, and that couldn't be further from the truth. Equities are perpetual. You have to discount all future cash flows at some long rate. So if I use the 30-year Treasury as a proxy for the long-term risk-free rate, we've gone from about 1.7% at the end of 2021 to about 3.7% today. If I would create a perpetual Treasury bond, and you can do that, John, you might learn something today on the Bloomberg terminal, PRPL.
Thanks for that.
Create a perpetual, you're welcome, a perpetual bond, and you price it, you would see that bond would be down about 35% over that period, and equities are down less than 15%, right? Just like everything else, when high yields go up the same amount as Treasury yields, we don't say the prices are down. We don't say it's really sold off. We say that it performed in line. Equities have way outperformed here, like in fixed income parlay to the tune of like 2,000 basis points. And that just means they haven't adjusted enough. I'm not an equity expert. I'm not predicting that you're going to have some type of crash or something. What I am saying is that high yield spreads above average are more attractive than equity levels that really haven't adjusted to the fact that the risk-free long-term rate has changed meaningfully.
So let's talk about credit in absolute terms. We've talked often about credit relative to what's happening with the risk-free rate and where spreads are. Gershon, what's happened in absolute terms over the last couple of weeks as this played out?
Well, there's no doubt that fundamentals are deteriorating here, John. We expect leverage to go up. We expect free cash flow to go down. Obviously, the cost of borrowing is going up. And that's all on a relative basis not great. But the starting point really matters. You look at those metrics I just mentioned, they're still going to be about, even if they deteriorate, about 10 to 20% better than they normally are heading into a recession. Than average. They're usually about 30% worse than average heading into a recession. So starting point matters. I think that means that defaults and losses are going to be more constrained than in previous cycles. Is high yield screamingly cheap at 500 plus basis points? No, I don't think so. But do I see a looming crisis? I don't see that either.
Jim Caron, final word.
Yeah, look, I mean, I don't disagree too much from that. I think high yield around 9%, investment grade credit around 5.5%. Default risks are likely to go up with a slower economy, but I don't think it's going to be, excessive. So I think these yields give you some protection. The other thing I'll say in equities is that, we would expect earnings to come down. We would expect profit margins to come down. But I also think that there are some opportunities for companies with good balance sheets and decent liquidity that actually you can go shopping on sale a little bit here. You have to be very selective, and it's very sector specific. I would argue more the materials and industrials sectors of the market, maybe some consumer staples. So again, somewhat defensive on the equity posture, but I do think that there are some bargains out there too.
Hey Jim, Gershon's assigning homework for the commercial break now. Going to work the Bloomberg terminal over the next couple of minutes. Jim Caron, Gershon Distenfeld, to the both of you, thank you as always. Equity futures right now positive, about 0.1%, not even that, about 7 minutes away from the opening bell. Coming up the morning calls and later, looking for cover. Why Nuveen Sarah Malik is positioning for recession. That conversation around the opening bell. Plus, pushing ahead to Chair Powell's news conference with Deutsche Bank's Matt Lazzetti. All of that coming up in about 7 minutes' time.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
March 8th at the close, 39.92. Why is March 8th important? That was the day before the banking crisis really ramped up. We closed yesterday north of 4K. It's as if at the index level, this story hasn't really happened. Right now, equity futures unchanged going into the Fed. That's the price action. Let's get you some morning calls. First up, Guggenheim upgrading Spotify to buy, saying the global music industry has the potential for market-leading financial growth. That stock is up by close to 2%, 131 in the pre-market. Next up, KeyBank upgrading Meta Platforms to overweight, $30 price target, citing bigger than expected cost cuts and robust ad revenue. That stock is down just a bit. It's been flying year to date, down about 0.2% in the pre-market. And finally, Wolf Research downgrading DR Horton to peer perform, seeing an unfavorable valuation with too many uncertainties remaining in the housing market. That stock's down about 1%. 95 in early trading. Coming up, investors should flock to safety with quality growth and dividend stocks. That's the advice from Nuveen Sarah Malik. She joins us at the opening bell. Your opening bell about 4 minutes away.
For parents and anyone out there who still doesn't quite understand, what exactly are kids doing on Roblox?
Kids on Roblox aren't just playing, they're learning, they're hanging out together. When they can't be together in real life, they're hanging out on Roblox. They could be playing hide and go seek. They could be pretending they're running a store or a pizza parlor. They could be making the next big game or adventure. So it's really a wide range of things, and it involves doing things together, pretending you're together.
Everybody is talking about the metaverse as something that's going to happen in the future, but there's an argument to be made that Roblox has already built a metaverse. What do you think?
I think we've started. There's still so much innovation to be done, and there's so much invention to be done in this category that it's mind-boggling.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Connection lost.
We're about 20 seconds away from the opening bell, going into the hardest decision for Chairman Powell in this whole hiking cycle. Equity futures right now unchanged on the S&P, on the Nasdaq positive by about 1/10% on the Nasdaq 100. Last week, the Nasdaq absolutely flying. And since this mess started, the S&P 500 is now higher over that period, believe it or not. There's the opening bell. Switch at the board and get to the bond market. Yields look like this on a 10-year, unchanged at 361. Unchanged does not describe the moves we've seen over the last couple of weeks in the bond market. The 10-year at 360-ish. The 2-year right now at 422, up 5 basis points on a session. A bit more curve inversion, back to about -60. Bear in mind it was at -110 or something like that just a couple of weeks ago. The broader market looks like this at the moment, about 20 seconds into the session. We are unchanged on the S&P. We are unchanged on the Nasdaq too. We are flat across the board going into this Fed call. One stock to watch is Nike, reporting better than expected results, but delivering a disappointing outlook on margins. The company blaming it on, quote, higher markdowns, increased product input costs, elevated freight, and logistic expenses. Abby, that doesn't look good.
No, it really does not look good at all. A bit of a mixed quarter for them for sure. Now, starting off with the positive, to be fair, they did beat sales and profits in a big way. Sales, they put up more than $12 billion in sales. That was roughly an 8% beat, and they also beat adjusted earnings by 45%. A lot of it, though, having to do with the markdowns that they had for inventory. They blew out a lot of the glut that they've had there, like so many other retailers. They also had talked about the fact that the margins in terms of the miss and that outlook being lackluster has everything to do with continued high freight and material costs weighing. Now, this is a look at the margin picture. You can clearly see, you don't have to be able to read a chart to know this one's going in the wrong direction. Over the last 2 years, they've lost about 6%, 600 basis points of operating profit and margin there. Not great for investors, not liking it. It's expected to continue in this negative trend. That said, John, this is not the greatest block to be on this year, and Nike, even with today's decline, is the best house on a bad block. Nike this year up about 7% almost. Under Armour down 13%. Lululemon down 5%. So again, clearly these athletic wear, leisure stories, companies having a hard time figuring it out. Nike having a little bit of a tough day. Let's see how the day goes. Again, outperforming on the year.
Not too bad. We're down about 1% in early trading. Abby, thanks for that. Here's a view from the south side. Constructive view from one analyst. This from Barclays, upgrading the stock to overweight, seeing the potential for 20% upside. The analyst writing this: Nike's significant beat on sales and EPS is evidence of broad-based brand strength. In spite of a weakening consumer macro backdrop, Nike is the most attractive China recovery play in our sector and an attractive option for those seeking exposure to China's reopening. I have to say, I haven't heard China and reopening at all, really, over the last couple of weeks or so. That's Nike. Let's stick with earnings. Shares of GameStop are soaring after reporting a surprise profit for the first time in 2 years. The CEO saying this: we're a much healthier business today than we were at the start of 2021. We have a path to full-year profitability. Kelly Greifeld, this stock's flying.
Absolutely soaring this morning, John, up about 46% at the moment. If this holds, it would be the biggest gain for GameStop in about 2 years or so. And like you said, that comes after it beat expectations on revenue and actually posted a surprise profit. Let's get into the numbers. You had net income come in at about $47 million in the fiscal fourth quarter. That is GameStop's first profit in 2 years, John, and it compares to a loss of $133 million just a year earlier. Now, one of the bright spots in last night's numbers was GameStop's physical collectibles business. Sales rose about 12% in that category, and GameStop says it's a long-term priority. And today's 45% gain or so, it's just building upon what's been a wild ride over the past 2 years. Of course, GameStop being one of the original meme stocks, its shares are higher by over 400% since the start of 2021, with some enormous drops along the way, as you can see. But unlike some of its meme peers, if you want to call them that, GameStop has a real business, and we got a reminder of that yesterday.
Without a doubt, in those numbers, there are reasons to like that name. That stock is absolutely flying. Katie, thanks for that. We'll stay on top of that for you all day on Bloomberg TV and on Bloomberg Radio. Finally, of course, the focus over the last couple of weeks on the banks. First Republic, the financials coming off their first 2-day winning streak since February. Kelly Lyons has more. Hey, Kaylee.
Well, John, it looks like the winning streak may be snapped today because right now regional banks as a whole are down about 1%, and one of the biggest drags being created is PacWest. Of course, we're having a little difficulty technically this morning showing the move on our boards here, but it is down, according to the pricing on the Bloomberg terminal, by about 9% right now. We finally have some figures around the outflows. That bank has seen 20% of outflows. They had $34 billion of deposits as of December 31st. As of March 20th, that had dropped to $27 billion, which is why they tapped Atlas for $1.4 billion in cash and had to tap some of the facilities from the Fed and Federal Home Loan Bank System as well. Then there's First Republic, which where we are focused on is rescue talks between Wall Street leaders and government officials trying to see if an intervention can be staged to avoid another bank failure. And we understand there's a variety of measures being floated to make First Republic more attractive to potential investors or a buyer because they are trying to stop the bleeding here. This is a stock that has lost about 90% of its value over the course of the last 13 days. So we continue to keep an eye on that and really just regional banks as a whole, John, because as evidenced by PacWest, the concern about deposit flight from these mid-sized lenders into the bigger banks deemed too big to fail remains a concern, hence the underperformance we have seen from regional bank stocks relative to the broader financials complex, John.
Thanks for that. I had a feeling you were winding down. Don't worry. Kelly Lyons, down in Washington. Kelly, thank you. About 5 or 6 minutes into the session, we are down by about 1/10% on the S&P. On the Nasdaq, we're down a little more than 1/10%. That's the broader equity market story. Here's Sarah Malik's take over at Nuveen. Investors should flock to safety in dividend stocks and quality growth stocks as yields decline and fears of a recession accelerate due to tighter lending standards. Focus on quality at attractive valuations. Sarah, I'm pleased to say, joins us now. Now, Sarah, I want to start, if we can, with a quote from Sharon Bell at Goldman Sachs, and I'd love your response to this. Sharon said this about banks in Europe, and they're overweight banks. They said this: valuation for banks in absolute terms has never been cheaper outside the GFC and European sovereign crisis. And even at these points, it wasn't much lower than today. Sarah, do you like the banks? When you talk about recession being pulled forward, are the banks part of the story for you?
We've not been fans of the banks for a while now because of the impact of higher interest rates on net interest margins. But I do think we need to separate Europe versus the U.S. at this point. In Europe, the average deposit account was on average lower, and also about over 80% of deposits are insured in Europe. So it's in a much better situation, especially with Credit Suisse and UBS coming to a resolution. So higher quality banks, just ING in Europe, I think are in good shape. Now, in the U.S., we know this mid-cap situation is still very fluid. I see going forward, though, more competition for deposits, more regulations. I think that's going to be a challenge for the banks beyond the margin issues. So I think in the U.S., you need to stay pretty cautious. And the real key issue is we're going to experience a tightening cycle, a credit tightening cycle, because of everything that's gone on. And that's why we're more worried about a recession now, because that's going to impact the consumer going forward.
Sarah, when you say quality, is the NASDAQ quality?
I think there are quality stocks in the NASDAQ. Technology stocks are generally higher quality, depending where you look. Software companies, they have strong backlogs, more visible revenues going forward. That's what you want to see when you're going into a recession. Semiconductor stocks, where the cycle is likely inflecting, fundamentals are getting better there. Those are areas that are strong in technology. Be careful of cyclical technology. Some of these mega cap companies with large advertising businesses, those are going to be very cyclical during a recession. So you need to be selective in technology.
We've been talking about leadership and a change in leadership for the best part of 12 months now. Let's call it 18 months. Just 2 weeks ago, then we have to frame, Sarah, how quickly this story has moved. Just 2 weeks ago, people were telling us that there was a secular component to the inflation story. Leadership was going to change. It was higher for longer, the end of tech dominance. 2 weeks later, we've got low rates and the NASDAQ is winning again. What is the backdrop we need to think about leadership around?
I think the backdrop is more around lower is over. I do agree that it's going to be tough to get inflation back to that 2% target level. So I don't think it's about growth versus value or value versus growth going forward. I think you can find attractive stocks in both areas because we probably do have sustainably higher inflation going forward, even as we get through a recession. And interest rates aren't going back to the levels that we saw post the GFC. Pre-GFC for about 50 years, and the average Fed funds rate was almost 6%. Post-GFC, it was under 1%. We're going back to something that's more normal, and that can be good for growth or value stocks, which is why you need to be selective across the board.
So we've got to talk about the Fed as well, Sarah, because seriously, looking ahead to this news conference, there is a takeaway that the more dovish they are, the more worried we should be. Do you see it that way a little bit later?
Well, the Fed's going to be dealing with the trifecta of looking to create financial stability, persistent inflation, and also the path of interest rate hikes going forward. We're looking for 25 basis points and more cautious language around ongoing increases. It's been just a little over a year since we saw that first rate hike. We're just seeing some of the repercussions of that come to life. The Fed's going to have to balance creating that financial stability as well as battling inflation. I think that's going to be challenging, and that's why we're worried about the credit cycle going forward and potentially a recession coming.
Sarah, are you working on the assumption that the dot plot remains unchanged, 5.1%, the median dot for 23?
I think that's going to be a key focus for the Fed. I think it'll be very close to unchanged. Our assumption right now is that we're not going to see a big move there, and the language around how they're going to think about increases going forward is going to be very important. I do agree with you that if they pause, that could be taken as a negative, that they're overly concerned. And also, if they pause, it doesn't mean that they're going to pause forever. I don't see that as a pivot. I think they could pause. If they do that, they could still continue to hike interest rates going forward if inflation persists.
It's going to be fascinating to see how they navigate this mess a little bit later. Sarah, you're one of the best. Thanks for being with us. Sarah Malik there.
Thanks for having me.
Thank you. About 10 minutes into the session, we're down about a tenth on the S&P. On the NASDAQ, we're down about a tenth of 1% also. Coming up on this program, counting down to a Fed decision.
The Fed will go 25. It's all in the messaging. And as we've seen, sometimes the messaging can be really complicated.
Matt Lazzetti of Deutsche Bank, up next.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
MasterCard introduced PayPass, its first contactless payment system, in 2002, but the technology took some time to gain traction.
I would say we first invested in this many years ago. The adoption rate on this in the early part, even in markets like the UK, Canada, Australia, was fairly slow in the early part. The inflection point of when it really started to hit its stride was when it was used in the transit vertical. So what we figured is, let's get all the transit systems around the globe enabled for contactless technology. That will create muscle memory for the consumer who will like the experience in transit and will use it elsewhere.
How do you judge the revenue proposition for MasterCard with an innovation like that and the adoption and the pace of it?
Look, I mean, for us, we're agnostic as to whether somebody's using the chip technology or the contactless technology or, using the mag stripe, which was the old way of doing business. We earn revenues which are quite similar across both of those. The revenue potential and upside for us comes from the fact that now more spend is being done on card-based forms of payment than was being done in the past. So we're converting that cash over to electronic forms of payment, which is where the incremental revenue comes from.
If contactless payments is the current revolution sweeping the payments industry, what's the next one?
I think pay with your smile. So, biometrics.
The Fed will go 25. It's all in the messaging. And as we've seen, sometimes the messaging can be really complicated. I would look to Christine Lagarde, and I'd look to the inflation number in the UK this morning as the signals of why we're going to do 25 today.
Investors awaiting the latest Fed decision and Chairman Powell news conference. This, as UK inflation comes in hot, with the BOE gearing up for a rate call of its own tomorrow. The team coverage starts right now with Guy Johnson in London, Mike McKee down in DC. Guy Johnson, just when maybe we thought Governor Bailey might pause himself, that CPI print this morning, does that mean go, go, go?
I think it probably means 25, John. We've had 3 softer prints. We now see UK inflation re-accelerating, as we've just been hearing. Other central banks are going to be paying attention to that. Headline goes to 10.4 from 10.1 in January. Core 6.2 from 5.8 in January. Services core 6.7 from 6% in January. We are seeing a significant re-acceleration, John. You've got a tight labor market. You've got fiscal policy that is easing. So I think 25 increasingly looks like it is the balance of probability. I think the real question, John, is what does the vote count look like?
Very, very true. That's going to be interesting later too. We've hardly talked about that, the prospect of maybe someone dissenting at the Federal Reserve. Mike, just looking at what Guy described, the experience of the Bank of England, there's a playbook there. The experience of the ECB in the last week, there's a playbook there. A lot of people have mentioned that, Mike, just the similarities of the experience the Federal Reserve right now currently is going through. Do you think there's more similarities than meet the eye?
No, I don't think so this time, John, because we have the banking situation layered on top for us. We have 4,800 banks in the U.S. It's a very unstructured system compared to what you see in Europe. And so the Fed has to keep an eye on what's going on with that. They would probably love the certainty with which the BOE is being forecast now, that they got to do 25. Because you look there, you've got people across the board. Nomura calling for a cut, no change from some of the big names like Goldman, NatWest, and Wells Fargo. Most economists at this point looking for a 25 basis point move. The futures market pricing in about only an 80% chance of a 25 basis point move. So not a lot of firm convictions there. And of course, what's really going to be interesting down the road, which we'll get later today when we get that dot plot, is what's the terminal rate going to be? Throughout all of this last 2 weeks, we've seen that come down significantly to about 5% next month. Does that go up with a dot plot that maybe moves it up, or do the markets still think the Fed is going to be constrained in how far it can go by what's happening with banking? I think the statement somebody made earlier on this show that we don't know what Wall Street is going to react to is probably just as valid as we don't know what the Fed is going to do.
That was Gershon Distenfeld, and that's what the Fed's got to grapple with as well. Mike, looking forward to you leading the coverage a little bit later this afternoon. Guy Johnson coming up with Alex Steele in about 13 minutes now to pick up coverage after this show. Matt Lazzetti of Deutsche Bank says this: we expect the Fed to deliver a 25 basis point rate hike at today's meeting. However, the outcome of the meeting will depend on headlines and events, which could either reinforce or upend the relative sense of stability that has emerged. Matt, I'm pleased to say, joins us now. So, Matt, we've got to work through a statement, the language of the news conference, the projections. Let me start with this. Let's go to Q&A. Let's say Chairman Powell has asked this question, and welcome to the show, by the way. Are the banking difficulties of the last few weeks disinflationary? If he's asked that, how do you think he answers it?
Sure. I think, at this point, he's likely to leave it open. We're in the midst of figuring out how widespread some of the stress is, how much of financial condition tightening we're going to get, how much of a credit tightening that we're likely to see from the bank lending channel. Ultimately, we do think that it is going to be disinflationary. We think it adds to recession risks and adds to our conviction that a recession is the baseline by the end of this year. But I think from the Fed's perspective, it might be too early to make that call. And in particular, given the inflation data that we've seen coming in since the last FOMC meeting, that data which caused Chair Powell to begin to upgrade the possibility of a 50 basis point hike before all this turmoil came about. So I think it's too early for them to conclude decisively in either direction.
So, Matt, they've got to put some language in a statement. It's got to read something.
I think it does. I think even if we weren't going through this, I think the Fed had an inclination to drop that language as we were getting further along in the tightening cycle. They had language in 2006 that I think gives you a pretty good blueprint. It leaves it far more open-ended. It suggests that there is a tightening bias, but that's heavily reliant on the incoming data flow, both inflation, labor market, what they see from the banking sector. So I do think it gets dropped, and they move to a much more data-dependent language.
They scrapped the SCP in the pandemic. Do you think they need to scrap it today?
No, I don't think so. It is highly uncertain what the environment is, what the forecast is at this point. It's not a great time to have to forecast, no doubt. But I actually think the SCP serves a purpose here. They can move to a data-dependent mode. They can drop their forward guidance language. But the SCP should continue to show some uplift in the dot plot and expectation for rate hikes. And so it should reaffirm a tightening bias, even if there's a lot more uncertainty about the timing and extent of future rate hikes.
The best guess, because this is difficult, and it's not necessarily about where you think rates are going to be year-end, it's where they are trying to signal rates will be year-end, and there's an important difference there. The median dot for 23, Matt, as you know, is 5.1%. For 24, it's 4.1. The long-term dot is a little bit lower than that as well. Matt, where do you see those numbers coming out?
We expect them to be mostly unchanged. We expect a 5.1% terminal rate for this year. You only need 2 or 3 dots to move higher to move that higher. So the bar for it to rise is somewhat low. But I don't think the Fed is necessarily inclined at this moment, with all the uncertainty, to send a materially more hawkish message than what the market is anticipating at this point. One question I think would be good for Chair Powell today is, we know in December no official expected a rate cut this year. I'd be interested to know if that is still the case from the Fed's perspective, if no official expects to cut rates this year, even if we do see that 5.1% dot for 2023.
Let's just stick on the presser and the questions he might be asked. I just wonder if he used the same language as President Lagarde, Matt, how surprised you might be by that. President Lagarde this morning, we will not entertain trade-offs on our primary objective. There is no trade-off between price and financial stability. Are you expecting the chairman to adopt some of that language in any way, shape, or form?
Yeah, I think that there's no doubt you want to disentangle the two to the extent that you can. You have liquidity issues, you have financial stability considerations. The Fed has some tools to deal with those. They have their policy rate and monetary policy to deal with their dual mandate objectives. So I would expect that you do hear some of that language. But I think the reality is, if you have financial stability risks, considerations, credit conditions tightening, that spills over into how you should think about the dual mandate objectives. It spills over into how we should think about growth, the labor market, and inflation, and we think adds to recession risk. So to the best that we try to disentangle the two, they're not mutually exclusive. And to the extent that we get financial condition tightening and financial stability risk, I do think it impacts monetary policy and their dual mandate objective.
Matt, I've got to ask this then, because some people think if they don't hike today, if they're super dovish, that's a reason to be concerned. The question I've asked, Matt, is what access they have to data about the financial system that we don't have. Is there really a situation where the Fed, in this moment right now, in this news conference with this chairman, there are things that he knows that we don't?
Yeah, I think oftentimes I'm skeptical of the idea that there should be this confidence signal or channel from the Fed and their decisions, and the idea that they have some informational advantage relative to the market. I do, however, think this is one case where they probably should. They should have higher frequency data on what they're seeing from deposit flows from the banking system, the distribution of those flows, what stresses may be out there still. And so from my perspective, if Chair Powell raised the possibility of going 50 basis points 2 weeks ago, and then if they were to pause today with the market pricing it with 80% probability, I do think that sends a negative signal about what the Fed is seeing from a financial stability perspective, about imminent recession risks, and I would be concerned about the confidence effects that has. I would certainly take a negative signal from that.
Matt, just quickly, I've got 10 seconds left. What's your terminal rate right now for this Fed, and how much has that changed?
We're at 5.1%. We brought it down from 5.6 to 5.1, as you've seen the banking sector turmoil. And from our perspective, it's all been about learning the lags of monetary policy, the fact that we are seeing likely closer to sufficiently restrictive monetary policy, and that ultimately the Fed will have to do less because the banking sector and financial conditions will do more.
Hey, Matt, this was great. As always, a clinic on what he's looking for from the Fed later. Matt Lazzetti of Deutsche Bank. Equities negative by 1/10 of 1% or so. Up next, your trading diary.
So Fabian, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
25 minutes in, it's the kind of price action you expect going into the Federal Reserve today. Clueless as to what they want to signal, what they're going to do, the tone of this news conference, the projections, all of the above. Right now, equities down by about 0.1%. That's the price action. Here's the trading diary. The main event, 2 p.m. Eastern Time. A Fed rate decision, Chairman Powell news conference, plus Secretary Yellen back on Capitol Hill at 2:30. 2 more rate decisions. The BOE, the Swiss National Bank, coming up tomorrow, along with new home sales and another round of jobless claims stateside. And finally, rounding out the week with durable goods and PMIs on Friday. That does it for me. I'll see you a little bit later this afternoon for our Federal Reserve coverage. Looking forward to that. From New York City, this was the countdown to the open. This is Bloomberg.
On the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Our studios in New York and San Francisco, our new hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the NBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees. But for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired 2 consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war. So the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack at the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venergold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venergold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venergold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Venergold as an opportunity to leave that troubled home. Venergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Venergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers. One of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities in the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is a lot of them are younger investors who are looking to hone their skills.
Tech in right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwits, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, The hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price, before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350. Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign the ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interests of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, and marching trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. But while that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least have, as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that he believes broadband is something that can transform a community and should be considered a public good.
One of the first communities to come on in the United States with full-on gigabit service was Chattanooga, Tennessee. Now, they're a bigger city, but they're a city that was economically in a downturn. In the last 15 years, the city of Chattanooga has turned around in an amazing way. It's a nexus for young people to move to. It's a place where technology happens.
It's not just about logging on to Zoom, to connect with your colleagues who might be in New York City. It's also your ability as a small business, operating in the town of Nevada City or wherever it may be to, quickly upload your payroll documents or something onto the cloud, or to quickly, swipe a customer's credit card. There's just some really basic business functions and mechanics that I think people in big cities really take for granted, and that are just going to be a much bigger challenge for small business owners in rural areas.
Historically, the marginalized people, you call them as untouchables or Dalits, they have been kept away from the center of the knowledge. Once you are born into a caste, it is very difficult for you to grow beyond that. You are stuck in that identity. I think education is the best way of liberating them. So that's how I chose to work in education sector. The kind of education that we are giving to the marginalized people is going to change not just the fate of these communities in Telangana, but it is going to be the source of inspiration, source of hope for all the marginalized in this country.
Greatest blight in India is the system of caste.
For generations of Indians, the social code known as the caste system has defined how people earn a living and whom they marry. Although outlawed 7 decades ago, castes remain a significant factor in deciding everything, from family ties and cultural traditions to educational and economic opportunities. Dalits, people who are on the lowest rung of the caste system, constitute almost 1/5 of India's population of 1.3 billion. Not able to afford the high tuition of private schools, many are forced to attend government-funded institutions, which in the past have suffered from poor infrastructure, lower education standards, and high student-to-teacher ratios. But Dr. Praveen Kumar is trying to change that.
I am currently working as head of Telangana Social Welfare Residential Schools. So totally above 400 schools I manage. These are all residential schools for the students who are historically marginalized but talented and then poor. Of them, 60% are girls and then 40% are boys, because girls are more marginalized among the marginalized. Their voices are always suppressed. My approach to improve the conditions in the schools has been put your eyes and ears on the ground always. Talk to the parents, talk to the teachers, talk to the students, stay in the schools and then understand their problems, their challenges, both in classrooms and then the corridors and the dorms. Then go to the dining halls and see what kind of food they are eating, and then go to their homes and then what kind of food they are getting and what kind of challenges the parents have. Very good. 9th class. One of the important changes that I brought in after I took over was to complete the transformation of mother tongue to English medium, because English medium, as I said, English is the language of emancipation. A language that connects you to the whole body of knowledge in the world. So we had to train a lot of teachers.
Refer to the dictionary also, okay, and find out the new meanings, as well as describe about. Hey, Richita, how are you? Hi, Sindhu. Fine, thank you. And how about you? I'm fine too.
Identity is extremely important. There is a scientific evidence to prove that your sense of identity is extremely crucial to your growth as a successful human being in your life. If you accept an identity which is very humiliating, which reminds you of very painful past, I think that identity will not help you to grow. I'm not saying that you should forget your past. I'm not saying that, but that should not be the bubble in which you must live always. Sweros is an alternative identity. S stands for state, W stands for welfare, Aero, SW and then Aero is Swero. So the idea is your dreams have to be skybound. So that is what we are trying to achieve by changing the identities. Like, you say, I'm a Swero and I aim to be a doctor. I am a Swero, I aim to be a top-notch engineer. I am a Swero, I aim to be a top bureaucrat of this country. I'm a Swero, I want to be a very good actor or a musician in this world. So these are the positive images that are associated with the identity. Just to give an example to you, in 2012, in our institution, we used to produce about 6 doctors per year. But because of our, this self-liberating ideology of Sveroism, we have, this year, we have produced about 189 doctors. This is phenomenal for any poorest of the poor people. You know how difficult it is to get into a medical colleges in this country. So, but today, because of this ideology, the students have been able to achieve this, feat. Pujita has been a farm laborer, and her parents themselves are agricultural laborers. And then this girl used to sell vegetables, but thanks to the residential education institutions, she came to the Gaulidodi campus, and then she toiled very hard for 1 year, despite many problems. And today, I'm so happy to share with you that she has joined one of the prestigious medical colleges in the state of Telangana, Usmania Medical College, and then in future, she hopes to be a gynecologist. So this is the journey our children are hoping for. Similarly, the Mount Everest expedition. At Mount Everest expedition, we are very fortunate enough to place the youngest ever female in the history of this world on the peak of Mount Everest. How did this happen? It's all because of an ideology that helps you to liberate yourself. We brought a lot of extracurricular activities, and most of them got institutionalized now. So, for example, music. Similarly, the games. We have so many coaching academy. We have boxing academy, we have wrestling academy, we have handball academy. So we have, kabaddi, the traditional Indian sport. We have golf. We have introduced the golf also. Like golf is generally played by so-called rich people, but today even poorest of the poor people also are being trained in golf in our schools. Wow. So our intention has been to give all 360 degrees, type of opportunities to the students, so that whoever is interested in whatever activity, they can go and then do it. Break the barriers, break the fence, at least mentally, because poor people have been programmed to be victims, programmed to be subjugated, programmed to be on the margins, always, programmed to feel inferior. We wanted to change all that. There are certain games which are exclusive to rich people. There are certain languages which are exclusive to middle class and upper middle class in this country. To put it in one word, the sole aim of introducing all these co-curricular activities is to break the stereotypes which are recklessly imposed on these people.
Their stereotypes Dr. Kumar knows all too well. Born a Dalit, his grandparents were labourers and access to the village well was restricted. Dr. Kumar credits his parents' belief in the power of education with helping him realise his aspirations. He went on to join the Indian Police Service, attended Harvard University, and then began pursuing educational reforms back home.
I attribute whatever I am today, it's to my mother primarily. They educated me in the village, although there were no good schools. So then I stayed in social welfare hostels, the hostels which are managed by government for the poorest of the poor kids. I passed with reasonably good grades. Then I went to university, and then I faced worst form of discrimination in the universities. Like there were in those days I'm talking about. So the bathrooms and the toilets were exclusively meant for scheduled castes and scheduled tribes. We used to fight discrimination on one hand, and then again try to excel in academics day in and day out. So that's how I came to education, because I deeply believe that education is the only important weapon that can really place the poorest of the poor people from a very victimhood orbit to a prosperous orbit. I think in future this is going to be a game changer for the marginalized in this country.
If you look at a thermal image of a city and then compare that to a map of vegetation, you'll find that where there's greenery, the temperature is lower. That's because things like asphalt, concrete, and shingled roofs absorb more heat from the sun than trees. This is the urban heat island effect, and it accounts for higher temperatures in cities, often by several degrees compared with their surroundings. It's becoming a huge risk to human health as growing urban populations exacerbate the heating effects of climate change. Heat waves kill more people than any other extreme weather event, more than tornadoes, hurricanes, and even floods. That's why urban heat island mitigation strategies are being studied in Singapore by a group of researchers. The government-backed project called Cooling Singapore is now in the process of combining everything they've learned to create a digital tool that can help cities all over the world, starting with Singapore. In Singapore, close to the equator, temperatures regularly rise above 32 degrees Celsius or 90 degrees Fahrenheit. And the city structures only make it worse.
And that is also the case for Singapore, which is basically a concrete jungle, more urbanized, more developed city. And even in Singapore, what you have is a situation whereby there's a temperature difference of 7 degrees Celsius between the more urbanized and the more rural areas.
The government has taken drastic steps to keep temperatures down. This is Gardens by the Bay, an award-winning park, and inside this greenhouse is a pleasant 24 degrees. That's because the dome, along with 24 nearby towers full of thousands of people, is chilled by what's probably the world's largest underground district cooling system. It uses a large central plant that cools water and then pipes it into banks, residential towers, an exhibition centre, shopping malls, and the city's iconic Marina Bay Sands hotel and casino complex.
So one of the biggest perks of using this system for the buildings is that they can save 40% in terms of electricity usage compared to your traditional air conditioners.
And with Singapore relying on natural gas for most of its power, this new system means emission savings equivalent to removing 10,000 cars from the city's roads. That has big implications for the rest of the world. If things stay as they are, more than a third of the world's electricity could end up being used to cool buildings and vehicles by 2050.
As the world gets hotter, gets warmer, there is a greater need for air conditioning and as well as refrigerators, for instance. And the more people are buying these household appliances, the more energy usage they use, and they release heat more, and that then exacerbates climate change.
It's a vicious circle. And so since 2017, researchers at Cooling Singapore have been identifying design solutions that reduce our need for so much cool air in the first place.
One thing many cities have in common, and that's the importance of vegetation. That's a very important measure to mitigate the urban heat because of the shading effect, of course, and the psychological effects of the vegetation, and also because of the possible evaporative cooling effect of the vegetation. Vegetation can be, of course, on the ground floor in form of trees and shrubs, and you can walk under them. This is the so-called canopy layer that the vegetation forms above us. But vegetation can also go up the facades of buildings, and it can go to the roof of the buildings.
Luckily, Singapore has been striving for the Garden City feel for quite some time. It was a vision initially introduced by then Prime Minister Lee Kuan Yew in 1967 to make life more pleasant for people. And today, Singapore is one of the world's greenest cities in terms of urban vegetation. Kampung Admiralty, a community centre that contains health facilities and social spaces, now provides more green space than the plot of land it was originally built on. It's topped by a roofscape of staggered terraces covered in local plants, which functions as a community park, and a village green in the centre that contains farm plots for residents to tend to. Park Royal on Pickering was designed as a hotel in a garden that doubled the green growing potential of its site. There's now 15,000 metres of sky gardens, reflecting pools, waterfalls, planted terraces and green walls. And the government has big plans as well.
Singapore actually has a plan to plant 1 million trees and add more green spaces over the next 10 years. It is actually a mix of wanting to reduce the urban heat island effect, but on the other hand is also to get the people to be more connected to nature.
But it's not enough. The city-state has still been warming twice as quickly as the world average over the past 6 decades. That's why Cooling Singapore has developed a catalogue of other potential heat mitigation measures.
When you try to mitigate the urban heat island effect in a city or in any building, in a village as well, the first place to start is by shading of the windows. You have to keep areas clear so that the wind can move through it. Water of a certain depth can act as a very good thermal buffer. If you have to construct heavy buildings such as high-rises, at least you can make the surface, the facade, less heavy, and you can protect it from direct sun penetration. We have to make sure that no combustion engines will be in the city in the middle, in the medium to long-term range. So ideally, the electricity production is outside of the city, and you bring just the clean electricity into the city. You can at least minimize the use of energy in the city, and you can start to slowly convert the roofs, the facades of the city into production areas for renewable energy. In Singapore, unfortunately, this is a limited option, but in the long run, it could produce up to 20-25% of the energy, of the electricity needed in Singapore, if all the roofs and the areas in the buildings, on the facades would be used to do that.
With so many different ideas, Cooling Singapore is also designing a virtual model of the city to test them out. It's called a Digital Urban Climate Twin, or DUCT, that will calculate how each element of the city's design will impact the urban heat island effect.
That means we model not only the geometry of the buildings digitally, but also we model the transportation, the insulation, the temperature, the radiation coming from the sun, the weather, the local climate, the even very, very microclimate of the city, the water, the movement of people in the city. We can invent scenarios, we can design scenarios, test them before we actually build them, and if they test very well and we are sure that they will function, then we can start to build them and put them into reality.
Singapore will be using this new tool to figure out which actions it should take next. And the model can be applied to any city, whether it needs to keep heat out or keep heat in, which will ultimately save energy, slow climate change, and improve our quality of life.
So this is something that Singapore will be able to export, maybe even together with its city development systems that it already has. Singapore is one of the very few cities in the world that really combine this scientific approach with a very well-established urban redesign and urban design approach. Through its agencies and the combination of its agencies, it has achieved a lot in the past. If it keeps following the scientific path and the combination with the other knowledge in the city already, we think that it will be a very comfortable and very livable city in the future, even more than today.
Times are tough. Jobs are scarce. It's risky to be outside and around others. Seems like there's very few ways to make extra money during a pandemic. So I guess I'll just hunker down and binge social media until this all blows over. Wait, don't these people make money? How do these people make money? Streamers, YouTubers, Twitch stars. How do they make money? Is it a lot? Is it a lot of work? I know, I gotta ask somebody in the biz, and I got just the guy. Austin John Plays.
This is your full-time job now, right? As of November of last year, yes. This was always just kind of like a side thing. Like, any money that I made from doing my videos and whatever else, I never touched that because I didn't really think of that as being like real money. And then it started coming in more and more. And then it was like I hit my first day that I broke $1,000, and I was like, this is actually going to be money.
How did the YouTube channel come to be?
When the game Pokemon Sun and Moon came out for the 3DS, there was like things that I learned about the game, and then I wanted to just share that information with people. And at the time, I didn't have any way to capture a screen or anything, so I found like generic footage, and I kind of put it all together with so much editing. And that video got 6 views. And then 2 days later, I made another one, and that one got 12 views. And then I just started pumping out more and more content, and people were like, this guy knows what he's talking about. It really just started building on top of itself, and then it was like, my channel really focuses on tips and tricks. So I play a straight 18 hours, and I'll finish the game or get to about the 40-hour mark, and then I'll make my first video. While I'm going through, I have a giant notepad and just scribbles everywhere, and I make these notes of like the things that stumped me, so I know the things that may stump other people.
What do you need to think about if you're building your YouTube channel? 1,
You need to do something that you're passionate about. Not that you like, not that you think you're gonna make money on, something you're passionate about. The other thing is something that other people are passionate about.
Connection
It holds
lost.
a special place to them. And third is, it needs to be something that people are gonna seek out information on. In order to enter into the marketplace, you either need to be better than everyone else, you either need to be faster than everyone else, or you need to be more accessible than everyone else. And you can't be more accessible because it's already on the platform. Granted, if you understand how the algorithm works, which is very similar to Google Analytics, then yeah, you can have a little bit of a head start. But if you're not doing it faster, and if you're not doing it better than everyone else, then why should anyone watch your channel? So my income as a YouTuber kind of breaks down to 3 different ways. 1, which is the bulk of it, which is ad revenue. Whenever you go and you watch a video and then there's an ad and then you wait 5 seconds and you hit the bottom right corner and then you go on to the next video, or a non-skippable ad, or the video starts immediately, you get the little banner ad at the bottom, or if you scroll down from the video, the first thing that shows there is an ad. Those are the 4 different types of ads that can appear on every single YouTube video. And all of them pay a certain amount. It varies on lots of things, like the country of the person who posts it, the country of the person who watches it, the time of year, where you are in the quarter, if there's anything going on with a reduction in ad revenue. Like, great example, COVID-19, companies weren't spending as much on advertising. So because of that, CPM went down. CPM stands for click per thousand. I'm using the Roman numeral for 1,000. And that means that for every 1,000 views, you get a certain amount of money. Now, on low ads, when I first started off, my CPM was 30 cents. So every 1,000 views, I made 30 cents. But then once I signed with an MCN and I started making more quality content and more engaging content, some of my better videos and certain times of the year, I can see CPMs as high as $12 to $14. And there's a big fluctuation between, you know, if I post a video when there's no ads being spent, like January and February, that's the reason a lot of your favorite YouTubers and also TV shows don't post new videos in that time of year, because ad rates are down. Why are they going to make content then? Instead, you're recording and you're bulking up for when ad revenue is higher. The second way that a YouTuber makes income is support, crowdfunding, things like that. When I first started off, Patreon was really the only option, but then they started rolling out supporters and members for YouTube channels. So whenever I have a live stream, you can click a button and then you can become a member, and then you get special icons next to your name. I believe they're called badges. Or on any video, you can hit the join button, and that helps support the channel. And then the third aspect of that would be merch. And for me, my merch has been somewhat basic. In fact, I'm wearing one of my t-shirts from last year right now. You have to endure the times that your first video gets 6 views, that you post it on Reddit and they say, shut up, and then an auto mod bans you. You have to go through that, because until you go through that and you discover why you're doing it, you're not doing it for other people, you're doing it for yourself. If you're not loving what you do, then it's not worth it.
Huh. So make a channel about something that I'm passionate about. Oh, sweet. I guess I can make the channel about that. Now, how do I grow an audience? How do I get popular?
It's all about diversification, right? You have to have a massive Twitter following. You have to have a massive Instagram following. You have to have a massive YouTube following. Of course, you have to be on Twitch, which is the key platform. But basically, any way you can get in front of your audience, you can engage with your audience, is going to drive those clicks, which ultimately drives the advertiser revenue that you get back from all of these platforms.
It's me and Dan playing video games and talking in a funny manner over them.
They're not just people who are good at games. They're actually people who are good at online engagement, online entertainment, first and foremost.
You have the right to remain stylish. Anything you wear can and will be used against you in the court of fashion.
The streamer is either very, very talented at the game. The best player in the game is generally going to draw a crowd because people like watching people who are very good. On the other hand, they're either very, very good or funny, charismatic, whatever it is on that side.
Oh, no.
You know, it becomes more of a show where they talk about other things outside of the gaming world, and gaming becomes really just a backdrop and an excuse to engage with that audience.
There were those weird, like, Ronald McDonald, like, straight to VHS movies. You remember those?
I'm personable, I'm chatty. I would kind of, when boring things were happening in the game, I would ramble on about, movies I'd watched or books I'd read and, or conversations I'd had and stuff like that. And so I think being personable was a big part of that.
It's not just getting on and playing games. It's getting on and being an entertainer. You are putting on a show.
All right, now let me go ahead and grab the samurai sword that every gym has. Okay, he's dead.
To have a larger audience and to have that audience, I think, stay with you, you have to bring something extra. You have to find your niche. You have to find what works and what connects with the audience and what makes them laugh and what makes them keep coming back.
You got to make it a little more exciting, all right? Throw in a hanging bishop. Have everybody in suspense for a moment.
I think the real most important thing is to just get used to being on camera. Like in any sort of performance thing, is get used to talking on camera. My first few videos were terrible, but because I sat down and did it for 6 to 8 hours a day, I just got used to talking and I got over that uncomfortable hump.
If you go into Twitch purely with the expectation that you're going to make money, make a job out of it, have all this growth, and it's going to be great, you're probably going to burn out prior to getting to that point because there's very little payoff for a long time, right? Like multiple years generally before you really start to see a payoff. And so, those first few times you're streaming, nobody is there. One person shows up every 30 minutes, says hi, maybe, and leaves, right? Like, it's very discouraging, I think, for a lot of people. And so you have to be there just loving it. You have to love talking to yourself when nobody is around. You have to love just the game that you're playing, all of that stuff, because it takes a while. And I think a majority of people burn out prior to getting to the profitable point of it.
And there you have it. My very own YouTube, Twitch, Discord, and streaming channels all ready to go live. It's a veritable social media ecosystem just on the verge of thriving. So don't forget to smash like and subscribe and visit my Patreon for perks. Also, go to my merch page. And one last thing, stay cool, my friends.
This is live stream shopping, one of the hottest trends in China. Every night, tens of millions of people watch live shows hosted by influencers like Thea and buy the products they recommend. On e-commerce and social apps like Taobao and Douyin, the sister app of TikTok.
我觉得已经改变了大家的购物的方式。其实各种各样的产品，哪怕你不买，你也可以来看。当然，你看了，你就有可能会买。
It's not about, only shopping. It's about the experience. It's about having fun. You got to see 3D. You got to see in some kind of action. It's almost like a theater act.
The internet craze has taken over China. By the end of 2020, the country had almost 400 million live stream shopping users. China's live stream e-commerce market has also grown dramatically, with an estimated value of $161 billion in 2020. It's becoming popular outside China as well. So, is live streaming the future of shopping? Live streaming is not a new thing. In China, it started in 2015 with the rollout of 4G. And it was first used for entertainment and socializing. Many live streamers performed for their followers or chatted to them, making money by receiving virtual currency and gifts. In the West, live streaming is mainly the domain of avid gamers. In China, it's broken into e-commerce.
China actually has a very big e-commerce empire, so it uses these super apps, what we call that you have payment, you have search of information, you have recommendation system, and you have huge amount of goods available on the platform, and as well as a lot of consumers. So with this advantage, they merge these features of live streaming to make the influencers actually sell goods.
Here is a perfect choice. Nice neutrals, beautiful print, nothing overwhelming, and the warmth and comfort of flannel. This is item.
Traditional TV shopping involves a one-way direction, whereby a host introduces a product, demonstrates certain things, and say, call this number or something. But live stream shopping is live. That in itself is a very, very big difference. It causes different psychology. And live stream shopping is a very entertaining way of actually engaging someone else.
When you shop, actually, this live streaming video will continue. It will minimize into a corner, and you can buy the items and pay all on the same app. And after that, the live streaming screen will just enlarge by itself, and the promoter will come back to screen. So it's very convenient.
Taobao, one of China's biggest e-commerce platforms owned by tech giant Alibaba, added a live streaming function in early 2016. In the following years, other e-commerce and social platforms like JD and Douyin also integrated this feature.
开头的时候还是有很多的挑战的，对画面的这个流畅，然后是否能够很真实的去还原商品，它其实在这个上面是有很高的这个门槛跟技术的这个卡口在的。不管是我们的这个用户的接受度，还是商家的这个上手的这个难度都很高，但是这几年下来，基本上难点在不断被突破的。
Over $70 billion worth of goods was sold via live stream on Taobao in the year through March 2021. Latest surveys show that over 60% of live stream users in China were watching shopping shows, and over 65% of them shopped at least once via live stream. In 2020, live stream shopping got a huge boost during the pandemic, when millions of people were in lockdown and many retailers were pushed online.
People, during the lockdown, felt like there's a need for more social interactions. This live platform creates an interesting kind of environment that gives people the sense that I'm actually interacting with you. And then live stream shopping brings in a lot more variety of things that people could buy and satisfy, the sense of losing control, especially during the pandemic.
At the heart of this craze are the top influencers who have tens of millions of followers and sell products worth millions of dollars every night. They often use their star power to get bargains from retailers, which in turn boosts their own sales and influence.
So if you think about China's live streaming, you have to know the king and queen of the influencers. The queen of live streaming, Via, she is actually having the biggest viewership and the biggest sales volume for a long time on Taobao platform. She can sell everything from like Gucci sunglasses, lipsticks, homes and cars. One time she offered her followers to go on a Tesla ride with her, and she even, for once, sold a rocket launch in her live streaming room for 40 million yuan. The king will be Li Jiaqi, more widely known as Lipstick's brother. He used to be a cosmetic sales before he turned into live streaming e-commerce, and he knows a lot about the cosmetics. So he's the one that will actually put the lipsticks on himself when he's on the show.
Top live streamers like Via and Li Jiaqi have become celebrities in China and can earn millions of dollars a year. Although not everyone can be as popular, mid-ranking live streamers like Tiffany still earn a good income through sales commissions.
如果说单从收入方面来讲的话，那主播的收入是比普通的工作要高很多。但是呢，主播这个工作时刻对身体，包括对精神都有很大的一个考验的。就是每天需要集中精力，然后长达5-6个小时，这种状态是很累的。而且这5-6个小时的话，你是脑子是不停的，然后嘴巴是不停的，然后手也是不停的，眼睛也是不停的。像我们做主播，不是说单一的只做直播一件事情，然后还会有选品的一些工作，然后还会有一些其他的事情排在里面，其实是没有个人生活的。那我觉得增强粉丝影响力的话，不是说某一件事情。可能今天做了什么事情你就增大了影响力，而是每天不断的内容的输出，粉丝不断的可能对你的了解，慢慢的信任你。
没有芝麻酱的味道，如果吃不习惯的话就慎买。
A lot of successful live streamers are generally very good at communication. They're very good at articulating very simply what a product does, what a product doesn't do. In order for them to sell, they need to be trustworthy and appear trustworthy, and they need to show in some ways that they're authentic, right? So for Via and Li Jiaqi, they are able to articulate that quite a bit through their body language, through what they say. For example, Li Jiaqi will also sometimes say bad things about certain products because to him that's his honest opinion, and sometimes people want to hear that. And so they seem very credible, they seem very trustworthy, and don't forget, they're also very entertaining and very interesting. If you're familiar with Li Jiaqi, he won a Guinness record for like the most lipstick applications to models in like 30 seconds. So if you're able to create a lot of buzz with interesting things that you do, people who may not want to buy lipsticks will also stream in just to watch what he does. And then from there, you might get hooked.
这就是一般女生出门的时候涂的口红的颜色。
Live streamers also use sales techniques such as limited time or supply. This sense of scarcity can often encourage viewers to buy.
The platform in itself creates and enhances some of these things because you see it live. Something we call social proof has taken over, meaning that, hey, other people are interested, other people are joining in, other people want the same product. And they add it in the chat and they ask questions and they say, oh, I want this too. What happens then? It makes the whole product even more scarce.
But it's not just influencers. Local farmers, luxury brands, even mutual funds have also started their own live stream shows.
Working with very top-tier live streamers can be risky. It's not necessary that the benefits will end up with the brand. So we see company executives opening their own shows, and we see like P&G have their own sales room which runs shows every day as well. We also have like local governors in like small towns to sell their agricultural products. So the live streaming is definitely transformed the way product owners can think about how to reach their consumers, and it enables a lot of players to actually sell.
Live stream shopping is going global. Merchants in Southeast Asia have embraced this trend. And in the West, Amazon has upgraded its live streaming function, adding interactive features like chat rooms. Companies, including Google and Facebook, are also developing and investing in technologies to integrate video and e-commerce.
直播电商它其实已经开始成为主流，它未来的发展空间跟潜力都是巨大的。
接下来大家会越来越依赖这种购物方式，会变成一个比较日常化、比较规范化的这么一个趋势。
If you look at the numbers alone, their numbers alone, Li Jiaxi's numbers or Via's numbers, you know that they can sell and you know that they can generate revenue. Are they able to sustain it over a long period of time? It depends on how innovative they are at changing some of the things that they do.
But you can't expect consumers one day turn into virtual shopping for good. There will be the nature of us that crave to go into the store, to touch the goods and actually wear it and see how it looks like and walk around in that with our friends. And those things wouldn't be replaceable with live streaming.
You could imagine that the oceans are actually the largest battery. We're storing huge amounts of energy in the oceans. The wave motion can be very deep. It can extend down several hundred meters. And once it gets to the near shore, from about 50 meters, the whole water column is moving backwards and forwards.
As we search for ways to reduce our reliance on fossil fuels, some are looking to a largely untapped potential source of renewable energy. In theory, waves off the coast of the United States alone could generate over 2 trillion kilowatt hours of electricity a year, enough to power more than half of the country.
Waves intensify and subside not as quickly as the wind, and that means that it can produce a smoother power generation curve. One of the potential advantages of wave energy is that it could act as a complementary source of power compared to other renewables on the grid if it were to be scaled up to commercial scale.
For decades, engineers have been trying to convert wave energy into electricity, but a host of technological and financial challenges have complicated their efforts.
In the years from around 2006 to 2015, there were a spate of bankruptcies in the sector, and this was largely because of a lack of kind of continuous proven projects out at sea with reliable electricity generation.
Since then, companies have been trying to develop the technologies at a steadier pace and with a smaller cash burn. But the same questions remain. Can companies develop devices and technologies that actually work? Is wave energy just a novelty or something that can become a major renewable energy source?
The sea is a very challenging environment within which to operate a power project. So seawater is corrosive and conditions are very rough. So this means that power projects don't have a very long lifetime, and it increases operating and maintenance costs.
Partly because of that, many early wave energy projects hit rough waters, such as the Palamas Wave Energy Converter in Portugal and the Isla Limpet project in Scotland. But that hasn't stopped others from trying.
Companies are focused on testing projects out at sea, proving their durability, trying to raise capital and bring down cost. The sector hasn't really converged around one single technology design, and companies are kind of undecided about which design works best. Finland-based AW Energy is a veteran in the sector.
The first proof of concept of the company's device was made in the 90s after diver Rauno Koivusari observed the strong back-and-forth movement of a hatch cover in a shipwreck in the Baltic Sea.
The waves are generated far from the coastline, so the wind blows on the surface of the water, causing the water particles to rotate. And that rotation extends deep down below the surface, and the waves can be very long. They can be several hundred meters long. And as they come into the near shore, this rotational energy turns into an elliptical energy, and eventually backwards and forwards, as you probably noticed if you've been swimming on the seashore in large waves, you're pulled in and out. That's the energy that we're extracting. There's a sweet spot where we deploy, so around 10 to 15 meters of water depth. That's where there's still strong wave energy coming in.
After years of research, prototyping and testing, the company has deployed Wave Roller, a 350 kilowatt device in the waters off Portugal. Wave Roller has an 18-meter wide and 10-meter high steel panel fixed to the seabed via a floatable foundation. The panel moves back and forth with the waves, capturing the energy.
It's submerged in the depth of 15 meters, so it's protected from the extreme waves. We generate electricity by capturing the movement with hydraulic circuitry in a machine room underneath the surface. That hydraulic energy we turn to electricity with hydraulic accumulators and hydraulic motors, and also a generator.
The Wave Roller has survived large waves at sea for over a year and delivered electricity via an underwater cable to the grid in Portugal. Meanwhile, the company has won a €2.5 million grant to work on an upgraded version of the Wave Roller, aiming to increase the electricity generation capacity to 1 megawatt. The upscaled device would have a bigger panel, 2 power takeoff units, and improved software to control the energy production.
We have taken into use a wave prediction algorithm that kind of tells us what kind of waves are coming into our device. That gives us few seconds to prepare for capturing more energy, and the difference in that is significant.
Our future plans are to deliver technology around the world. So I'm hoping we can be working on delivering technology to projects in Asia and also in the American continent as well.
Meanwhile, Israeli company Eco Wave Power is taking a different approach to capturing the power of the ocean. For the company's founder, Inna Braverman, developing new sources of renewable energy is a personal mission.
I was born in Ukraine in 1986, and 2 weeks after I was born, the Chernobyl nuclear reactor exploded, causing the largest in history nuclear disaster. I was one of the babies that got hurt from the negative effects of such explosion. I had a respiratory arrest and a clinical death. Luckily, my mother, a nurse, approached my crib on time and gave me a mouth-to-mouth resuscitation, which saved my life. I got a second chance in life and decided to do something good with it.
Growing up, Inna wanted to be a politician to positively change the world. After working as a translator at a renewable energy company, she decided to change paths.
Solar and wind energy were fully commercialized. There were a lot of amazing technologies implemented everywhere. I saw that wave energy, although it's an immense source of electricity, the biggest companies in the world are trying to develop wave energy with no success. And there was kind of a race going on in the world of who is the company that is going to develop a viable wave energy solution first.
In 2011, the then 24-year-old Inna co-founded Eco Wave Power. Instead of installing devices offshore, the company's devices are attached to existing breakwaters, jetties, and piers.
Our technology is very cost efficient, especially in comparison to the offshore technologies, because we don't need any ships, divers, underwater mooring or cables. We install on existing man-made structures, and all our expensive equipment, the generator, the hydraulic conversion unit, the automation, is located on land just like a regular power station.
This is the EcoWave Power conversion unit that has been operating in Jaffa Port
since 2014 until 2020. Here you can see how the technology works. Basically, the floaters are going up and down and pushing the hydro cylinders, which transmit biodegradable fluid into land-located accumulators. A pressure is being built. The higher the waves, the higher the pressure, which is used to turn the hydro motor, which is turning the generators. The whole system is controlled by a smart automation system, which you can see right here. And in case of upcoming storms, the system automatically raises the floater above the water level and keeps them in the upward position until the storm passes.
The company has been operating a 100-kilowatt grid-connected device in Gibraltar since 2016, which is enough to power 100 households. Currently, Ina and her team are working on another 100-kilowatt project at the Port of Jaffa in Tel Aviv.
The project will be also the first time in the history of Israel that wave energy will officially connect to the electrical grid. And our goal going forward is to expand it to all suitable breakwaters in the city of Tel Aviv and to supply a significant part of the city's electricity needs.
Today, engineers and entrepreneurs are still trying to crack wave energy. Globally, only a few hundred kilowatts of wave energy are deployed, compared with gigawatts of offshore wind. But the field has come a long way in recent years, and with the right engineering solutions, this new power source could eventually become competitive with more mature renewables like solar and wind.
I would have a lot more confidence in the success of wave energy companies today as opposed to like 20 years ago. But in the next few years, or maybe the next couple of decades, it will be more likely to be used in remote locations like islands that are otherwise dependent on expensive diesel power, or out at sea on gas decommissioning rigs, or for powering underwater autonomous vehicles.
So definitely, wave energy can compete with other renewable energy sources, but I personally believe that this is not a competition. In order to have a 100% renewable energy friendly world, we need all renewable energy sources to work together.
Who are all these people from? Who are all these people from?
So can you please tell me? I'm not going to... please wait.
You know, I've covered a lot of companies. I've covered a lot of Machiavellian companies where, you know, people play rough. I don't think I've ever seen anything on the scale of Nissan.
He is making you, but you act for this side. I mean, it's corrupt.
One of the most dramatic elements was Ravinder Pasi's home being raided by court officials in Yokohama.
You scared my wife. You scared my children. I worked in this for 16 years.
So Rav Passy's journey into the darkest recesses of the Japanese corporate world started when he was the general counsel, the highest corporate lawyer position in the company.
In the past few minutes, Nissan has revealed that its chairman has been arrested after allegations of serious misconduct.
He was tasked with investigating Carlos Ghosn. And he was told, conduct an internal investigation and get to the heart of the matter. And then along the way, he started to notice serious conflicts of interest.
He is one of the few people who knows an extreme amount of detail regarding the alleged crimes by Carlos Ghosn, and he's now ready to tell his own story on the record about some of the events that happened.
My name is Ravinder Passy. I'm the former Global General Counsel of Nissan Motor Co. Limited. And you could say, yes, I had a front row seat in terms of what was going on.
When Carlos Ghosn saved Nissan years ago, he was depicted in Japanese comic books as this hero, and now maybe we'll see comic books where he's the villain.
In corporate Japan, Nissan was quite an unusual company. It was led for 2 decades by a non-Japanese executive.
Well, Carlos Ghosn was a hero in the Japanese business world. If you had a global business celebrity in Japan and worldwide, it was definitely Carlos Ghosn.
In a country with few foreigners at the top, he stood out. But over the years, he saved Nissan from bankruptcy, allied with Renault and Mitsubishi, and turned the alliance into one of the most competitive in the world.
Yet as the years went on, I think his ambitions changed a little bit. He started thinking about legacy plays, and one of them was to really tighten the alliance between Renault and Japan. And unbeknownst to him, there was a contingent of senior Nissan executives that were really felt threatened by that move. They really thought that they would lose complete control of the car company, and even in the government, there was probably a little bit of anxiety about a national champion in the auto industry falling under full-blown foreign control.
Carlos Ghosn was an auto industry leader, respected by many in Japan. Now he's in jail.
The arrest of Carlos Ghosn came completely out of the blue. This was in November of 2018. He was coming to Japan on Nissan's corporate jet for a regular executive meeting, and he was met on the tarmac by Japanese authorities who whisked him away to jail and charged him with financial misconduct crimes.
So what happened was that a power struggle ensued inside the company, and somewhere along the way, it was criminalized. By that I mean that there were allegations leveled at Carlos Ghosn about the way he reported his pay to Japanese authorities, the way he handled money inside the company, that in other contexts might have been a board action, might have been handled internally. A number of executives at Nissan decided to take this difference and take it over to the Tokyo prosecutor's office, and that unleashed a chain of events that would shake the entire auto industry.
So after Carlos Ghosn was arrested, Nissan launched an internal investigation into the events that led up to his arrest.
So Rav Passy was tasked with investigating Carlos Ghosn, and he was told, get to the heart of the matter, find out what Carlos Ghosn did wrong and bring it to our shareholders.
It's really complicated because you had various things coming out of the weeds. 2018, the investigation has started, and we become aware of matters in terms of conflicts, actions by certain individuals that cause some concern because things might not quite be what they seem.
So in our story, we really took a close look at Harinada and his role in Carlos Ghosn's downfall.
Harinada is one of the most fascinating figures inside Nissan. He's also a lawyer. He's originally Malaysian. Hello, Mr. Hadi. And he had a meteoric rise through the company and became very, very close to Carlos Ghosn and other top figures. He had a front row seat at all the major strategic deliberations at the company. And when he discovered that Carlos Ghosn, as his final legacy play, was going to tighten the relationship between Renault and Nissan, he made a decision to go against Carlos Ghosn. And he became one of the key figures that decided that Carlos Ghosn had to go.
Harinada was somebody who actually recruited me into the company, so I have a long-standing relationship with him, or did have a long-standing relationship with him. For many, many years, he was a mentor. I had doubts about the credibility of the process right at the start. Harinada had a plea deal with the Tokyo prosecutors. Now, that suggests he was intrinsically involved in some of the wrongdoing, or the allegations of wrongdoing, and it just didn't smell right, just doesn't sit right.
So there was a basic conflict of interest. In other words, Harinada had to deliver results to Japanese prosecutors to avoid his own criminal liability, and he's accusing and leading the investigation of Carlos Ghosn.
Some of the people who had been involved in the original alleged crimes were also looking into the affairs themselves. Ravinder Pasi began pointing out some of these conflict of interest issues. And the reason for that is essentially his concern was for the company. If the company's own investigation into itself was compromised, that could lead to a very weak position in various lawsuits that it was dealing with across the world.
I had discussions with Harry, discussions with the statutory auditors about these conflicts, discussions with HR about some of these conflicts, because at that point, we reported into him. You know, at the time, everything was quite, as you can imagine, it was, we've got to do this, we've got to do that, we've got to move fast. But when you step back and look at some of these things, you just think, my God, what was going on here? Because members of my team were being placed in immediate danger. Your chairman's been arrested, a representative director's been arrested. They both happen to be foreigners. And then now what we need to do, we're being instructed to do, is certain compliance professionals need to go into properties in Brazil, for example, and retrieve evidence. They've got to do it very carefully, because if they don't do it carefully, they're going to get convicted of criminal activities. And likewise, when a team of lawyers were commissioned to go to Lebanon, I mean, one of my immediate concerns was, why are lawyers from Nissan being sent to go to Lebanon to retrieve evidence? These are just lawyers, they're corporate lawyers from Nissan. You had revelations that a number of executives had benefited from share appreciation rights when they shouldn't have. I mean, you know, substantive amounts of money being taken by these guys when they weren't entitled to take them. And you do think, yes, how is this going to look later on? It's going to look quite concerning. So that triggered, for me, the sort of assessment that, well, I'm going to have to do something, because up until this point, I haven't put down on paper these conflicts and these issues.
So Rav Pasi makes a fateful move. He writes this letter to the board listing every suspicion he has in great detail, backed up by evidence, backed up by memos, of why this internal investigation had serious problems. He sends the letter to the board and it's crickets. He doesn't hear much of anything.
Nothing happened thereafter. Nothing at all. Just like it just gone into a black box.
And he began to suspect that there was a desire, even at the highest level within Nissan, to kind of sweep these conflicts of interest under the rug.
Unfortunately for me, I think, again, with hindsight, people must have thought that this is the nail that's sticking out, and we can't have this. Within 3 days of me submitting that to the board of directors, that letter to the independent board of directors, I was removed from the GOAN executive conduct matters. I was then told that I could not attend board meetings anymore. And up until that point, I had attended every single board meeting. I was then also told that after 8 years of being in Japan, I'd be going back to the UK. It eventually transpired that I'd be the VP of Projects and Transformation, managing a team of 3. So you can imagine what this feels like at this stage. Almost an arbitrary removal from Japan, where I've lived for 8 years, had 3 children there, my family has grown up, and we've been settled there, having a few months earlier been promoted to vice president at a global level, to being almost demoted.
So Pasi was essentially being reassigned to get him as far away from the internal investigation as possible, and also to a certain extent in retaliation to some of the issues that he brought up regarding the internal investigation and Harinada.
What happened to Rav Pasi can be seen as a series of corporate humiliations. I mean, first of all, his immediate responsibilities were taken away from him. Eventually, he lost, the coveted general counsel title. But it didn't stop there. Toward the end of his stay in Japan, Rav and his wife were convinced that they were being followed.
During that period, I'd noticed that whilst driving my car, I'd have other cars following me. First time I noticed this was around mid-March, and I was driving, I can't remember where I was going, but this grey van, small van, just literally started following me. And I noticed that there was somebody in the car taking pictures. And lo and behold, we were absolutely being followed either by people on foot or other individuals, 2 or 3, normally 2 burly men in a car, different cars at different times, following us around. They were following the family as well. And, given I'd seen the Nissan security department behave in a very, very egregious manner with others in terms of following and surveilling, I was very concerned as to what they were doing and who they were giving this information to. Because if they're giving this information to the authorities, you do think, why? What's going on here? I mean, this is just not normal behavior.
And this all culminated in a rather dramatic event in the middle of 2020.
Who are you people?
Where Nissan had hired a legal team and had obtained an unusual court order from the district court in Yokohama
to basically do a search of his home and seizure of his corporate laptop and phone and other documents.
If you don't let us in now, we have to break this key.
So it's a pretty extreme way to treat someone who'd spent 16 years at the company.
These people have all come in. We don't really know who they are, apart from the fact that I've been shown a badge that says the Yokohama court. And they're here to recover a laptop and a mobile phone. It was even more weird because I'd highlighted to the directors that certain Nissan executives were trying to recover this laptop and this phone whilst I was still in Japan. And I was very concerned because it had evidence on there that related to misconduct matters and other forms of inappropriate conduct. It was just another form of intimidation, another form of harassment, forcing me almost to leave the company and the country. Because once they'd retained and obtained these items, we were still followed, which, again, I just couldn't understand. What is the point of doing that? You know, this isn't a car company. This is not the KGB.
I think it's fair to say that Rav Pasi didn't have full battlefield awareness of all the intrigue going on at Nissan. I mean, Hari Nada is interesting because he's both charismatic and charming, and one of the most brutal corporate infighters one could ever run across.
This is a confidential company email, right? You should not have this.
If he had fallen into line, he would probably still have his job at Nissan, be paid very well, and continued his work.
A career that he spent 16 years building at Nissan is irretrievably broken. It's been smashed to smithereens. He and his family paid a huge price, certainly. But in terms of being able to sleep at night, I think, he's come out ahead.
I highlighted issues to the highest levels of the company so that they could be dealt with appropriately by those in charge. There was no response to those, and there was retaliation against me. What's really profound, like absolutely profound, is that none of your colleagues, I mean people who you have known for years, forget it.
Yeah.
You're on your own.
Yeah.
And you got to be ready for that. You've got to be ready for that. If you take it on anyway.
This is the awful truth. There's always someone in the family that's pushing it.
This lady does not deserve to be taken advantage of, especially at your age with your own grandchild.
Yeah.
My grandma is having to sue them.
I'm testifying against them. Nobody's talking. They're one floor below right now. I get afraid to go on the elevator. It's sad that it had to devolve to this.
It's like a soap opera
It's a
to
very
me.
sad thing.
It's a family feud.
A family feud.
Here's a family that, on paper, you would think has the wealth that so many people seek, yet at the end of the day, it seemed to sort of rip everybody apart. My name's Tom Schoenberg. I'm a senior reporter here at Bloomberg News, cover financial enforcement. I was approached by someone close to the Schottenstein family and asked whether or not I would be interested in writing about Beverly Schottenstein and this case that she had against JP Morgan. And it was immediately clear that there was a great story here to be told. So I started just, assembling all sorts of documents that the family made available to me. That included a diary that Beverly had begun writing when she started having suspicions about what was actually going on with her money. Beverly obtained her wealth from the Schottenstein kind of retail empire that has at times included Big Lots, Value City, American Eagle Outfitters, DSW Shoes. Beverly's husband died, and at which point they sold off their portion of the company, bringing them an enormous amount of wealth at around 1990. Estimates of her wealth were around $90 million. She, for many years, had that pool of money being managed by outside advisors. Her grandsons in the late 2000s had both graduated and were becoming financial advisors. She gave them a little bit to work with, and over time, her grandson, Evan, became the trustee of her entire estate. Managing sort of family money is not a conflict. In fact, some ways in wealth management, it's kind of how you get your start. It's kind of the seed that you need to sort of get going in the business. But Beverly started having suspicions that something was wrong probably in around 2016.
Well, there were suspicious things, but taken separately without everyone talking about their own experiences, it was hard to really put it together.
She had written a check to her caretaker, Dawn, that bounced. So she went down to her local Chase branch to sort of find out what was going on. She wasn't getting paper statements in the mail, so she asked them to print out a number of her statements having to do with her checking account and her credit card account.
So we went to the bank and asked for the statements. And she got a whole year and going through all of them, page by page by page.
And it was there she saw all sorts of charges that she said she didn't authorize or didn't know about.
I was becoming very, very suspicious. I was starting to look in the money part, and that's what bothered me more when I saw that money was going, and I was not a big spender.
Around the same time, Dawn, she starts noticing Beverly's son, who lived in the condominium below her, came up with Evan with a shredder and started grabbing papers in her office area, including some with JP Morgan letterhead, and just started sitting at the kitchen table just shredding documents over and over.
Yeah, they came in one morning.
They used to do it in the back.
Through the back door, and they brought the shredder inside. And then they went in the drawers in the office and took out all the papers, and they started doing it. I was very suspicious because I know you don't go around and destroying papers.
Beverly said that they had done this many times before.
That's when she said to me, Dawn, I'm going to write my feelings in this black book.
Diary.
And it's a diary, and she started writing. Each day she would write a little at a time.
Around the holidays of 2018, a package had arrived, a FedEx package, and in it were materials about a venture capital fund based out of the Cayman Islands. Dawn and some other family members take a look at this, and they see that Beverly is signed up for this fund to the tune of $5 million over the course of several years.
And that was really the beginning of it. That was sort of the tip of the iceberg when it became obvious that something was going on, that my grandmother really wasn't aware of this fund.
Beverly started to panic. She got really upset and called, J.P. Morgan's headquarters in New York and asked for Jamie Dimon. She said she was told someone would call her back, but she says that never happened. She wrote a letter to Evan and Avi, and in there she laid out a number of things that were concerning her: unauthorized trading, the checking account. She had about $1 million worth of jewelry in a safe deposit box, and that her son Bobby had the key to that box, and that jewelry had gone missing. All this was kind of packaged in this, 5-page handwritten amendment to a will and trust.
There's such an evolving narrative about why the jewelry was taken. The only truth we really know is that the jewelry is gone. But why it happened, there have been a lot of different stories.
You just don't take your mother's wonderful things and hand it out.
And they emailed that note to J.P. Morgan to seize all activity on her account.
And it ended up setting off a firestorm after that. As soon as they got this email that there was a cease and desist and that she wanted to send her money and change brokerage firms, they were actually vacationing one floor below downstairs. They're there right now.
The next day, Beverly's in her place. The granddaughter's still in her place visiting. Dawn is there, and up comes Bobby kind of barging through the door. And he's screaming about what was sent to the J.P. Morgan. They're now investigating them. And he's furious, takes his mother and sort of puts her into a chair, gets pen and paper, and she says physically forced her to write a retraction letter.
They were pushing me around.
It was a scary time. I was really afraid, too.
I had to take her to the doctor, and she did an x-ray because she was in so much pain.
The locks had to be changed. The phone number had to be changed. I really thought we were going to have to hire guards to be outside just for protection.
Oh, it was terrible.
Horrible scene.
Beverly brought her case before the Financial Industry Regulatory Authorities, usually known as FINRA. It took several months of hearings. She sees all sorts of transactions that's going on, hundreds of them that she claims that she never knew about, never authorized, but yet were logged in J.P. Morgan's files as having been direct requests from her. That included the sale of a large amount of Apple stock worth several $1 million, as well as all her stock in Big Lots. Over the course of their time with J.P. Morgan, Evan and Avi were making all sorts of trading on her account that was generating millions of dollars in commissions for themselves and the bank, yet she was not sort of getting any of the type of gains that you would expect sort of an $80 million account in a bullish market to be able to get. They issued a ruling entirely in her favor, finding that her grandsons, as well as J.P. Morgan, they were liable for violating their fiduciary duty, misrepresenting themselves, and they also found that the bank and her grandson, Evan, were liable for elder abuse. Evan and Avi, they were fired from J.P. Morgan. They issued an award of about $19 million. I reached out for comment, and J.P. Morgan emphasized that Evan and Avi were no longer with the firm and that their actions do not represent the sort of values of the bank. I reached out to Evan and Avi, heard back from their lawyer saying that, they disagree with the law and the facts that FINRA kind of used to decide the case against them and are seeing if they can have it withdrawn. Her son, Bobby, wrote her a letter, said his sons weren't criminals, and he also admits to taking her jewelry. And he says he needed it to pay off some bad business debts he had.
They never once came up to say, I'm sorry.
If there had been an apology and some acceptance, and asking for forgiveness from my grandmother, I don't think we'd be in the position that we are now.
Since the piece came out, we've received dozens of messages from people, many of whom are telling their own sort of personal tales of, kind of financial advisors gone bad, or family members who got control of an estate and abused, those within. Seems that it's really resonated with a lot of people. I keep, hearing a lot of feedback about Beverly and how, a lot of people feel she did the right thing.
You're never too old to stand up for yourself and try to right an injustice. She was adamant that she wanted to stand up for herself, but at the end of the day, they did wrong.
It's a painful life lesson. You know, Beverly taught them that you don't mess with grandma.
On April 20th, oil markets did something they never had before, and they crashed, went into negative territory, and closed the day at minus $40. Meanwhile, in a place called Thaden Boyce in Essex, a group of 9 traders, led by a guy called Cuddles, made $660 million over the course of a couple of hours.
The price of oil has collapsed to a record low.
We've never really seen anything like it. WTI this morning down more than 35%.
People maybe wouldn't have been so surprised if the oil price had fallen to zero, but the oil price went to minus 38.